All right, hi everyone. We're going to get started in just a second here. If you can hear me, go ahead and just type something in the chat. Okay, great. Let's see. KP says hello. Paul says good. Jen says yes. Okay, awesome. Let's see. Where is everyone logging in from today? Go first. I'm in Louisville, Kentucky. Anka, if you can hear me, go ahead and record to your computer. Bruno's from Denmark, Jen from Seattle, Paul from New Jersey, Debbie from South Carolina, Tana from Texas. Okay. Sounds good. Okay. Um, all right. Unfortunately, we have had some technical issues. Um, if you have been to any of my events for the last couple of years, you know that usually Adrian or Julie Mans opens the event for us. And usually Adrian, well, either of them record the presentation the night before and send it to me because they're usually in their, working with their students right now. But Adrian tried to record something, he said 4 or 5 times yesterday and kept having technical issues. So I'm going to go ahead and I'm just going to play um, a different presentation of his from recently, but still great education and everything. And then we will be um, the rest of the day will be live presentations. Oh, yeah. Um, so um, yeah, then at 11 a.m. Serge Berger will be here live, and then Anka Metcalf at 12 p.m. Eastern time. Um, yeah, we're gonna get started. This is day one of the Active Traders Playbook, brought to you by TradeOutLoud.com and TimingResearch.com. Along with our co-sponsors, MadHedgeFundTrader.com, TradeThirsty.com, TradingIndicators.com, and BigTrends.com. So, yeah, so over 3 days, today, tomorrow, and Thursday, we're going to have up to 30 total sessions of trading education and from some of the top minds and top educators in the trading world. So, I've been working for several months on this event, and I'm really excited about it. A lot of good info. Um, a lot of our friends who come back for, most of our events are going to be on here, but a lot of new people, uh, new educators and people we haven't heard from in a while. So it'll be great to have them back. And yeah, we're going to get started with this recording from Adrian Mans. And then we'll be live at 11 a.m. with Serge Berger.
Be sitting here talking to you about what I think is going to.
Okay, live now. Or should be working now.
All right, welcome everybody. I'm Adrian Mans, and I am happy to be sitting here talking to you about what I think is going to be sort of the state of the art for 2026. Trading is very much the same and very, very different than it was a few years ago. But I think that the tools of the trade right now anyways are still the basic things that we've learned to work with over the years. Includes a lot of common sense, includes like a good deal of trader psychology, and includes techniques that go back hundreds of years. And I don't think that any of that is really lost in this world that's now just becoming about AI and when is AI going to do this and when's AI going to do that. And I think AI is a long way from delivering on the promises that it makes. And as long as people are relying on things like Chat GPT to just sort of spew ideas about what's on a chart, I think we're pretty safe as analytical thinkers to say, we can probably figure out better than it can what's coming next. So, what I want to talk about today are the tools that I use, the tools that I have used. I've been trading for a very long time, as those of you who know us know. My wife Julie and I are traders going back to the 1990s. So we've got a deep-rooted connection to the New York Stock Exchange. We had a deep-rooted connection to the psychology of floor trading, the psychology of individual trading, being an upstairs trader, being a floor trader, being a proprietary trader, being a private trader, being a hedge fund manager. It's all stuff that comes from a lot of different skills and a lot of different places in your own head. And I think that if you can get a grip on it and put yourself in position to profit from the market every day, you're going to be pretty happy with what you're doing. So I've written a lot of articles over the years that a lot of you are probably familiar with. I was featured in a couple of books about strategies, and everything that I've written has been very focused on trading strategy, because where we came from, the time that we came from, the 90s 2000s, were all about, people really didn't want to hear a whole lot about trading psychology. What they wanted to hear about was what can I do to make money in the market. And Julie and I are both psychologists, and one of the things that gave us a lot of pause was that there was this attitude among people that whatever it was that made money in the market, that was the only thing worth knowing, because you can always adapt your psychology. And that's really not true. So trader psychology has become a bigger and bigger part of what we do, bigger and bigger part of our business. And future articles and future books that you see from me will not be so focused on the strategy of trading as they were in the past. It'll be strategy and how that strategy is intercepted by your personal psychology, because your personal psychology is definitely going to be the biggest game changer in what you're doing in your trading business. We've trained an awful lot of people over the years, and our professional trader training, really comes with the guarantee that we're gonna teach you how to trade. We're gonna teach you how to earn a living trading if that's what you want to do, or we're gonna teach you how to supplement your income if that's what you want to do, and we're gonna work with you until you get there. And a lot of this relies then on strategic thinking. A lot of it relies on figuring out how strategies fit into your psychology, into your trading business. When I wrote Around the Horn, A Trader's Guide to Consistently Scoring in the Markets, that was the best-selling book on stock trading on Amazon for over a year. And it was all just pattern-based stuff where you're going through, the markets are cyclical, you can identify the different cycles that the market is in, and then based on that pattern cyclicality, you can go and figure out how to do these trades, these around the horn trades. That is still the backbone of what we do in terms of the trading mechanics. So between that and what later developed into this boot camp that we put together for traders, it's really a soup to nuts program of here's how you can take it all to the next level. Here's how you can become profitable and trade professionally, trade for a living. What we learned over the years was that we probably shouldn't have put so much emphasis on the things that people wanted to hear about and put a little bit more emphasis on the fact that as psychologists, what we know is I've got a PhD in organizational behavior and behavioral finance and an MBA in business and international business and finance. And I will tell you, the PhD in psychology is a lot handier when it comes to my own trading or with dealing with our clients than any of the mathematical knowledge or any of the business knowledge is ever going to be. And psychology is really the top tier product that you're going to have to put yourself in front of, and is your psychology. Because the the stuff that we've put together, the books, the boot camp, the things that we trade ourselves, we basically have, really there's seven strategies. There's seven very specific ways that we go about trading the markets, and those seven things all work with our psychology. We developed them, so it makes sense that we can do all seven things. When we take traders and train them, the whole point of the boot camp is to say, look, you're going to learn to think the way that we think about the markets in terms of what price is going to do, where the price behavior comes from, but know ahead of time, probably all seven of these things aren't going to be the way that you run your trading business just because we do. So, when you talk to boot camp alumni, or when you see what they're doing a couple of years down the road, what you find out is, yeah, they've sort of cherry picked things. They've gone and figured out what's important to them and what is what drives their success and what made things difficult for them. And sort of generally speaking, it's about knowing what your why is, and we'll get into that in a second. So we've got this show, Trader Nation, and this is really all about psychology. So it's not on TV anymore because we have moved much farther from Hollywood than we were. We're going to run this as an internet show. And if you have questions about trader psychology, it can be something as simple as saying, you know what, I tend to get out of positions too soon, or I have a hard time setting stops and following stops. I have a hard time with the discipline. I have, whatever it is, you can shoot us an email. So it's just Adrian@TraderInsight.com or Julie@TraderInsight.com. Be nice if you send us a little video clip, do it on your iPhone or your Android, and just send us a thing saying, this is what gives me trouble when I'm trading. And then let us know, what's your why? Why do you trade to begin with? So a lot of people want to do this for consistent income. They want some cash flow. They want to have the freedom that cash flow provides. Long-term wealth. People want to build capital. They want to support their future. They want to know that they don't need an everyday job anymore. They can rely on trading the markets to be the thing that funds their lifestyle. Lifestyle freedom. For Julie and me, this was the most important thing of all. So, we have Connor, our son, and we homeschooled him for the first, he's 18 now, if you guys can believe that, if you know him. We homeschooled him for the first 15 years of his life because we traveled non-stop. We were all over the world. We traded from wherever we landed. We stayed in other countries for months at a time. I would get speaking gigs for the London Stock Exchange, and we would stay in Chelsea for a month. And Connor, we have pictures of Connor every year for 4 or 5 years in Chelsea Park. We've been, anytime that we had the opportunity to go speak somewhere, we turned it in to a long-term stay, and we lived in neighborhoods, and we walked around in those neighborhoods and got to the grocery stores, got to the markets, got to know people. That's what was important to us. Lifestyle freedom. For other people, it's about personal mastery. They want to know that they can develop an elite skill. There's a very elite thing, trading. It's about having extreme discipline and having psychological strength. And if that's your thing, right, personal mastery, that's, out of the people we know, I would say that's at least a third of them. These are people who were very successful in business, very successful in whatever they did before. They could be doctors, lawyers, farmers, It could be we've had tool and die makers, we've had engineers, lots and lots of engineers worked with us. And for them, it's a matter of personal mastery. They just want to develop this skill because it's unlike anything they've ever done before, and it's hard. And that's why they want to do it. And yet for other people, it's family security, just to give stability and provide opportunity for the people you care about. And when you look at one of our boot camps, you go around those rooms and every one of those people brings a lot of psychology to the table when they're learning how to do this. And that psychology can be a strength, that psychology can be baggage. It can slow you down, it can speed you up. You have to be very flexible in your thinking, and you have to have this growth mindset that just says, I'm going to be able to do this new thing. I know that it's going to be hard. I know that I'm going to have to work on who I am, right? The things that are going on behind the curtain in order to succeed. And we work with 20 people a year, so we've got 20 people at each one of these boot camps, and it's pretty much a whole year. They do 40 or 60 hours of online training with a 650-page manual before they ever come to this thing. And then once we're there, it's 4 days in Miami Beach. We actually do it on the East Coast because that's a much better time zone than California. And we're there for 4 days. We're looking over their shoulders, and what we're seeing is all these people who learned the same stuff, all these very intelligent people. Like I'm looking at, I've got a cop in the back row who's a great friend of ours, and a food photographer, and just the people throughout that room, lawyers, physicians, dentists, pilot, another pilot, and engineers galore. I mean, they've all got these really good skill sets, and when you're looking over their shoulders, what you see first and foremost is the thing that's hanging them up. So we wrote this personality inventory that you're free to take. It is the Man's Trader Readiness Inventory, so it's MTRI. So you can just go to traderinsight.com/MTRI, and you can take the test, and when you're done, usually you learn something about yourself. Some of those guys in the room have told us they completed the 100 questions and it confirmed everything that they knew about who they are and where they're coming from. And other people have told us, you know what, I need a hug, because that's a difficult insight into my personality. One way or another, what these guys are a testament to is you can do it. This is not, when you hear people talk about the 90% of people fail in trading. 90% of people fail in trading because they're trying to become traders by watching YouTube videos. They're trying to become traders by watching things on TikTok, and they think that just because there's a lot of junk out there that they can grab hold of, they're going to be able to capitalize on that, and they're going to be able to become successful just by watching it, even though there's no personal touch going on, and that's not how this works, right? A mentor is still one of the most important things you can have in this game, and whether it's me or somebody else, just make sure it's someone whose psychology you can connect with. The notion that if it makes money, I can make it fit my psychology is one of the most dangerous thoughts that gets into people's heads when they want to trade. Because what happens is, no, you can't. You cannot make it fit your psychology. It has to be something that's a good fit to begin with, or at least a decent fit to begin with. Or what's going to happen is you're going to be a passive psychological failure. You're going to have the weight of this trading business is going to be on your shoulders every day of your life, and you're just going to feel like you can't do a damn thing right ever. If you take a profit, you're going to feel like it's a failure because you took the profit too soon. If you take a loss, you're going to feel like it's a failure because you shouldn't have been in the trade to begin with. If you approach this as, I'm just going to find something that works for somebody, and then that's what I'm going to do, you're going to have a big problem on your hands. Because even for us, the way that we've got our trading structured is so that we can compartmentalize things. And as I said, there's actually 7 different things that we do over the course of a day, but at its core, we had NYSE program trades, so trades that run on the NYSE. NYSE and NASDAQ are different animals. We've got NASDAQ program trades, right? The NYSE trades are the around the horn trades. The NASDAQ program trades, those are for something that I call XRV. That's an algorithm that goes through and finds trading opportunities tonight for tomorrow. All of these things are setting up ahead of time. The NYSE program trades, we set those up today for tomorrow. And we've got an opening gap reversion trade that we trade with the guys in the room in the morning. So that's a first hour trade. And we've got order flow trading. And all of this stuff fits us. It fits our psychology. And our guys are able to go through and find one thing, two things, three things, or sometimes all these things that work for them the way that they need something to work. But you know, what's important is that you can sit down with this and figure out what it is about the trading workflow that's going to make you successful. This is our workflow. This is the way that we structure things. We've got a pre-market thing that we do, a delta hedge that we set up on Apple on some big cap stocks, right? Apple is the primary recipient of that particular honor. We prep volatility bands in the pre-market. The trade that I'm going to show you today is a trade in Tesla that actually happened today. I recorded this on Monday for the Tuesday session. So you guys will see that. That was recorded live this morning. And then we know exactly over the course of the day what we're supposed to be doing at every time slot of the day, because that's important for me in terms of my psychology. So really, we enjoy the first hour trading more than anything else. I want to trade the opening bell, and then I live at the beach. I want to go sit on the beach. I want to enjoy my life. I want to enjoy my kid, and that's my why. I want to be able to travel. I want to be able to ski. I want to be able to do all the stuff that we love. We scuba dive, right? We go, you guys who know us know that we'll spend time out on a sailboat. We'll spend time in the water. We'll spend time on the ski slopes. But the important thing to us is that we have that time to spend. And this notion of being a 1 hour trader is the thing that gives us the flexibility to do this. You're going to see firsthand today how the early bird gets the worm, because the video that I recorded this morning of the market, so I was doing live commentary as the market was open, just like we do every day in our trading room. And I was talking through a trade in Tesla. You can trade, I know Tesla's expensive and some people freak out when they see that it's, you know, that we're trading this, $400 and something stock. You can also trade TSLL and do it for less than 30, but there's a million ways to do this business. And the most important thing is, again, that it fits your psychology. If what you want to do is trade the first hour, then what you need to know about the first hour, if that's what sounds fantastic to you, right? Oh my gosh, it'd be great to just trade 1 hour a day and, you know, get in front of the opportunity and be done. The first hour has different dynamics than the rest of the day. There's a liquidity surge right at the open. Overnight orders have to get cleared. There's price manipulation, some call it. I say it's just, you know, they're trying to sweep through some liquidity that isn't there. So they're trying to create liquidity by running some stops, and you get this big liquidity surge as a result. That's uncomfortable for some people to trade. Fast market, right? It's called a fast market, and it is a fast market. That tape gets really, really fast sometimes. You can see your computer, even the best computers in the world. We've got the best machines you can buy here, and you can see sometimes you've got enough charts open, you've got enough level 2 screens going, things start hanging up a little bit. But other people love it. They love the rush of trading that first hour. They love the open. The first 5-10 minutes of the day is fantastic. Gap psychology. We've got, you know, the opening gaps make for a whole different kind of trade. We've got 5-10 traders over the years who've worked with us who only trade the 2SD opening gaps. And you've seen me talk about those in other presentations. And that's what they came to boot camp to learn. That's what they walked away with. We kind of make them learn everything so they get the whole gist of the thing. But what they're doing for a living is a thing that can be done in the first 30 minutes of the market. And, Rick, if you're listening, Rick Kipp is one of our star graduates, loves trading those gaps. He likes to not have to think about the markets after the first 30 minutes of the day. That's not where he wants to be. He does not want to be focused on what's the chart going to do next. He wants to be focused on flying his plane. So you get the strong momentum in the first 30 to 45 minutes. It's going to peak right around that time, and you've got really definable risk and definable range. So people who are afraid of the opens, I get it. But for those of us who love it, it's because we're looking at the order flow, and the order flow it's the rhythm of the market, and it's what makes us feel like we can control the situation that we're in front of. We can figure out a way to capitalize on what's happening and just not get sucked into some sort of a whirlpool. We are very much riding the wave and working with the ebb and flow of the market. So we also trade after 11:30. Julie and I come back 11:30 Eastern time. We'll come back to the market and we take a look at what's going on in terms of a settled market, in terms of are things trading in the box, are things trading sideways? Do we see big liquidity pools? Those liquidity pools that you can spot on things like Bookmap will show you where price is going to get pulled. It's going to be a slower market. You're not going to see opportunities for profit as quickly. You'll see that in the video of this morning's trades, but you get a real steady sort of reveal of what's going on in terms of market volatility and market direction. One of the tools that I use, and you're going to see me use in the video, is Bookmap. And if you've seen this before, if you've used it, then you know what you're looking at. A lot of people have sort of tinkered with it and either adopted it or passed on it. But this is a very useful tool in visualizing where price is going. If you want to think of this as, somebody asked me, is this level 3? It's not really level 3, but it is a different way of representing data than level 2 in a normal dome. It is a very, very robust system of providing liquidity. So if you're looking at the information about the liquidity here above a market, in this case, up there at 422, you see there's a heavy pocket of liquidity. That's a passive seller. That's a limit order that's sitting at about $422, and you can see that it's tens of thousands of shares are sitting there. And if you look below the market at 417, same thing down there, those red liquidity zones. What that's telling you is price is going to gravitate to those areas over the course of the day. You're going to see price move to these pockets of liquidity. That's what trading's all about, is order flow. That order is going to move into the liquidity pockets. And what our job is to use tools like the ones that I'll show you in a minute here, intraday, to say, do I have something that is there natural support and resistance that's also at that level? Is there a Fibonacci retracement zone at that level? Do I have volatility bands that correspond to these levels? Because over the course of the session, what you're going to see is price sweep into those levels. A lot of times it's programs that are pushing, algos are pushing things there. Other times it's traders who are looking at the book and trying to figure out if they can sweep some stops. There's order flow to be had, and order flow is, I think, one of the keys. If you can understand how to trade order flow, it's one of the keys to becoming successful as a trader. So this stuff is a little bit better represented than I think it's going to be in the video, a little bit easier to read because it was later in the day. This early morning trade in Tesla today, the liquidity got kind of thick. You're going to see that on the video. But I think that once the video is over and done, you should have a pretty good feel for what it is that gives us an edge in trading and why we've been successful in this business for going 30 years now, Julie and I. So A lot of people like to say 60 years combined. I'm just going to keep it at 30 because 60 years makes me feel even older than I already feel. But let me pop over to the recording from this morning. So again, what I did was I recorded during the live market. I recorded what I was doing, and then in the after hours, I recorded this portion so that we could run this webinar in the morning. All right, let's have a look. This particular trade is in Tesla. And what we're looking at here is the market's going to open in a few minutes. And Tesla has been in the news, got some changes coming, and there's a trade that I like to do in this stock pretty much every day, which is I like to bound up the open before it opens, right, in the pre-market. And it's going to be a wild ride, but I like to look for a break of this pre-market range that's supported by what's going on in terms of liquidity in this chart and also liquidity on the bookmap chart. So bookmap is a tool that I use to gauge the order flow. I'll pop that up here so that you can see that as well. And, going into the open, what we see on our bookmap data is that it's, there's not a whole lot of volume that's really supporting this thing underneath. We've really only got 2,300 shares down at 422. And, it's already trading through there. We're at 420.95 now. And, going into the open, it's got a very easy shot down below this 420 level if it can break it. So there's about 14,000 shares sitting right there at 420. If we can get through those, then I think this has a really good shot at just careening lower. So what I'm going to do is I'm going to set up my first trade of the morning down below. It's testing that 420.11 level right now. So I'm going to set up my first trade of the morning. I'm doing a short sale at that 420.11 threshold if we break it once the market opens. And then I'm going to look for support down below, probably into daily data going back a few days, going back longer than a few days, actually, going back on a weekly chart, a monthly chart. You want to go and dig in as much as you can. And also, as you see down on the bookmap data, it looks like there's room down into the teens for Tesla on this opening bell. So I keep tinkering with this. I keep setting the parameters a little bit further away, right? We just want to keep capturing what's going on in the pre-market. Where is that pre-market inflection? And this, as you can tell, the psychology of this is going to be pretty intense because you're making the first trade of the day. And a lot of people think, they've heard this thing of the amateurs open the market and the pros close it. Well, that's not true. It's just about you need to know what to do when you're opening the market. And in this case, we're going to have a stop limit order down at 419.81 stop right now, with a limit down around 419.60. It's Tesla, right? These spreads are going to get a little bit wider as I'm looking at the bookmap data and I'm looking at what's happening here on the 5-minute chart going into the open. Everything points toward it's probably going to be a breakdown and it's probably going to have some room to run. So let's see what happens when we get that opening bell. All right, here's the open. We're coming down from above, so it did get back up into that 420.95 if you manage to move your order. Boop, there we go. 419.81 fills, and we are off to the races. But if you got it at 420.95 on the pullback, that's a really good entry. So, getting it from that early tick is also a great way to position into this stock right now. Still looking for the move down. We've got room, I think, down into 416, it looks like, at about, about 18,000 or 15,000 shares sitting down there. And we're coming into that pretty quick. Let's see if we can get down there. If there's an extension, we'd be looking for 415. But what we're doing here with our chart data and with the bookmap data is assessing the liquidity. So when you're looking at this stuff on the bookmap here, these big red balloons here, these red spheres, are all market orders. And what Bookmap really tells you is where are the limit orders. So these levels below are orders to buy. These are limit orders that are sitting in the market. So we know there's X thousand shares sitting at 415, X thousand shares sitting at 414.50. There's, the whole way down. Right now, what we're trying to gauge is it going to bounce off of one of those levels? And is that inflection going to pop the stock back up again? And if it is, that's where I'm going to pull the plug on the trade. So you want to give this some room to run, especially on a Monday morning, right? There's another thing about Tesla. It's got a different psychology than a lot of the other stuff that we trade. A lot of our other Magnificent Seven stocks, whether it's Apple, Amazon, Google, Meta, Micro, all that stuff is kind of off the table on a Monday because it gets a little hairy around the opens. Tesla has some pent-up energy usually on a Monday, and that pent-up energy winds up making for some pretty darn good trades if you can stay on the right side of these things. As it's popping higher here, you see this is already the place that you're thinking about what's going on, right? Where is the threshold for a reversal? And I'm still relying then on this Bookmap data and just looking for, if it gets into this really thick area down here, this is where I think you could have an inflection that actually means something, pops the stock higher, and makes for a good place to cut this off. But right now, I think we've got a pretty clean shot down at 415, maybe even 414. But this is the thinking that you have to do on the fly when you're trading something like Tesla and you're looking at an opening move. And now the question for you in terms of psychology is, right, how comfortable am I making these kind of decisions while the market's open, while the market's moving? This is very different than some of the other plan trades, for example, that you learn about at boot camp. Everybody learns the whole theory. There's just a lot of the around the horn stuff. Is all about market cyclicality and how markets behave and how you can go through and bound up volatility and figure out where the volatility is going to impact price and how the price directionality is going to be influenced by natural support and resistance and some of the chart patterns that we focus on. But the reality is it permeates every one of the 7 different types of strategies that we focus on. But each one of those strategies, as I said, have a very different psychology. The pre-program a trade, set it and forget it, is very different than what we're doing here. Especially, we're trying to talk through this trade as we're doing it, and even that affects your judgment. Talking about what you've got going on in front of you as we're coming down. It's not looking like this 414 level is probably going to be something that gets hit based on the buy side liquidity that's popping up on the Bookmap, but we'll see what's going to happen. But in the interim, what you need to be doing here is managing the trade. So if you've got a bracket order out on this, you had an entry, a stop, and a target, and you can keep moving the target away. So at this point, you can adjust your bracket, right? In this case, I'm trading this on Realtick, so I can adjust the bracket on chart. I can adjust the bracket on the level 2 screen, which is a little bit easier. And you just pull the target away, and then you're pulling the stop loss in behind it. But what you have to know is the target is a limit order, which would fill at a limit price, and the stop is a market order. And on Tesla, when it starts popping higher, it's probably going to slip you. And that's one of these things that puts a lot of people into this coulda, woulda, shoulda mentality where they're, oh my God, I could have had, let's say this winds up down at 412, and then we're pulling in our stop order behind it and 412 trigger, and we wind up out at 413.50 or something. Something crazy can happen if it starts popping. You can just get run over. And does that put you then in the position of being upset about the trade instead of patting yourself on the back for putting together a plan in the pre-market and actually getting out of the position on time? So here, 416. This is as good as place as any to close this position out on this inflection. So as far as I'm concerned, once you get down as low as we did, and now we're getting this reversal move, it's time to cut this one off and look for entry opportunities, re-entry opportunities on retracements that get us back higher up into this wide range bar that we've made on the open. So far today, you've gone through and bracketed up the morning volatility. You've found the precise inflection points where a violation, if it cracks down through it, your anticipation is you've got a really good opportunity for a short sale. And by the way, we would have looked at the top of the range too, at the 424.04. I would have definitely looked at, especially given that order flow, that liquidity that we see on the chart here, we would have definitely looked at the long side on this as well. The tell here about what was going to happen after the open, about this first move that we were going to see, was in the ricochet down through that 422.11 level, right where it comes down, and that first or that last bar before the opening bell, it goes, finds that support from earlier in the session, comes back up, stops right at the 420.95 level, and then we see this reversal lower. So this is all about order flow at this point. This is all about anticipating the anticipators. Where is price going to go? So at this point now we are out. And now it's time to wait for the next opportunity. And let's see if there's another trade to be had in Tesla in the first hour of the day. Now, mind you, at this point, you're barely into the market. And as I said in a previous seminar that we did here, or webinar that we did here, we trade primarily the first hour, and then we take a break. And then we come back and we set up some other trades as the day goes on. But a lot of our guys, a good chunk of our guys, they only trade the first hour period. They don't look to trade anything else. So you can see there, I just put this fib study on the screen, and what we see is a 382 retracement on the chart of that first move. I use fibs a lot. I use the fib studies in conjunction, again, with the bookmap data. I like to see what is the overlap between my fib level there at 417.87 and what's going on the bookmap data. And you can see here that there was liquidity right at that level earlier, and that this is a spot that we've had an inflection already. So maybe this is going to be a good place to look for another move that can generate a profit. Now in this case, now again, right, your psychology has to shift. Now what are you thinking? Now you've got a lot of liquidity on the map, and you've got a much slower moving Tesla on the chart. And what you have to put together in terms of expectancy is, if I get a 417.87 entry, if I'm going to go straight in from that 382 fib level, what I personally do is set up a 1-by-1 bracket. So I've got a dollar by a dollar, a $1 profit objective and a $1 stop. So on the short sale from 417.87, if you guys are in the room and hear us talking about these in the morning, I'm putting on a 1-by-1 bracket, and I'm looking for a move from 417.87 to the short side, and I want to see if I can get another pop down into the range. If it takes me out at 416.87, I'm not going to feel bad about a move down to 414.62 because I missed it. And what I'm definitely not going to do is get back in the middle of the range here. The protection that this data is giving us is to say, if we get a reversal from 417.87 that moves us lower, then we're very likely to be able to peel a dollar worth of range out of it, just based on the book map and based on what's going on the chart here. The tick value and everything is pretty high this morning, but I don't want to get in at 416.64 and look for a move back down to 414.62 because I missed a trade or something. The safety for my psychology is, if I get in at 417.87 and it goes and makes a move beyond 417.87, I've got a $1 stop there, and that $1 stop is right above the 50% retracement level. So I can pull that up a little bit so that it's not exactly at 418.87, or I can pull it under this volume by price node here if I want, or I can say if it gets up above 417.87 and gets to 418.87, I'm going to double the position and get in there again, because 418.87 is the 50% retracement. I get an average price that's a little bit higher than the initial fill was. But if it goes and breaks the 50% retracement, I'm going to get out at maybe 419.20. I'm definitely not going to 419.87, because that's where the whole thing starts falling apart on me. But for now, when I put a 1x1 bracket out, typically my psychology is I don't care if 418.87 might be the next entry. If 417.87 doesn't work, I'm going to get out of the position. I'm just going to get out and reevaluate. Is there another entry at the higher mark? So right now you see it, it's gone. It's hit the profit objective on the fib retracement, and now it's a matter of waiting to see what's Tesla going to do next. I've redrawn the fib study here a little bit, right? This is not rocket science, the fibs. They're going to be off a little bit, but this is an infield fly setup, and our short sale trigger is going to be right at the low of that bar. So it left that tail to the upside, and now we've got a violation of the low, and a pretty simple trade. So this is one of the key patterns, one of the core patterns in what I teach people to do. We're looking for a retracement move, looking for this move that I call a switch hitter. Comes back up, gets us into this deep retracement. We're right at support and resistance. And now what we're looking for is the violation of that low. And there's going to be some bleed back into this bar. And again, this is where you have to say, what's my psychology say about this whole thing? Do I have the courage to follow through on what I think is going to happen here, or does this make me so uncomfortable that I'm going to be a wreck until I'm out of this trade, win, lose, or draw? Am I looking for an exit at break even right away? Am I looking for just a way out of the trade? But the reality here is we've got a pretty solid spot, right in here that makes for a decent first target on this. It's moving down into a place that we've got some confluence of price. We had, opens, closes, highs, lows, all that stuff just bumping up against each other there. And we have this volume by price node out here. So this is a hierarchical cluster analysis, really, of what's going on in volume. Kind of gives you a feel the same sort of way as the bookmap data does. Bookmap shows you all of this stuff on the dome here, on the current order book and the session volume at each price level. And what this is showing us is if we get through a threshold level, we've got a really good opportunity at hitting 417.94, which is going to get us back down into this retracement level. It's going to get us back down into these lows that we bounced off of earlier, and it's going to put us in front of just a really good take our profit and know why we took our profit, as opposed to we're trying to guess what's going to happen next. This is how I like to do discretionary trading. So the guys who are in the room with us, and you guys can all, if you'd like to join us in the room, it's just to go to traderinsight.com/trade. And that was forever an alumni-only room, and we are now opening it up to a wider audience and hopefully some future alumni of the boot camp, people who see what we're doing and like it and want to be part of it. I think it's a good place to get your feet wet. A lot of people sign up for the thing and then never wind up even looking at the room or the trading plans. So I'm going to encourage you, if you sign up for it, get there and take a look at this with us in the mornings and see what you think. See if you think it fits your psychology. It's not a hyperactive room. It's not some place that there's 5,000 trades being called. You're free to ask questions. I'm happy to go over charts and things and look at what's going on in the markets. But it's all about, you need to show up. So if you go to the link and you fill it out, I would encourage you add a phone number. We're not going to bother you. It's just a phone number that you can get a text message at, and then you'll get a text message telling you that you've been subscribed to the room, and here's how you can get in there and take advantage of what's going on, because a lot of people don't get emails. So emails get buried, they get lost in spam, they get lost in promotions folders and all that stuff. And we've had just a ton of people tell us that they wanted to join us in the room, and then they couldn't get in there because they never found the email. So that's why it's going to ask you for a text phone number as well. But here you see it's playing out, doing what we expected it to do, and it's one of my favorite things to trade, and it is really supported by a lot of the tools that I like to use. Again, in the coming year, I will lean heavily on the fib tools. I'm going to lean heavily on all of the around the horn stuff, all the stuff that we do at the boot camp. And I definitely like having the order book open and looking at what's going on the book map and figuring out, where do I think price is going based on the liquidity profile of what's going on in the markets. So that is it for our second trade of the day. Let's see what happens next. Moving forward, we see the extension down below our initial target was definitely not much, and the retraces have brought us back up into this 419.77 level, this low of this infield fly bar, and the retests have given us a move lower back down into 417.77. So the next trade on my book is a 419.77 short sale here, and we're looking for a move. In this case, I'm going to set it up as a 1x1 bracket with a 50% exit at 418.77 and a 50% exit at 417.77. So you can do this. You can set up your trade so that if you have, it doesn't matter how many shares you trade. If you're trading 100 shares, you can say, get me in at 419.77. That's my short sale. Get me out of half of it at 418.77. Get me out of the other half at 417.77. Lets you lock in a little bit more of your profitability if things go against you. Right? So if we wind up here moving back up above 419.77, hit 420.77 on the bracket, it would take us out of the trade. But if it goes down and makes it through 418.77, what we're counting on is this slow drift down into this lower retracement, into the 38.2% retracement, is going to get us, a shift that lets us book a little bit of an extra profit. So as the morning goes on, this gets more and more logical. And the first hour trading stuff, this is where you really have to do a lot of thinking on the fly. When we come back from our break after the first hour, then typically what we're doing is we're really boxing up the market. And that's where you'll see on those live stream strategy sessions that pretty much what I talk about in the live streams is, all right, here's how Tesla's been trading, or here's how the Qs have been trading, or here's how, the spiders or Google or Amazon or whatever it is that's behaving for the day has been trading. And here's how we can box it up. And here's what we're expecting in terms of price activity. So you got, in this case, down from 419.77 to 418.77. You booked a profit on the first one. It's entirely possible now that the other half of the trade is going to wind up at 420.77, and the net for the trade, it's just going to get wiped out. It's going to be a zero. But we had the opportunity to catch both legs. If it doesn't go, we're just content to say we planned the trade, we traded the plan. If it does go and it comes back up into this higher level band, I will not be taking another entry. And that's because of something that just sticks in my head called the rule of three. And that's when you get these repeated tests of a level, it becomes more and more likely that price is going to be able to move through the level and go and test the next higher level. So If it gets up into the next part of the range, then the next place that I would be looking for a short would be up at 422.11, up at the pivot line there, up at the support line. And if it gets to 422.11, what we would want to do is go over and take a look at the bookmap data and see, is it stacking up there? Are there orders that stack up as price gets there? If there are, that's sell side liquidity. That's a group of limit orders that are sitting there. And that gives us that much more confidence when we put an order out there. We put our own order out that says we've got a 422.11 short that we want to do. It's a limit. Same thing, it'd be probably a 1-by-1 limit. And when price gets there, it was a logical reason for exploring the trade. We looked at the liquidity profile. We looked at what's going on above the market. We know we've got a heck of a lot of stuff to get through at 421. Between 421 and 421.50, there's been a lot of liquidity in the morning, and you would expect that based on 402,000 shares traded there, that we've got a really high likelihood that a seller is going to pop back in there again and push price lower. But if we get through it and we move higher, 422.11 would be the next place that I'd be looking for a short sale on this one. And here you've got the whole thing soup to nuts. It's played out pretty much the way that we suggested it could play out. So it didn't get to the second profit objective. It didn't get down low enough when we were in this trading range earlier. So we had a 50% of the position that went to the profit, 50% that went to the stop. That trade was a net zero, and then we had to move up into that pivot line just the way we thought it was going to happen. 422.11, got that inflection up there, short sale, and then where do you put your target? Where are you going to look for a potentially big pivot inflection to take you? And it's right down here, the volume weighted average price. So this is session volume weighted average price. It's another one of my favorite tools. So now we've got a few tools here that are on your radar as long as you're trying to follow along with sort of this style of trading. Intraday discretionary stuff, the volume weighted average price, the anchored volume weighted average price, the information from the book map, natural support and resistance, and those Fibonacci retracement levels. Those are things that just all factor into how the sausage is made around here. It's exactly what we look at. It's what we try to factor into our decision making. And by the end of the day, what looks like a confusing mess from the outside looking in looks pretty understandable and pretty regimented and pretty disciplined when you've got this backdrop of, I know my tools, I know how the tools fit my psychology, I know my trades, I know how my trades fit my psychology, and life isn't about making everything fit into trading. Trading should be something that caters to how it can fit into your life. So the more comfortable you are with all this stuff, the easier it is to earn a living doing it, the easier it is to make money doing it. You have to figure out what your why is. Do you like to go skiing with your kid? That's a big part of our life. We like to spend a whole month on the slopes, and this is something that allows us to do that. We like to travel. This is something that allows us to travel almost constantly. So we've had a lot of family time, and it's all because we have this very detailed trading plan that we can put together for ourselves, even though there's discretionary stuff involved with it. We have a system we can use when we're at home and we can be in front of the computer 6.5 hours of the day. We have a system that we use when we're traveling or don't want to sit in front of a computer all day. And really the bottom line is everyone needs to figure out a way to make this serve them. It has to serve you. It's not the other way around. You can't become an indentured servant to your trading business. You need to be somebody who's got the courage of their convictions and the freedom to go and live life. That's what this is all about. All right, that's it. Easy peasy, right? Maybe. I hope it makes things easier for you to understand, or easier for you to think about in terms of the psychology behind some of these trades. That's just one of the things that we do. Like I said, we've got lots and lots of people who go to the boot camp or who've worked with us over the years who prefer a much slower decision-making process. They want to go and trade those around the horn trades. They want to put the stuff out there, set it and forget it. It's
All right. So for those of you who missed my introduction, normally or Adrian would have recorded that live or recorded that for us last night, but he had some technical issues, so that was an earlier recent recording from Adrian Mans of TraderInsight.com. But next up is Serge Berger live here with us. And Serge, are you there?
David, how are you?
I'm good. How have you been?
I'm pretty good. I'm here,
All right.
live and kicking.
Yeah. Um, okay. Anka, if you can hear me, go ahead and record to your computer as a backup. But Serge, you should be able to share your screen
Yeah,
and we
let
can
me do
get
that here.
started with your session.
Yeah, 1 second. Let me see where we're at. Yeah, let me know if you can see this.
It's loading and yeah, looks good.
Perfect. Cool.
All right.
All right.
Um,
Well, thank you, David. I appreciate it.
Sorry, hold on just a second. Okay. Are you ready to start now?
I'm ready to go.
Okay. I'm going to start my recording again in just a second, and then you can start your presentation. And just a reminder for everyone, I'm recording each session individually. Those archives will be available. I'm also live streaming to YouTube, so it's being archived instantly to YouTube. If you have to leave the Zoom room for any reason, you can still, join us on YouTube, and then the full archives will be available after the event. So, all right, Serge, I'm going to start my recording again. I'm recording again now.
Perfect. Well, thank you, David. I appreciate it. Always good to be here with everyone. I might turn the camera off largely just because it distracts myself. But just so you guys know, we're here live. I'm going to go through one very specific opportunity here today. Um, this is purely research based. I'm not obviously allowed to give you recommendations, so we'll go through that in just a second as well. But we're going to look at a very specific opportunity that has already been playing out. We've got a portfolio that tracks this. It's up 102% year to date. I think last year, I've got the numbers for you guys in a second. It did very well as well. So let me show you guys what this looks like. Now, again, just for risk disclaimer purposes, as I just mentioned, it is important to point this out. And trading and investing does carry a lot of risks. So I think it's very important to understand that and embrace that. So I would always encourage people to take this very serious. This is not meant to be a game. It's not meant to be entertainment. And also, again, everything I'm going to talk about here today is purely educational, no advice given here in any shape or form. We are first going to do a few true or false questions. We're going to start with those in just a couple of minutes. But I want to actually start off with just quickly highlighting what the opportunity is and kind of what it's been doing so far, and so you can get your head around it before we get started. First of all, this opportunity is already happening. It's no longer an if it will happen. It's a when, and the when is now. Um, I think it has the potential to be really the ultimate 10x move, potentially of the decade. Obviously, we'll only find out in hindsight, but it really has an incredible asymmetrical setup. And so I'd like to go through all of that here with you guys here in a minute. In terms of the way I look at an opportunity like this, I typically like to look for, I mean, as many as possible. But I think having more than a couple a year of these types of setups is difficult because it becomes difficult to track. But in general, what I'm looking for here is a what I call a 10x return. And just for me personally, the way I look at something like this is if I were to invest, let's say $2,000 in something like this, I'd want to have a good chance of making, let's say $20,000. If I were to invest, let's say $4,000, I'd want to have a good chance of making $40,000. And with $10,000 investment, I'd want to have a good chance of making 100,000. So 10x, right? That's kind of what that means. Now, to give you a bit of perspective, and again, none of this is meant to be any guarantees or anything. It's just factually what we've did. So, for example, in last year, as we started doing being active in this opportunity set, we in 2025 racked up gains on those mock portfolio gains of 225%. You can see each trade and how it accumulated over the course of time last year. So I can now say that this mock portfolio returned, by calculating it that way, 225% on the underlying. That's not using any leverage. In other words, if this would have been done with options, it would have been 3, 4x, whatever, this, depending how aggressive an option one would have used. In 2026 so far, and actually I've got an updated slide on this on the next one, but up until a couple of weeks ago, this mock portfolio was up 84%. The S&P at that point was still down. Now S&P is now up on the year. The latest numbers are 102%. So we just closed the trade the other day. So the mock portfolio here, using this opportunity set, is up 102%. This is not hypothetical in the sense that it's not something we just randomly invented. These are actual trades that are being sent and opening and closing things that we sent to our clients as well. So this is not it's real in that in the way we track it. What I'm going to show you guys today is essentially one of multiple markets. It says 5 markets here. I think at this point, because the opportunity set has expanded since I made this slide, it's probably closer to 10 to 15 different tickers, if you will, that are the opportunity set, maybe more. One doesn't have to do all of them, of course. But I'm going to show you guys one specific one today that is sort of at the core of the research. And I think that'll give you a really good idea of what this is all about. So my warning, and I'm going to mention this several times, and I think this is an important warning, so I would encourage you to heed this call. Do not just take that one market I'm going to teach you or talk about right now and just go ahead and buy it and say, oh, if this is the ticker, got it, I'm going to buy it, wham, bam, thank you, man, and leave. It's not going to do you much good because you need the proper perspective and the proper plan in order to do this. Okay, so you'll hear me say this a few more times here today. Now, a couple of true or false questions. We're going to go through them pretty quickly. And we found this to be very helpful for people to kind of get the right mindset around this. True or false? The easiest way to build wealth in the stock market is to get in early on the right opportunities. I don't know how many people in here think that's true or false, but I generally tend to think that is true, right? So I think history has proven over the course of time that those who spotted new and untapped trends before the masses have over time had really great tailwinds, and to some extent life-changing fortunes were built. If you think about some of the great trends that have happened, be that individual stocks like an Nvidia or other opportunities, even just gold for the past 2 years, right? So we're going to go over what I consider the next big wave that's unfolding here literally right now. We'll talk about this shortly. True or false? Most investors recognize these massive opportunities before they actually take off. So how many people think that most people actually recognize these opportunities before they even take off, right? That's the next question. I tend to think that's false. I think the biggest wealth building moments in history over the course of time, be that tech of any types, shape or form, cars, Bitcoin, were largely ignored by the majority. And even if they were aware of it, they didn't really ride those trends. Next question, investing in a volatile market is just gambling with your money. Let's just skip this one to the interest of time. But the biggest opportunities in the AI revolution, is going to be AI itself. I think that's a pretty critical question. For me, that's probably a false with one caveat, but I think it's a false because AI does get a lot of attention and there's certainly the profit potential there. But I think the biggest opportunities are going to come from companies providing essentially the components and resources that make AI possible. And so keep that in mind. Last but not least, true or false, the world in 10 years is going to be dramatically different than it is today. I think many of us would probably agree that is 100% true, at least in our view, which is exactly what we're going to talk about here today. Now, what are we going to talk about? We're going to talk about the state of AI, where it is right now, and why this probably matters to you and your money. We're going to look at what's powering the future of AI and why that's actually good news. And then we're going to tap into the opportunity here that we really think is the big one before many people are still really trying to catch on. My promise here is I'm going to show you what I think is something that a lot of people are still not talking about. And even if they're talking about it, they're not actually allocating to it. My hope is that it excites you enough so that you'll join us to capitalize on this opportunity together. And if that's the case, I do have a special deal for the early takers here as well. So what I'm going to show you guys here right now in a second is essentially backed by now, it says 25, it's actually more like 26 plus years in the markets now, a lot of deep research and tech-driven insights that have revealed plenty of times where things have truly headed next with some big opportunities. I'm not here to tell you that every single idea we have is going to nail it. That's not true, and no one does that. Trust me, if we've got plenty of things wrong, this one here is a big idea that we think has a lot of potential. Who am I? Well, I've done this for quite a long time, and I've been fortunate enough to be able to trade and invest through various different cycles, be that the dot-com bubble, the great financial crisis in 08, 09. COVID to some extent was something as well, but a bit shorter lived. We're proud to count. It says 4,800. It's closer to probably 7,000 at this point. People and counting that have trusted us in our process, and so we're very proud of that, and we will continue to do that. Now, where does AI stand at the moment, and why does this matter to you? I think is the real big question. Well, over the past few years, we have seen, since the introduction of large language models like ChatGPT, we have seen AI revolutionize many industries. That spans from healthcare to education, all sorts of businesses, and even art. And if you remember, back in the early days of the internet, let's call it circa mid-1990s, I remember crafting my first email address. It was a Yahoo email address. And we kind of think that's where AI is now. I remember a lot of clunky forums that looked good at the time, few websites, relatively speaking. And so we think this is where AI is. It's still in its infancy, basically, is what I'm trying to tell you. AI remains in its early stages, albeit it's progressing at an increasing, an amazing clip. I mean, just the rate of change is unbelievable. But I think there is one important thing we need to understand about this. And this gentleman here is the CEO of NVIDIA. It's Jensen Huang. And he said this last year. He said the year before, almost everyone got it wrong, meaning that the computational requirement for AI is actually 100 times more than we thought we needed. I don't know where he's at right now on this. Maybe it's even more. I don't know. But that's what he said then. And I think it's certainly coming true if you see the amount of data centers that are being built out. And essentially the conclusion he drew, and to me, this made a lot of sense. He said that, I'm going to quote it for a minute, every single data center will be power limited. And you can essentially calculate your revenues by how much power you get, right? So in other words, and I'm going to get right to the point here, as he says, AI is becoming a lot smarter. We see this, we notice every single day the models get better every week, and it means it needs a lot more computing power, right? But we have to build that computing power, and that, by those estimates at the time, was close to $1 trillion in the next few years. Now, if you trace this all the way back to the origin of what's actually needed to get more computing power, we actually need more infrastructure, right? And new infrastructure requires things like materials. We already know that we're power limited. You look at the energy cost in various cities. I was just listening to the governor of Florida today, or yesterday, I think it was, talk about the concern that he has with AI data centers being anywhere near, basically towns and stuff, where it's going to skyrocket the price of energy, which is already happening in some places around the country and other places in the world. And so I think the conclusion we can safely draw, at least in our view, is that if the next wave of AI needs more energy, which seems to be the I think everyone can agree with that, and Jensen Huang seems to agree with that. He's CEO of NVIDIA. Um, we're going to need more infrastructure to support this, and I think it's clear we need to invest, or we can invest in stuff that makes this actually possible. It's nice to know that there's AI. If AI can't make it itself happen because we have not enough energy for it, the technology is really not that helpful, right? So I think without energy and infrastructure, there's really no progress. And that's a really critical point I want to make. So uh, I will ask you, who else wants to get paid by being at the front of the line of this new revolution? I certainly want to be, and that's exactly why we're doing what we're doing. Okay? So where are we today? Well, I think today specifically, and I don't mean like today, X day of the week, but in general, we've seen a whole bunch of these chart chasing, as I call them, AI trades already blow up in a lot of people's faces. Not because AI doesn't have a future, I certainly think it does, but because the money is rotating into other parts of the AI trade, which is now really focused more on the infrastructure. What do we actually need in order to make AI, reach its, at least to some extent, its full potential? You look at things like the IGV ETF, it's rebounded since I've taken this chart, but in general, that classic AI trade has gotten more and more difficult to sustain itself. Stocks like this one here, continuously having these really meaningful drawdowns of 70%. And I think this latest one here is actually now, was at the time, at least when I took this chart, 60%. I'm sure it's rebounded. And then even NVIDIA, right? It's now, I think, at the upper end, very, very upper end of this range. It might even have attempted a marginal breakout, I think. No, it actually hasn't. It hasn't broken out, but it's at the very upper end of this range. The point is NVIDIA hasn't really made any progress. It's a great company, smart people, but the money is rotating into other parts of the market. And that's really what's going on here. So I think in general, if you look at this through the lens of sort of the Max 7 trade, you can see that the Max 7 trade, although it is working still, it has badly lagged, and this chart is a little bit out of date, but the trajectory still is there. For the most part, the Max 7 trade is still very much lagging other parts of the market, like materials and energy, which we're going to get to here in just a second. Okay, but I think for us, if we look at the market, particularly the S&P 500, we think we're probably limited to maybe like a 5% move per year for the next maybe 5 to 10 years. And so I think making money just being long the S&P 500 is going to be very difficult going forward. The S&P has a tremendous amount of great companies in it, but we are very, very market cap concentrated. That has traditionally not been as severe as now. In fact, nowhere near as severe. And so we do think we're getting crowded here. Someone's asking, it is very crowded. The question is, what's the AI trade? The AI trade was Max 7 and stuff. What we're talking about here today is actually part of the AI trade, but not AI itself. So let's talk about it. Okay, now just quickly expanding on the S&P so you can kind of see what's going on here. Again, you can see largely the returns for the S&P 500 over the past, at least a decade at this point. It's been more than that even, has largely been driven by technology. That's this green line at the top. We're at a point right now where, as much as if you look at S&P once again here right now today, obviously fresh all-time highs. Why not? The market's open, so you go up. It's largely probably not going to sustain itself at this certainly not at this rate. The S&P since the 70s has essentially, even since the 50s, has essentially had this like 14-year cycle, 15-year cycle-ish, where it goes up for 14, 15 years and then goes sideways for roughly that sort of time span. And we think we're probably at that point again right now. I'm not saying that we're at that point right now today, but within maybe a couple of quarters, maybe even a few months. Hell, we could be at the top today. I don't know, right? We'll find out only in hindsight. But we're pretty close. If you look at a 100-year chart of the S&P 500, we're at the very upper end range of that. In fact, we're blowing a little bit out on top of it, which is classically what you'd see at this juncture in the cycle as well. So that's just price. You can look at market cap concentration. Again, it's largely focused on a few stocks. And that is ultimately a bit risky. multiple wise, if you look at the S&P 500's forward multiple, I think we're trading at a 22, 23 times 2026 multiple. That's a PE. And that's not cheap. It's not the end of the world expensive, but it's not cheap. So let's talk about our 10x opportunity. Now, when we talk about a 10x opportunity, for me, it's kind of I break it down to the very simple thing. If everyone's on one side of the boat, it's typically time to start looking elsewhere to make money. It comes down to one very specific chart, and I'm going to give you this ticker or what this is here shortly. But for the most part, I think when we look at AI, we need to understand that there are a lot of fast-moving algo chasing kind of trades to be had, but they tend to mean revert. And if we want to ride what I would consider to be more sustainable trends, we probably need to look at stuff that actually powers all of this. And so this is a hell of a bullish chart. If you've ever looked at a chart before, you might label this as a cup and handle chart. Again, I'll go through the ticker symbol here in a minute. But in general, I think this is a very bullish chart. And the theme that this all falls under essentially is, if you want to talk about this from an equity perspective, is the materials and energy sector as a thematic. There are multiple ETFs and a plethora of stocks that are part of this 10x strategy. And I'm going to cover one of them right now, as I said earlier. And that one of them here is copper. Now, copper can be invested in through ETFs, through the futures, through options, of course, through individual stocks. There's a whole bunch of ways of doing so. But I think the main point I'd like to start off with copper right now is there's a glaringly obvious what we call a supply and demand imbalance. And so essentially when you look at copper where it is right now, or ish right now, the demand is going to continue to be steady, which is sort of the primary demand here that you see on this line. But the supply is essentially slowly going to be going down. So and that's, you can see we're more or less right at this juncture right now. So that is a very crucial thing to look at. The asymmetrical setup that we're seeing here right now is such that we have very, very small risk versus the reward, which basically means that given the type of sort of reward to risk dynamic, what we think the reward is so much bigger than the potential risk. There's always a risk in everything, right? But I think the potential reward versus the risk is just completely lopsided. Probably the best way to show you all this is if you subtract the current copper supply minus the demand, you get a negative number, and you can see that negative number from here on forward, if these assumptions are correct, is only going to get worse. In other words, what this means is that there is only more demand and basically, relatively speaking, less supply. That supply and demand imbalance or dynamic is something that is in addition. So this is just copper itself, right? But that's in addition to just the demand we have general for energy. So not only is there a supply and demand imbalance, it's forcing copper into a situation where you could literally see price shocks to the upside. Where is the demand actually coming from? We could get very granular on this, but for right now, basically, what we have is an imbalance. A demand for copper that comes from industrial use, right? That's sort of your classic demand. We'll talk about transports in a minute. Electrical of all types, be that your phone, be that your computer, be that whatever, right? And there's a lot of other. And if I remember this correctly, the other includes part of what's included here is basically AI related. So I'm going to skip this next chart here, but just to give you an idea, it's not really just about AI. You know, copper's demand comes even just from, let's say, let's just isolate one thing, just as an example, comes, for example, from electric vehicles. And so when you look at electric vehicles, you can see that your classic combustion engine car, so basically just a motor in it, has roughly, I'm sure it's an average, about 48 pounds per car. You look at a fully automated electric vehicle, like a Tesla, for example, it's got more like 180 plus pounds of copper in it. So that's a very, very big difference. As I mentioned, you know, we've already seen this trade begin to play out. So the demand for materials and energy is already playing out. I took this a few weeks ago, but it's still roughly the same. Technology has had a catch-up trade the past few weeks. You may have noticed, but the energy stocks and the material stocks are doing very, very well, because without any of that, there is no AI, or there is limited AI, right? Limited in the sense that it cannot reach its potential anywhere near close. And in fact, if you look at a portfolio, I went back a decade, and I have this hard assets portfolio that I track. You can see that the blue line, which is a hard assets portfolio, has actually done much better than the S&P 500 over the past decade, which is incredible. If you think about how well the S&P 500 has done, the S&P has done like 15% a year for the past decade. I mean, it's incredible, right? Way, way, way above average, which is why we're probably going to have mean reversion as well. But let's get to the chart. And you may have guessed it by now, but the chart I showed you before, the one that I think is a bullish chart of the ages, it's actually the price of copper. Now, again, copper can be invested or traded in through futures, through ETFs, through options, thus, and of course, through individual stocks that might, you know, have a close correlation, positive correlation to the price of copper. If we overlay the price of copper to the price of NVIDIA, and this is now our estimation, we estimate that copper is more or less, and again, this is our estimation, where NVIDIA was, let's say, in early 2023 or maybe mid 2023. And of course, that led to a giant move. Now, the thing about commodities is they're not stocks, right? So commodities can move in giant leaps and bounds in either direction. But when you have a giant supply and demand imbalance, it really can force things to the upside. So we actually think that the price shocks here are likely going to be to the upside, not to the downside. That's the risk, I should say. Is more price shocks to the upside than to the downside. For the past 25 years, if we average out the average rally for the price of copper, then you can see what it kind of averages out to. So the past 25 years, we have had some major rallies in the price of copper, and I just decided to take an average of these, and the average of these moves is 250%. So essentially, if we were to get anything, you know, and again, that's why I took an average, not like the high of it or the low of it. If we just take it a bit more conservative, if I may say so, and you make this, let's say, a 200% move, then if copper were to rally 200% from here, if it's not a forecast but an assumption based on everything we just talked about, we're looking at a copper price that can easily go, you know, north of 10, 11, 12, 13, whatever dollars, kind of thing, roughly, right? I'm not trying to go too exact here. Again, that's an average, and that's now taking it in a below average. Now, some of the previous moves did not come with these massive tailwinds in energy. That's another thing to maybe point out. And I think now we really have sort of like a, if I may call it, a perfect storm of what could be setting up here. There are at least four, it's at this point actually more, maybe 7 or 8 other hard asset setups like this that are needed for energy supply, as well as a whole basket and even some ETFs and individual stocks and ETFs that I think are setting up for this. To give you an idea what those charts look like, just to give you sort of a broad stroked idea. Some of these charts look like this. So, you know, if you've ever looked at a chart before, you can probably see this is a pretty bullish setup, or like this. right? Very, very bullish setup, or like this. So, there's a lot of commonality in the way that these charts currently look like, just from a pure charting perspective. I think the best out of all, and it's not it's just sort of like the cherry on top, but I think the best of all is that no one, or maybe I shouldn't say no one, but very few people are in this trade or positioned in all of this yet. Um, People are talking about it for sure. You may have even heard about it, but I'm telling you, very few people are actually allocating to this. They're certainly not allocating to the extent that they could, which is to say that there's still a lot of potential for this to go a lot higher. I'm going to warn you one more time, and maybe a third one. We'll see a third time later on. But again, I would not encourage anyone to just go ahead and say, okay, got it. Serge likes copper. I'm going to go and buy some copper. I don't think that is going to be the right mindset. I think you need the proper plan and perspective and look at this through the lens of an opportunity set as a thematic and not just one ticker. I think that's very, very important here. Now, we haven't even talked about one of the biggest tailwinds of this, in my view, and that is really, if you look at the energy sector itself, which is essentially underowned in most portfolios. There's been a severe underinvestment in the energy industry due to some of those ESG movements that we've had over the past decade or so. And I think the risks, as I mentioned before, are actually that we get price shocks or price spikes, price shocks to the upside, not to the downside. And I think a lot of this will translate into opportunities for investors that may be difficult to really see just yet. Here is a very simple, but I think an important and a telling way of looking at the S&P 500 index. What I did here is I just broke down the S&P 500 into its constituent sectors. So these numbers you see here, the 30% and the 10% or whatever, these are basically how big a part of the S&P these different sectors are. And if one were to fairly add up the technology sector right now in the S&P 500, it wouldn't be 30%. It would be closer to 45, 50% of the S&P 500 is essentially technology, and even more so is the correlation to tech in larger part. What we see sort of on the other spectrum is that the energy sector, which maybe now is closer to 4% of the S&P, and the materials sector, which isn't even here because it's so small, was 2-3%, whatever, a little while ago. Maybe it's a touch more right now. So there's so little money allocated to the stuff that actually we need desperately in order to make IT work, certainly AI and other stuff, that we could literally see some of these sectors explode. And in fact, if you look at historically, the tech sector is closer to, if we're fair, tech is closer to maybe 15 to 20% of the S&P. If we round up, the energy sector is closer to 8% of the S&P, materials maybe 6, so at least 2 to 3 times what those allocations are right now. So energy materials could easily double or triple as a sector, and of course individual stocks a whole lot more. And if you look at some of the charts, just to give you a bit of perspective in terms of what this looks like, just from a purely charting perspective, people a lot of us, about 60 or 70% of us, are visual learners, meaning we have an easier time learning something by looking at it as a series of pictures as opposed to just numbers and words. The energy sector, very, very much coiling. It's moved a bit since I took this picture, but still very much, still breaking, and in the big sense, breaking out of almost a 10-year base. Again, if I show you sort of the energy sector where it is right now versus where like tech stocks are, which is the purple line, we're just really starting kind of that move. We showed this chart early this year. This is the energy sector divided by the NASDAQ 100. And we showed this chart to some of our clients. And of course, we had a major breakout since then. So we're certainly moving in the right direction in all of this. Individual stocks like ExxonMobil, are looking very good and have broken higher since. And so again, the entire thematic here is really working in the right direction. Now, we've talked a lot of tailwinds, but there's one more that I think we need to address here in order to really kind of understand what is the opportunity set here. And that is the amount of money that's currently tied up in US markets. This is basically what you call net international investment positions as a share of GDP. And basically, to make a long story short, you can see the amount of money that's basically plowed into the US equity market and to some extent the bond market as well. A lot of this money is in US tech stocks, right? Or at least a good amount of it, which is again why we have these incredible market cap concentrations in tech stocks. And if you look at the tape again today, you see that story continuing. So if you, and I'm going to flip these a bit quickly, but just so you kind of see how big the Max 7 stocks are from a market cap perspective relative to global markets, even within the S&P 500 itself. Don't worry about the numbers here. Just look at the graphs, the bars, the columns. You can see how big the tech sector is versus the other sectors. Just another way of showing you. So basically what I'm trying to tell you is if we're trying to take some money from the tech sector and allocate it, if you're like at, let's say, a pension fund or something, or a big allocator, and you're trying to allocate money to other parts of the market, let's say the energy sector or the materials sector, it's like trying to squeeze, this tree into a vase. It's not going to fit. And the price spikes, the risk is that the price spike is to the upside, not to the downside, right? So there's simply these sectors, and the liquidity and the volume and all that is simply not big enough in these other sectors, particularly energy materials, which we're focusing on here, to accommodate for these moves. And big hedge funds and stuff are aware of this. That's why they can't plow so much at one time. But it looks like it's a constant drip of money going more at the margin out of Mac 7 tech and into some of the stuff that actually enables energy and that enables AI, which is basically energy and materials and even utilities to some extent. So that's kind of how we look at things right now. So having said all of this, I think it's time to just stop, kind of talking around the cake and just look at what's the actual trade, what's the setup, what are we looking at here? This specific strategy here includes multiple markets. Again, I think it's at least 5. We could probably expand it out to 10 or so different tickers. Before I show you guys these 3 big ideas of how to do this trade, one doesn't have to do all 3. One could do either of these, right? So not trying to overwhelm you. I want to share a couple of really big moves that this strategy has revealed just over the past few years. As I mentioned before, I typically try to look for sort of a couple of these 10x opportunities each year. They don't all work, but just try to show you the last 3 ones so you can kind of see what we're looking at and what the methodology is also here for this one that I'm talking about here today. So, for example, coming into 2020, we thought that the bond market was going to have a more difficult time, and that bond yields essentially would go down, bond prices would go up. So we talked about, SHY and ETF or TLT with options for futures or whatever. We thought there might be a big rally in place. And of course, bond yields collapsed, bond prices went higher, and a lot of people who followed us and that did very well. Gold was a big one. We pounded the table on that one starting in late 23 into 2024. And gold continues to do okay. Since then, it's had a massive move, as you know, probably over the past couple of years. A shorter one still took a couple of months, but a shorter one was Tesla. We really thought there was a tremendous amount of upside through the lens of a 10x. This was in March. This was in September 2024, I believe. And we had a massive move in Tesla that went so quickly that we had to close the trade by December at some point because it just reached the target. So, but again, these are not meant to be day trades. They are sort of 10x allocation ideas that we like to entertain that have a deep-rooted research. So those are 3 trades, 3 big opportunities, and I think now it's very much ripe to talk about the opportunity here right now. So let's talk about this. We've talked about copper, right? So I think everyone sees here the idea of copper being at one of the core things that we need. We need copper in order to this have this energy transition actually take place. In order to transmit and transport energy, we need copper. If we want to build more power plants or whatever we want to do, right? Almost anything takes copper. AI infrastructure, it needs it, right? Even just building these power plants or not power plants. Sorry, phone is ringing. Building the data centers, right? All those things require a lot of copper. Okay, so the trade we're talking about here, the idea can be executed in multiple ways. I think what's important here is not so much how we execute it, but what the tailwinds are. But I'm going to give you 3 different ways in which this can be done. Okay, so one way of doing this would be just to literally buy an ETF, right? So for example, the one idea I gave you today, one part of our research is copper itself. There's an ETF that tracks the price of copper. I think that itself has probably a 50 to 100% return potential just buying an ETF. Not a guarantee, I'm just giving you education here, right? So please keep that in mind. So that's a simple sort of one way of doing that. Another way of doing it would be to use a little bit of leverage. It's not a suggestion, I'm just explaining it to you, which is to say that one could use options on, for example, an ETF or even some individual stocks that are closely correlated to this idea. In this one example I gave you today, for example, that will track closely to the price of copper. And then a third way of doing that, and this, by the way, I think this one with options here is probably a 10x return potentially. It could be 20x, I don't know. So I'm trying to be conservative in my view, but I think a 10 to 20x is not unreasonable. And then last but not least, if there is a futures contract, and this is, again, if you're privy to futures, maybe something worth considering. I'm not giving you advice, just educationally speaking here. But with futures, there's easily could be a 10 to 20, 30x return potential if one were to do a trend following trade with futures on this. So again, we're looking at a specific setup. What I really like about this setup here is there's a real storyline that I think a lot of people, it's pretty easy to comprehend the baseline of the story. We have supply and demand imbalances. In the case of copper, for example, we have tremendous demand, not just from AI, but the entire industry and the globe needs more energy, and more energy needs more, among other things, copper and a whole bunch of other stuff. This is the explosive pattern that I mentioned before to talk about. So again, just quickly circling back just to the price of copper, and you can see that the price of copper itself easily, in our view, could expand 200%. Again, that's just the underlying ETF or the futures or whatever, right? So how to express that view ends up being everyone's own sort of decision. But what I'm trying to give you is the baseline research in our view. Third warning, though, I told you, I promise you I'd warn you once again. Do not just take this trade randomly without any research. Don't just go in here and say, okay, got it. I want to buy some copper because search said so. No, really, this needs a proper perspective, proper plan, and it needs to be done in a manner that actually looks at this as an opportunity set, not just a random speculative YOLO trade. Again, as I said before, I think the opportunity is happening now. It's no longer an if, it's already happening. And if I'm right, and so far it's worked very well, it could be the ultimate 10x move, maybe for the entire decade. We shall see. We'll look back at this and find out. To give you a bit of perspective again, to me, when I look at these 10x trades, really I'm looking at something like my math for me personally, something like this. If I were to invest $2,000, I'd want to be able to make, up say 20,000. If I were to invest $4,000, I'd want to be able to make about 40,000. Again, with a decent probability, decent chance. If I were to invest, let's say $10,000, I don't want to be able to make 100,000. That kind of is my logic. What I'm showing here today is what I like most, and what it all comes down to, just from a simple uh, setup perspective, is it's an asymmetrical setup, right? So in other words, again, the potential reward, in my view, is much, much larger than the risk that we are taking here. And again, I think there's a huge profit potential. It could even be a retirement hedge, um, meaning like most people are not actually long this stuff. Most people are long a bunch of tech stocks because that's what the S&P is made up of. So when I say a hedge, don't take that too literal. I mean, just it could be a diversifier, and it's a trend following trade. And trust me, a lot of trend followers are going to jump on this trade, are already looking at it, and I think are going to start jumping on this. We have something called Heat Seeker. Heat stands for Hidden ETF AI Trades. And what I mentioned earlier today is we've already been tracking these trades and doing these things. In our Heat Seeker product, here's what we actually do. We actually position in a mock portfolio, if you will, a trade alert thing. We position ourselves in some of these assets that tend to benefit from the tailwinds of AI's energy revolution and materials. And we will send them out when we do a new trade, when we close one, and we look at it as a mock portfolio. We typically have about between 5 and 10 open positions. So we do look at it as a mock portfolio. And so that's what we are looking at here in terms of the performance. Last year, if we add up all the gains and losses of these trades, it netted to a gain of 225%, and that's without leverage. That's not using options. That's just the underlying stocks or ETFs. With options, of course, or futures, it would have been a lot more, right? 3-4x, whatever, however aggressive a leverage one may have used. In 2026, as I mentioned before, just up, I think up until a week or two ago, we were up 84%. We're now up 102% on the year. We closed another nice trade, and we've got a couple more that we may close here before long. But we continue to move in the right direction. It's because the tailwinds are there, right? So the tailwinds of this story of almost an insatiable demand for energy and materials continues to work out, and we're looking to continue to position as such going forward. Now, if you like this idea, if you like the idea, if it reasons with you, it resonates with you, excuse me, and you can see where the tailwinds are and why they're there. And by the way, AI is just the tip of the iceberg, right? AI, yes, that requires a crazy ton of energy, but you have all the other demand from industry to transports and whatever, right? Just life. We need a shit ton, excuse my language. We need a lot of energy and materials in order to make all this work. First of all, what we do in our Heat Seeker product is we send out the exact entries and exit for these positions when we send them out in real time. They're not day trades, they're position trades. The average position is on the books for a few weeks at least. Sometimes they're much longer. It depends on how great the trade is working or the position is working. We will cut something right if it doesn't work. So we're not just randomly holding stuff for no reason. And so we send out the ideas based on that by email when we have a new position that we want to add to the mock portfolio. The way most of our clients use this is by essentially saying, listen, I want to allocate a pot of money to this idea of being bullish energy, and they will just replicate the positions we have in the mock portfolios. I'm not giving you a recommendation. Remember, this is purely educational, but that's what people you basically do when they use this product. Again, the trade alerts can send by email. We also put them into a document, which is basically inside of our members area, which I will show you here right now, which looks like this. So in the members area, you get access to the actual mock portfolio on that page. But again, it gets sent out by email when we enter and when we exit it. We also are sending out essentially the research and all this, so you get access to the full research as we update it as well. And very importantly, we do monthly meetings with our clients, with our members, if you will. And these meetings are important because we update people on what's going on in this energy transition trade, materials, how it relates to industry, the globe, AI, and whatever else there might be. Everything gets recorded and posted in the members area, as I just showed you before. So if you can't make any of these member meetings, do not worry one bit. We do always record them and put them inside the members area right there. So you have full access to it, just like you have access to the mock portfolio as well. Yeah, again, the duration, right? This is important. Now, I think this opportunity is probably going to last a few years. I believe the trigger is here. So I think there's going to be a big surge in all of this here over the next few months, even more so than we've already begun seeing the initial moves of this. But I think this entire trend and opportunity lasts a few years. I think it lasts, my best case is at least 2 years, maybe 5 to 10 years. That's my best case right now. And for that reason, we have created our heat plan, our heat seeker, and it's $495 one-time fee. That's not for the year. That's not for the month. That's just for the entire duration of the trade. If this trade goes 5 years, you'll have access for 5 years. If it's done after 2 years, it'll have been a 2-year trade, which hopefully will have done very well. It's a one-time fee. What you can do is you can go to the link right there. It's thesteadytrader.com/heat. And thank you, David, for posting that into the chat. You can use credit card and PayPal there. And again, to be very clear, you get access, full unrestricted access to the Heat Seeker product and all the research and everything that goes with it. And of course, the trade alerts in real time when we enter the new positions. You have access to the mock portfolio. We typically have between 5 and maximum 10 positions, right? You can do those positions with options or futures, and of course stocks and ETFs. We will teach you if you want to use leverage. I don't know how many people in here like to use leverage. If you are someone who likes to use leverage like options and futures, you can absolutely do that, and we will teach you how to do that in the member sessions. In fact, the next member session is coming up soon. Yeah, there you go, in May. This month here. So we're going to do a member session soon. You'll get an email as soon as you're on board. Within the next day or two, you'll receive an email when we do our next member session. We're going to teach you everything you need to know about the setup. It's super simple in terms of what we do. We send you trade alerts, and then you can follow the mock portfolio. Also, as another bonus, as if that's not enough, we're also going to give you our sector rotation guide. So this basically is a beautiful little PDF that we created so that we broke down different industries and sectors and such, and so that way you can check which ETF to use based on which industry you want to track. So that's something that we're doing, and I think that's very, very helpful. And you guys are all going to get access to this. I think someone was asking something into this extent. So this is something that will be very, very helpful for you. So again, this is not a monthly fee. It's not an annual fee. It's literally for the life of the trade. Again, I think the trade is probably good for at least 2 years. It might be 5. I mean, hell, it might be 10 years. I don't know, but it could easily be 4 or 5 years. You will never pay another penny. It's $495. I think we're taking 15 people here today. And the reason we limit it to 15 people is because we can't take everyone on board at the same time. So we limit it to 15 people. So the sooner you come, the better. After that 15 people, it just shuts down so that we can onboard everyone. So that's how that works. If you have any questions, there is a phone number here you can call, and that is 561-769-3025. Any questions at all, let us know. I'd be happy to address them there. Some of the questions that I typically see around this is, what's the average holding period? We typically hold these positions on average. They're on the books for a few weeks at least. They can be longer. Listen, if something continues to trend, like we've had some things on for like one ETF that tracks commodities, for example, we've had it on for months and months because it just continues to work like crazy, right? So why take it off? If you're using options, we teach you, of course, how to roll options in a situation like that. So that'll be something we cover in the next meeting as well. We do that every month. Again, I think this trade has at least another 2 years in it. It really only just started, honestly. And it might be good as much as 5 years. So the $495 is a one-time fee. There's no hidden sneaky fees. That's it. One time you join, you're on board. And as long as the trade has its thesis, which again, I think is at least 2 years, possibly 5, we'll find out. We will continue to send you the alerts on this mock portfolio, to the monthly member sessions, and everything else that that we do along with this. So that is it. In the big picture, again, copper is just one idea that's core to this. There's a whole bunch of other tickers, including in the individual stocks, ETFs, and even futures if you want to use that. I think it's a beautiful 10x opportunity. That's how I look at it. I gave you the math before. And if you guys have any questions, you can always call the phone number there on your screen, 561-769-3025. Again, I will leave it at this. I think if you believe in AI, if one believes in AI, it's very difficult not to believe in at the energy transition and the materials transition, because we cannot have just AI. Forget everything else we need energy for, right? Like the world cannot live without a ton more energy. But just for AI, which I know is everyone's mind right now, rightfully so, we need a ton more of that in order for that to come to anywhere near the maximum potential that we can at least conceive right now. So with that, David, I'm going to pass it back to you. I hope that works for everybody. Any questions, let us know. The phone number is there. You can go to the steadytrader.com/heat. I was just confirmed here a second ago, we're taking 15 slots. After those 15 slots, it shuts down because we have to be able to onboard people. Then that's it for a while. So join us, sooner the better. $4.95. Again, it's a one-time fee. That's not a monthly or whatever. It's just literally for as long as the opportunity lasts. I think it's at least 2 years. It might be 5. And I think it's a hell of an opportunity. So thank you, David. I appreciate it.
All right. Thanks, Serge. Thanks for being here.
Thank you. Great to be here. Looking forward to having everyone on board.
Yeah. All right. That was Serge Berger, and be sure to click his link there and check out his offer. And so he was our second presenter for the day one of this Active Traders Playbook event. We have a lot of great presentations still to go today. In case you did not hear this earlier, we are live streaming this event to YouTube. So if you have to leave the Zoom room, welcome to everyone who is listening on YouTube right now. But for those of you in the Zoom room, if you have to leave at any point, you can still listen on YouTube as well. So next up is Anka Metcalf. Anka, are you there?
Hi, David. Hi, everybody. Yes, I'm here.
All right. Okay, you should be able to share your screen and get set up now.
Okay.
And then for the archives too, I am recording each presentation individually as well, and those recordings will be available on Timing Research as soon as I can get them processed. All right. Okay, I see your screen now.
Okay.
All right. I'm just checking my setup. Everything's good. All right. And you're ready to start, right?
Of course.
Okay. I'm going to start my recording again, and then you can start your presentation. So
Thank you.
I'm recording again now.
Good afternoon, everyone, and welcome to this amazing event that David put together. And I have something prepared for you guys that I hope is going to be worth your time and effort to watch. Happy Cinco de Mayo, everybody, because I almost forgot today. It's time for a margarita. So before we head out to have a margarita, let's take a quick look on how we can generate income and how we can create a blueprint to have that consistency, into trading. So I will be sharing with you guys a lot of information today. And a lot of the things that I will be presenting today are going to be new. So I want you guys to take some notes. Put away your phones, close any open browser, and pay attention, because what I'm about to share is going to blow your mind. We're going to be talking about the power hour advantage. And if you are like me and do not like to spend a lot of time sitting down in front of the computer, basically chained to your computer, this is the power hour secret that I'm just going to reveal on how you can generate an income, not only with day trading, but with swing trading as well, because 90% of the power moves from swing trades, you're going to be able to detect from early on into the first hour of the day. So you are going to be swing trading and day trading within 1 hour. I'm going to share with you some stats and some trades that we have done. And in fact, we do have actually more than 10 years of trading data, of 10 years of results. So I'm going to be revealing the power hour advantage, the most explosive opportunities that happen, yes, in the first like 60 minutes of the day when the market opens at 9:30 till about 10:30 or 11 o'clock. Like I said before, day trades and swing trades basically are lining up within precision within this power hour as well. This is where the institutional money is diving in to the market and putting us into a really great position of capturing sector rotations, capturing what is moving into the market at that particular time. Also, let's not forget that we are still in a full swing earnings season, and earnings season provides an edge. And if we understand the mechanism behind it, we can trade futures, for example, with extreme precision based upon the stocks that are reported earnings. So last week was a fabulous week where we had the most significant companies in the market report earnings, and we had some really impressive moves. We're going to take a look at some live charts in just a second. And also, April market outlook and what April actually laid out the foundation for. This is why we're going to talk about, because April laid out the foundation for May and June. And we're going to take a look at some key levels, critical trends, and what April literally created for our data and for the key levels, and how to trade it into May, because we're basically going to have a continuation from April, and seasonality is going to be very, very strong. We're going to talk a little bit about seasonality as well throughout May, and even going a little bit into June, but more about that when we are going to get to that chapter. And I'm going to share with you guys the income blueprint. So this is a clear plan with consistent execution and real results, right? Because everybody wants real results. And I'm delivering these results in 1 hour every single day. And I have been doing it for a really long time. For those of you that do not know me, my name is Anka Metcalf. I am the CEO and founder of TradeOutloud.com. I come with 10 plus years of investment banking experience, and I have 35 years of investing experience on top of 25 years of day trading experience. And we specialize in educating individuals how to day trade and swing trade in any environment, whether you're trading stocks or futures or cryptos. The system is the same. It's based on a multi-layer price support resistance. We take into consideration 8 layers of price support resistance. We also have specific trigger times throughout the day and specific price zones. These specific trigger times are proprietary to Trade Out Loud, and the specific price zones are institutional key levels based on which the price action is likely to react. And of course, chart synchronicity and divergency. If you have been trading in the market today, whether you have been trading stocks or futures, you have probably noticed that the Dow has been lagging throughout the day today. It also has been lagging in yesterday's trading session while we had some power moves happening in NASDAQ. But I would say not as powerful as some of the stocks or ETFs within the Qs, right? The ETFs are not within the Qs, but the stocks like Sandisk and Micron and Cisco and so on and so forth. So these stocks are literally blasting higher while NASDAQ is grinding higher. It's one of the strongest. And in fact, we did have 2 all-time highs today recorded in the Qs, definitely in NASDAQ, NASDAQ futures, and also in Russell futures and in Russell, the ETF. So let's get started, everybody. We're going to talk about the 5 pillars, and this is basically the foundation of consistent trading success. First of all, when we look at the market, we look at the market to determine what we want the market bias, whether it is going to be bullish or bearish, and what are the key levels that are pointing us towards a bullish bias or towards a bearish bias. And again, when you have the market structure, the market bias all planned out, trading is going to become very easy. This first pillar is one of the most difficult pillars for traders because traders think that they can go long and they can go short because they're trading a shorter time frame, where the reality is that based on the market volume and when you have some power moves into earnings, even if you have like a very slight pullback, but if the earnings are strong, then guess what? They're going to start blasting higher. So you're not going to have a good measured move if you short a really massive market. You're not going to get consistency. You're not going to get results. All you're getting is a stubborn reaction. Is your typical reaction say, I'm better than the market. And basically, we're not. We're not better than the market. And I understood this right from the get-go when I first started day trading about 25 years ago. I can't believe it has been 25 years ago since I started day trading. I literally quit my job and I started to day trade. And it was not easy, even though I'm coming from the financial field, from the investing side, from the swing trading side, from the hedge fund side. I'm coming here into day trading. It was a real transformation. But let me tell you something. Once I understood the day trading mechanism, even swing trading or investing became so much easier because you're able to see the flow, the volume, you're able to see and identify the sector rotations firsthand. That is going to give you an edge into your swing trading and day trading because day traders make some of the best swing traders and investors on the planet because they understand momentum, volume more than institutions do in reality. So what we do in the market bias, I'm going to show you on the chart, we use higher time frame structures to determine key levels because on a higher time frame structure, we're able to determine levels that are more likely to hold than levels that are holding, for instance, on a 2-minute time frame or a 5-minute or even on a 15-minute time frame. So before the market opens, I like to do my analysis and I like to look at these macro key levels because these are going to be my go-to, and I can establish the bullish above and bearish below based on this and based on how the momentum is playing out. And also take only the trades that align with the bias. Again, I'm not going to be stubborn and say, okay, so we had a run into the market or the market is basing into the highs and means that it's exhausted. So I'm going to start shorting it because it's not moving higher. So a perfect example was today because the market was basing into the highs, right? And we had NASDAQ into the highs. I'm going to show you charts in a few seconds. We have NASDAQ into the highs. We had the S&P into the highs. So we had a lot of the indices that were trading into the highs, but they were not making new highs. So that happened for about 30, 40, 50 minutes. So a lot of traders are tempted in this situation to say, you know what, if it's not making new highs, it means that it's going to go lower. And they start shorting. Now, the moment they start shorting, guess what? The algos are triggering and they're pushing the market higher. And the fleece out of those traders that start shorting make the algos accumulate even more size to start pushing further higher. Okay, so the bottom line is to trade with the institutions. You want to be in line with the institutions. You don't want to be against institutions. The second thing is the institutional levels. These identify high probability levels where price action is likely going to react. Prior day's high low is very important. If you have the price that is trading above the prior day's high, it means that it's going to have traction towards the upside and you're going to look into targets. If it's trading into all-time highs, for example, at Russell or the NASDAQ, you're going to be using your extensions, your fib extensions to determine or any other level that is going to create new resistance levels for the upcoming targets, such as fulcrums or pivot points or what have you outside of Fibonacci's. Because newsflash, institutions are not using only Fibonacci's to trace targets outside of all-time highs. So prior day high low is very important. For example, if the price action is so super extended into on a daily chart, for example, but it's still grinding higher, you have no reason to short it because that means that it's still grinding higher. And therefore, if the momentum is strong, the volume is lined up, just continue higher. Just look for a good pullback. Also, overnight high lows are very important because those are providing also an edge, and also look for the setups that are happening in the overnight. For example, on the 4 hour or on the 1 hour, because they can potentially trigger in the New York trading session, especially at around 9:30 to close to 10 o'clock. And of course, key support and resistance levels, and price respects these levels. And if you pay attention to, again, the macro levels and also dive in to these overnight highs, high lows, into 1 hour charts, 1 hour setups, you're going to find out that trading is much easier than you ever thought. And then you're getting into the power hour, right? So you're getting, right, the market is opening at 9:30, so you have all your homework done. So let's say from 9:20 to 9:30, you're doing your prep. And again, it's not like the stock market. The futures market is a little bit for lazier people, or for people that don't want to do a whole lot of extra work. The stock market, though, is in comparison is a little bit different. I love trading stocks, so I'm never going to step away from trading stocks, but it's a little bit more tedious because you have to look at the gaps, you have to look at the earnings, you have to look at a lot of other things and analyze the stocks that you intend on potentially trading off of the open, right? So it's a little bit more work. Here, you basically have the indices. That's all you have. You have 4 indices, and that's what you're going to be trading. And you have to wait for the power hour, so for the open. I rarely trade before the market opens. I used to, for example, when I trade the news like CPIs or PPI data, that I haven't done in quite some time because of the volatility in the market and the geopolitical context and everything that is going on. Because, even if you set a trade before the market opens, notice that at the open, when we have the huge volume surge come into the market, oftentimes the price action is going to fleece out some sort. So it's going to make a tail. And you can't trade without having a hard stop, right? Especially in this market, because if you have some news coming out, oh my gosh, right? That's going to wipe you out. For example, today we had again at 10 o'clock the same kind of missile news, right? With Iran. And guess what? The market dove a little bit lower, then it rotated back up. But we had the same thing in yesterday's trading session. So it's very hard to trade within this environment if you don't have a hard stop. So what to look for these high probability setups? There are not many, but you're going to be looking for breakouts or breakdowns, buy setups, sell setups, inside bars, dojis, etc. So it's whole sort of strategies that you have learned that you have to apply. Rejections off the highs or off the lows. Rejections off key levels. And this is going to probably send the price a little bit lower. Look at your support levels if your asset is in an uptrend, and look to see if you could get a better price with a better risk. And then momentum continuation like we have today, for example, in Russell and in NASDAQ. But patience creates precision. So it's all about waiting, right? So you're waiting for your setup, your timing, your price to be perfect, in a perfect alignment before you take the trade. And then let's not forget the risk management, because this is what's going to make you or break you as a trader. Now, I have some very bad news. 95% of the futures traders lose money because they have no idea how to manage risk. Zero. And the percentage is incredibly high. I have a lot of friends that are brokers, and they're telling me that stock traders are a little bit more educated in this respect, but with futures traders, it is a disaster because they can think that they can trade a standard size. Like, oh, I'm going to be just trading like one contract or three contracts or of mini S&P. Mind blowing, mind boggling. Why? Because your risk is not going to be the same. One time you're going to be risking $300. Another time you're going to be risking $500. There's going to be another time when your risk is going to be over $1,000, depending on the volatility. So your risk is not going to be the same. The issue here with these types of traders is that when they accumulate these losses, it's going to be really hard to get out of the hole. Really hard, especially for those of you guys that are prop traders. You should be learning how to manage risk first before managing trades, before looking into setups, before determining a bias, before determining a trade. Okay. So when you enter a trade, you have to make sure that you use the same risk size on all the trades. And it's not hard. I'm going to show you what we use in the trading room. It's a simple tool. It's a risk size calculator. And we also have a performance sheet where it automatically provides us with the necessary contracts that we need to take the trade with. Okay. So when you think about trading, you think that you need to have the same size. So for example, if my risk is $1,000 on a trade, but it should be $1,000 on every single trade, and it's not a monetary value, because risk is the difference between the entry and the stop. And one time I could have a trade in NASDAQ, which can have a 20-point stop, sometimes can have a 150-point stop. So you can imagine the results if you have an 150-point stop in NASDAQ, right? Or if you have a 20-point stop in the NASDAQ, if you are trading with one contract or standard of 3 contracts. Definitely that 20-point stop is going to get you like a really less risk. But when you have a wider stop in these volatile markets, you are going to have these wider stops. It's going to be devastating. And this is how traders blow up accounts. This is the only reason. Not because they don't know how to read the trend, not because they don't know how to identify high probability trades, not because they are not able to wait for key levels. It's because of risk. And it's because of risk management. And of course, execution and discipline. You have to wait and follow your plan. And yes, you need to have a trading plan. We provide our traders with a trading plan because I believe everybody should have a trading plan. And I know traders are lazy, myself included. When I first started day trading, I didn't have a trading plan and I was all over the place. Once I created my own trading plan, guess what? I was able to follow my rules and I tweaked it and I tweaked it and I tweaked it. And about 3 years, I'm trading basically the same, absolutely the same trading plan that I have created more than 25 years ago, right? So it was, and it takes a little bit of time. And have you noticed that every single mentor out there is telling traders that, hey guys, you need to have a trading plan. But at the same time, they're telling you that the trading plan is unique to you based on your style, based on your system, based on whatever. When I started trading, I couldn't care whether it's my system or somebody else's system. I wanted a system that works. Does that sound fair to you guys? Do you want a system that works? Or do you want to recreate the wheel and say, oh, I have to discover myself? I have to discover myself. I needed income now. And if you're like me, I really needed to generate income to pay my bills, to pay whatever, right? So I needed to follow a plan. So I started creating my trading plan because nobody would give me a trading plan, right? And I couldn't at that time find anybody successful that would share a trading plan with the strategy, with the timing, with everything. Guess what we're doing now? We're providing our traders, our students, with my trading plan. Guess what? They can develop their own trading plan if they want. And it's normal for them to, create their trading plan. But guess what? I'm providing them with my trading plan, with my exact trades, so they can start generating income before they discover their style, before they discover their own trading plan. Okay. My focus is to only take high probability trades. And if I see a setup that does not provide, for example, like a 75, 85% chances of success in that trade, I don't take it. And also remember that one good trade per day can make your day, can make your month, can make literally your week, depending on how it is. So consistency creates that freedom. So it's basically about one system, right? That is applicable in any kind of market condition, in any asset. And these 5 pillars that are so important. Remember, it starts with the market bias, into the institutional levels, into the power hour setups, managing the risk, which actually this should be like number 1, because this one should be like an all no. This would be like, okay, I know what my risk is for a day in the night position size, and then wait to execute with patience. Okay, now I've mentioned earlier that we're going to be looking at seasonality, right? And these are the peak seasonalities for example, for the mini S&P. It's valid for NASDAQ, for Russell, for etc. So we're looking at May because remember that I talked about the importance of May. Now remember, this is just a seasonal trend, right? So this computes about 20 years what has happened throughout throughout the years into the market. So the tendency was that April is usually very bullish, right? And we treated it as such, even if we had a lot of hiccups from the geopolitical tensions. Now let's take a look at May. May is a little bit more choppier, but it's still higher. So we could still potentially make new all-time highs, right? And if you have more of a compression towards the end of April, the more may develop higher and may continue higher. But be careful because the end of May usually creates pullback and creates a really amazing layout for the month of June. So remember, we're here. We just started. So we are moving higher. And for the next week or week and a half, we are still going to move higher. And you know what this is in sync with? This is, yes, Allison is live too. If you have a question, shoot it. Okay, so I'm going to be answering. So basically what we're looking at is a continuation of momentum into May. Now keep in mind that the market in April ran without having consistent volume. So there was very low volume. And if you have been day trading or swing trading, you have been noticing that the volume is still not there. Why? Because the institutions are still, some of them, not committing their full blast money. They're not committing their size yet into the market. Okay. And I also want to mention something else. Towards the end of the year, October is usually very tough and very volatile. Somehow resembles March, because March is an incredible difficult March. So if you take away something from this, remember that if you need to apply money management and risk management, this is where you need to apply, because the months where traders blow up their accounts are usually in May and October. In March and October. This is the highest score of blowouts. Okay. Now, how many of you guys would like to take control over your financial future for you and your family? Like, give me a one. How many of you guys in here? Give me a yes or no. I mean, I know that this is the one thing that I wanted for myself and for my family. I wanted financial security. I wanted less time for my commute, because I was commuting about literally almost 3 hours every day to go to work and come back from work. I loved what I was doing because I was doing pretty much the same thing, but I was doing it institutionally, and I was doing it on a macro level versus the micro level that I'm doing it right now versus day trading, right? So I was doing the same thing, but the commute was killing me. So I just needed more time to spend with my family, to spend, to have time to go to the gym, to do the things that I love, to go golfing, to go on the beach. And I needed that. So I worked so hard for that to develop my power hour system. Now, there are a lot of traders out there that claim that they have the secret sauce for the power hour. I don't know, because I have listened to a few of them and it doesn't look very good because they don't have any performance on that. We do, and I do. So generate income or supplement your income, right? So whether you're at a retirement age where you say, you know what, I just want to put the extra effort, just about an hour a day, and I want to see if I want to supplement my income, right? I mean, who doesn't like money? Type a one in here if you love money. Money gives you everything. It provides everything for you, right? Liberty, independence, etc., right? When you have money, you're not tense. Like imagine, having your bank account canceled right now and you're zero, like, oh my God, what do I do? What do I do? Right? As long as you have a trading account, and you know what? You know what the best part is? You don't even need to have a trading account. You don't need to have a trading account. You don't need to have money because now you could trade prop accounts, right? And we have our own prop account that we're going to be launching. And I know it has been, quite a process because we have launched it, we have reached a cap into it with our capital, and now we're relaunching again and reopening it. It is going to be mind blowing because it's not going to be subscription based, it's going to be performance based, but it's going to be fantastic. So more about that into the next couple of weeks or so. But if you want to generate income, if you want to supplement your income, there's a little bit of effort that you need to do. And again, you don't even need to have money. So my goal for you today is to understand the process. So here's why futures. I wasn't driven towards futures trading. I know. And I really didn't care what I was trading as long as I was making money. I don't care whether I'm trading options or stocks or futures or cryptos. I don't care. I don't care which trading plan I'm trading. I just want to make money. So I wanted the end result. And because I wanted money, I wanted the end result. Okay. So I was day trading stocks because I'm coming from investing background, swing trading background, like I said, hedge fund background. And I dove into stock day trading. But my accountant said, Tiska, 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 you're paying too many taxes. You're paying too many taxes. And it was so tedious for them to put my taxes together because I had a gazillions of trades. I was trading probably around 15, taking 15 trades in a day. And she had to record all of them. So it was, and then she told me, and this is an account that specialized in hedge funds, and it's quite a pricey accountant. But she told me that I should be gearing from day trading futures, from day trading stocks to day trading futures. Allison, for the second time, this is live. And if you have a question, please ask me. And she said, you know what? This is it. You have to trade futures. And I'm like, oh God, I don't think I can do that because I love stocks. I have a system. I have the background. I know what I'm doing. Like I'm profitable. Like what are the things here? And she said that you're going to pay way less taxes. You're going to have lots of tax advantages of being a professional trader, which I am. And when I heard like less taxes, I'm like, sign me up. Okay, so I started. So it was like not really like starting from the beginning, but I want to tell you something really interesting. Like when I started trading futures, I started applying the system that I had from my stock trading. And trading futures is a little bit more different. And just a quick sound check, guys. Can you guys hear me? Can you guys, okay, just a quick sound check. Let me know if you guys can hear me. Okay, cool. Okay, I just thought, yeah, I just thought that maybe the sound is not coming through. Okay. So basically, when you start trading when you trade stocks, let me ask you this. When you trade stocks, what do you guys focus on? You focus first on the Qs, SPYs, diamonds, and Russell, right? Is that true? So before we actually dive into the stocks that we have to analyze, and for example, if on the list that day we have Palantir, Broadcom, Nvidia, and Apple, let's say this is my watch list, we first look at the market indices because we want to make sure that these stocks are in sync, or if they're not in sync, what are these stocks telling us? So you perform the analysis on the Qs, SPYs, diamonds, etc., right? And you determine the levels, the trend, everything that we have discussed before. Now, when you dive into futures, again, you're trading those indices, right? So you're trading the Qs, you're trading the SPYs, you're trading the diamonds because you're not trading those stocks anymore. However, If you have a watch list of stocks that are powerful, like I do, that's going to provide you with an extra edge into futures. And this is what 99.99% of futures traders do not do, because they do not focus on what's moving that day, and not percentage wise in the sense of a little list that is moving on your platform and is showing how much percentage, I don't know, Nvidia is up, or SanDisk is up or down or whatever. No, but to have it on a chart and to observe the patterns that are emerging from your watch list or from the power players that I'm going to show you in a little while here, how they're impacting the action from the futures market. Wow, it is mind blowing. And you can only get this edge if you have been a stock trader, or if you're trading futures right now and you're listening to what I'm saying right now, to watch these stocks, right? To have panels and windows with these stocks. Okay. So basically, when you're trading futures, you get great leverage, you get more buying power. So you can actually control large contract values with very small amounts of capital, with very small margin. So, for example, with just a few $1,000s, you can trade contracts worth tens and or hundreds of thousands of dollars. And the result is potentially for amplified gains, but for losses if you don't know how to trade. You have high liquidity, especially in the futures market, like I've mentioned, the market indices, crude and oil right now. And for now, just please stay away from crude, because it's just junk, right? It is not a technical trade. It's a geopolitical trade. You get really tight bid-ask spreads. So this is very efficient for entry and exits, whether you're executing a market order or a limit order. I only trade with limit orders, only trade with limit orders. Maybe 1%, maybe one or two trades throughout the year I enter on market. You get fast order execution even in very volatile markets. The futures market is open nearly 24 hours a day. So if there's an event that is happening overnight, you could take advantage of that if you want to trade it. Or if you're in a trade and if you see something that is coming on news, or something is happening anywhere in the world that is affecting price, you have the opportunity to get into your platform and raise the stop if you're in, and say, hey, I'm going to put my stop at break even. Whatever happens, happens. And then I'm going to go to bed. Or I'm going to take it all out now. So I don't want to have to live through any uncertainty throughout the night. So you have that liberty, where in the stock market, you don't have that. So you have to wait until the market opens, or at least the pre-market. You have low trading costs. So futures commissions fees are still lower, and no pattern day trading rules. Now you don't have that, or we won't have that in the stock market either. Very tax efficient. So when you think tax efficient, I want you guys to talk to your accountants, or you can chat GPT it, if you will. But many US futures contracts qualify for the 60/40 rule. So if you're trading the futures indices, you get the 60/40 tax rule if you're in the US. If you're in the UK or in Europe or anywhere else in the world, even in Canada, you're getting much better taxation on trading futures. So 60%, that what the 60/40 rule is about, is 60% of the gains taxed as long-term at a lower rate, and 40% taxed at a shorter-term ordinary income. So no wash. Sale rule, easier tax reporting, and cleaner bookkeeping, because at the end of the year, you just get a 1099 form. Boom, that's it. That's it. And you put it, whether you want to do your taxes yourself or you have your accountant is going to love you for this. You get transparency and regulation. So trading on regular exchanges like CME and NYMEX. You have diversification opportunities. So if you think like, oh, I'm, like I don't have an opportunity to trade stocks, but hey, you trade indices, right? And I'm going to show you how you could trade stocks through indices. You could trade currency, so you don't need to trade Forex anymore, because I was trading Forex. I traded Forex for so long, okay, almost for like 20 years. And guess what? You don't need to do that anymore. Now you can trade through futures. You can trade commodities. Commodities like gold, silver, oil, natural gas, copper, so metals, grains, etc. Bonds, you could trade bonds. Not that they're moving lately. Interest rates as well. So it allows you to hedge or speculate across asset classes. So I always say that I'm really not a big fan of hedging, and I know this is a tactic that is used by a lot of funds. But hedging for a retail trade, I understand funds, and I understand if you own a hedge fund. I understand if you are at JP Morgan and managing billions of dollars in people's money. But when you're a retail trader and you're trading three contracts of RTY, for example, of Russell, and you want to hedge that, that means that you're admitting you are totally wrong and you're looking to hedge. So you're admitting you're wrong when you're hedging, right? And this is what institutions do. They're admitting that there's some risk that is just about to happen. And what they do is they start hedging, whether it is, for example, if they're long and SanDisk and Nvidia and whatever, they're shorting, let's say, futures Nasdaq. Okay. All right. Professional level tools for everybody. Everybody has access now to amazing tools, real-time data, and tools that allow you to manage risk properly and start doubling, tripling, or quadrupling your account versus losing money. So in this era with AI and everything, like losing money is just it's just a no-no because you can manage risk. Okay. Futures trading levels out the playing field for literally serious traders. So I have a panel here. And for those of you that are new to futures trading, this is everything that this is your watch screen, if you will. And that's if you want to watch everything. Now, do I watch grains? No. Grades have been incredibly low volume. They have literally very little interest into them, and they're very flaky. So I don't like to have my money parked into these grains for weeks or months without doing anything or even stopping out of these. You could trade currencies, not interested in trading currencies, but for those of you traders that like to trade futures, you could take a look at you could definitely trade the dollar, the euro, Japanese yen, pound, Canadian dollar, Aussie, and Bitcoin. By the way, I'm in a position in Bitcoin, and it has been, a really long time since I have been in. That's Bitcoin futures. Okay. My playing field is the Dow, the S&P, Nasdaq, and Russell. These are my go-to. This is where I go to make my money, and I pull my money in. You could also trade oil, gasoline, heating oil, natural gas. It has been a while since I have been trading gasoline, I have to be honest, or heating oil, but natural gas, pretty choppy right now. But yes, you could trade coffee, orange juice, etc. Do I trade them? Absolutely not. Okay, so I focus, these are my go-to, gold and oil. Okay, now my trading universe, like I said, it's the Dow, the M&E S&P, NASDAQ, and Russell, and my metals of choice are gold, silver, and copper. My energy of choice is natural gas and oil and bonds. That's it. I watch them because I don't know when a moment and when they're going to be setting up, I'm going to be trading them. But for now, I'm not. So earnings season has a powerful impact on the futures indices, especially in these indices that I've just mentioned. And these futures track broader equity indices and react strongly to earnings results of major index components. So earnings season is the time when the markets reveal its hand. It's where momentum starts, trend shifts, and new leaders emerge. So earnings season is creating more moves. It's creating velocity moves. The velocity is a term that is used for a stock or for an index that has a tradable void and is moving with these into the next target. And what is the most important element for traders? Follow through. If I see that a trade has a great setup, but at the same time, the resistance is so close to the trigger point, I'm just going to skip it because that trade is not going to have follow through. With earnings season, we have the return of volatility. Not that we missed volatility, right? But it's the good sort of volatility because this volatility is coming from earnings. So it's coming from the fundamental side. So it's creating the fundamental moves, which are true to the market. and you get bigger price swings. And for this really smart trader, that means really more money. And there are basically, I'm going to show you, there are basically 6 weeks in which you have to push the pedal to the metal, because that is the time when you're going to get that velocity, you're going to get the follow through. So that means actually less time spent into the market and taking advantage of the institutional power moves that occur in the first hour. So when earnings season impacts, the most important element to observe is that the futures market are going to react to it. So even if the stock market closes at 4 o'clock, earnings season starts after 4 o'clock. And if you have earnings that are coming in at 4:30 or 5 o'clock or whatever the timing is when they release, the futures are going to move as well, right? So not only that stock is going to, let's say, move up or down based on the earnings, right? It's going to have that hawkish action. But guess what? The futures are going to follow. So if you have strong earnings, for example, into Apple, you're going to see the reaction into NASDAQ. And you're going to be able to trade NASDAQ even overnight or into the New York trading session open before actually the market opens. You're going to see that it's going to have a really great reaction. And when it opens and when the institutional flow is coming in, that's going to be crazy, because that's going to carry the price whether higher or lower, depending on how the earnings are. And we're going to get to charts in just a little bit. Earnings beats versus earning forward guidance. This is something that I'm getting a little bit deeper in here with you guys, but the actual EPS beat is less important than the forward guidance. Keep that in mind. Markets are forward looking. So if earnings beat, how many times have you seen like, oh my God, amazing earnings? Look at Palantir. But the outlook is weak or in line or extended, which in Palantir's case, futures can sell off a little bit, and that means that the stock can sell off a little bit. Okay. And what should we focus on as futures trader? We should focus at key earnings data, right? So when these massive companies like the Max 7 are reporting, when banks are reporting, and track the earnings before and after the market closes within the earnings season. So also pay attention to the reaction of the news, because futures traders don't trade the earnings, they trade the market reaction, right? So they trade the reaction from Microsoft, from Palantir, from all these earnings. Now, this is this week's calendar. After the close today, we have AMD that is reporting earnings, and we have Super Microcomputer. We have also AMD, and these are some of the biggest components of NASDAQ, for example, the AMD and the Super Micro. And also tomorrow we have Disney. What do you think the Dow is going to do? It's going to react very strongly. So if Disney is going to have good guidance and good earnings, the Dow is going to move higher. Maybe it's going to break out higher finally, right? And then you have Uber, you have all sorts of other stocks in here. This is just to give you a general idea. And these are earnings reports by the week. This was last week, team. This is where we had Google, we had Amazon, we had all those massive stocks that reported earnings. And guess what? We're here right now. But even if you see like 4% here, these are still days where you're going to have a massive, massive push into the futures market. And then after that, remember that I said that the first 6 weeks are the most important. We're still into the peak right now. This week is still going to be fabulous for the market. So how to trade futures during earnings season? Avoid trading before the big announcement. So don't get into the market. For example, Disney is going to report before the market tomorrow. Don't get into the Dow just before Disney reports, because the Dow is going to have a reaction. Okay. So use the overnight data session. It's very important. Mark your highs, your lows, and from the stock that is reporting, and also from the index, because you're going to get traction off of that. Trade the indices with the most exposure, right? So if Meta smashes earnings, trade NASDAQ. Over S&P, if JP Morgan surprises, trade the Dow or trade the mini S&P. And again, it's all about plotting the zones. It goes back to the first pillar to identify the trend, to identify the key levels. And as a day trader, I use the 1 through the 15-minute charts during the power hour from 9:30 to about 11 o'clock, 10:30, 11. And I use very simple indicators that you're going to see. I use the 21 SMA, 10 EMA. These are going to be my guides. for the open. And pro tips, watch the first 15-minute range, because a lot of times trades are very fleecy in the morning and they go like up and down, up and down. They chop a lot. So watch it after 9:45 and look for a setup into 9:45. 9:45 is the first actual reversal time into the market. It's not 10 o'clock, it's 9:45. Track the earnings sentiment across the week. If most beat, the market will rally regardless of the individual misses. And pay attention to cluster days when multiple top names report. They're volatile and they trade lighter and tighter. Use the tools like earnings calendar. You saw I use earnings whispers and volatility monitor. Use the VIX to see where we're at. This is the fear factor. And also look at oil, because if oil goes higher, market higher. Oil lower, market lower. They're in sync. Now I'm going to share with you some examples of what happened. This is Wells Fargo reporting. You can see that the price action lower. This is before the market opened and after the market opened. Now check this out. This is the mini S&P. So I correlated the financial with the mini S&P reaction, and the reaction is lower, right? So it's not hard to trade. And you actually have, for example, a setup here where you have a little base breakdown, right? You have the stop over here, you have the entry here, you can position size, you have, for example, the support level here that you can guide for your target. You have Netflix reporting, right? Netflix down, continued lower, right? You can see it over here. Let's take a look at NASDAQ reaction. NASDAQ lower. So they're trading in sync. It's no surprise, no shock. So next time when you trade earnings season, pay attention to these elements. They're very easy to trade. So here is another example of Netflix reporting. Here is an example of NASDAQ short. Here's an example of IBM moving higher, reporting higher. Here is an example of the Dow moving higher. Now, in the Max 7 stocks, very few traders know that you can sync them into your NASDAQ, right? Now, the S&P holding, again, keep in mind that even though they're still synced into NASDAQ, the S&P is going to react as well. So NVIDIA represents 8%, guys, of the S&P. Apple represents 6.8%, Microsoft 6.7%, Alphabet, Google, excuse me, 4.8%, Amazon 3.9%, Broadcom 2.9%. So yes, NASDAQ is not going to be the only one that is going to move. So how to exploit earnings season through futures? Correlate these watch lists and see what is the strongest stock, pull it out, check the pattern and see if it's in sync or has relative strength to your NASDAQ, to your S&P futures, to etc. So remember, within the Dow, there are 30 stocks. S&P has 500 stocks. NASDAQ has 100 stocks. Russell has 2,000 stocks under it. So it's time to sync your, for example, and I'm giving an example here, your Dow into, your Dow stocks into your YM, because if you have really hard, like CRM here, for example, you have XP, Microsoft, etc. These have a huge market cap, so therefore they're going to be reflecting the ascending move into the Dow. So checklist, what do you need to do? First of all, check your earnings, trace your levels, trade and watch the stocks that are reporting that are in sync, right, with the indices, and watch them trade. That's all you need to do. Best time to execute the trades before the market opens. Okay. And after the market closes, if you're in a swing or some sort, you can actually manage it then. And how to prep, you need to know when certain stocks report earnings. And you need to keep an eye on those and determine your key levels and definitely plot your trade. Here's another example where Netflix flew higher right after earnings. And we had the power move into NASDAQ as well. So you see how correlated they are. This is Netflix down again from another report. This is NASDAQ down. Now tell me this is not easy to trade. This is where Google, Amazon, Microsoft reported the same day, and you could see the power move higher in all of these three. And obviously NASDAQ, what do you think it was going to do? Go lower or short it? And we're going to go like, oh no, we're going to short it at the open because it's too high. I mean, who are we to determine what's too high? So why traders fail? Well, here's the thing. Doctors think that they need about doctors need about 7 years of school, training plus license, etc. Plus. A lawyer needs 4 years of school, law school plus bar exam. A pilot needs 3 years of school, training time plus license. An engineer, 4 years plus training plus PE exam. But the trader, I want to be a trader now. No experience, no trading. I'm going to start tomorrow. So guys, the key here is to get educated first and then execute in trades. And here are some more examples with correlations. Walmart reported earnings, and this is on the same day. Walmart reported and the price went higher. The Dow went higher. On the same day, Apple reported lower earnings and Nasdaq lower. This on the same day, so you can see this divergency within the same day. This is so crazy. So like I said, with the plan what we have discussed in the first 5 minutes of this presentation: determine your bias, determine your entry, stop, target, and risk. Risk is more important than anything else, because if you know how to risk, you're going to be able to double, triple your account. Place orders. I use limit orders. Wait until the trigger is filled before I put my stop in, and have a trailing system. Have a trailing system. Know exactly what you're going to be doing into the trailing system. And again, if you have that, you're going to be always winning into the market, because you're not going to go like, oh my God, what am I going to do now? I'm going to sell that. Because a lot of traders are not used to winning when they get into a little bit of the target, even though it's below 1R or what have you. They go like, I'm going to take it all out. Okay. Because they don't know any better. They don't have a trailing method. We actually teach our traders for trailing methods. So we have a special offer for you guys. I know a lot of you guys have been asking about my futures trading room. We do have a course that is going to start again in a month from today. It's going to start in June. If you're interested on that, you can shoot me an email at info@traderlaw.com. But for today, I just did something for you guys, and it's only available for today. Today only. By the end of the day, midnight, and it's gone. So we never usually discount any of our products, because when you buy our course, it's like buying a Hermes bag, okay, or a Chanel bag. You're not going to see it on sale, okay? And even if you resell it, it's going to keep the price, right? So this is exactly what you're getting. So you're getting top-notch information inside information on the system that we're trading. So we're starting the day at 9:30 with the market prep. The morning trading room opens at 9 a.m. Okay, so we're discussing exactly where the money's flowing, and we're reviewing everything from earnings to news to whatever happened overnight to geopolitical context to everything, aside from technical. So this comes on top of everything. So of course we're going to do all the technical. Real-time execution. You're basically going to be trading my plan. Okay, so I'm not going to teach you how to fish. I'm teaching you how to trade, but I'm giving you the trades as well so you understand. So it's basically I'm teaching you how to fish. I'm also catching the fish, cooking the fish, putting a little bit of garnish, okay, and a side dish, and I'm offering to you guys that on a silver platter, okay? This is why this is the Hermes of everything, okay? This is the Rolls Royce of trading. Because and if you lose on that trade, oh my gosh, you can blame me. So don't blame yourself, right? But if you respect, I'm going to show you our stats in a second. If you respect everything, yeah, you're going to make money. Last year, we quadrupled our account. This year, we're on track to doubling the account so far, because the environment has been way different than what it was last year. But you're going to get in-depth coaching and skill drills. And every single question that you have is going to be answered in the room. We're trading Monday through Friday. From the room opens at 9 a.m. I usually come on the mic around 9:15. And as soon as we're done, we're done. So it could be 11:30 or it could be 9:45. It could be done at 9:45. One trade and done. You're going to get pro level strategies with a structured system built on institutional principles and simplified for retail pro traders. So few traders know that if you need to reach consistency, you need to have what? Great education and a support system. Because if you don't have the support system, a person that you can ask questions about the education, about the system, that's not a system, right? Imagine going to Barnes and Noble or Amazon and getting the best book that is on the market on trading, right? But if you have a question, what do? You do nothing, okay? You're not going to call the author and say, oh, what did you mean? I mean, I'm looking at this context. Does this apply here? No, you can't. So what kind of a trader are you? So I'm going to ask you guys a simple question. Are you a welfare trader where you're not successful, but you're the internal student? Okay. You're jumping from webinar to webinar, from system to system, from trading room to trading room, from education piece to education piece, from book to DVD to live, whatever you can get, but you're never committing. So you're the welfare trader, always broke, but you're looking for the next great thing. Or are you a millionaire mindset trader, a successful trader, a trader that is ready to invest in yourself to produce real results? So are you this kind of trader, or are you a welfare trader? So think about this. Don't procrastinate. Never procrastinate when it comes to trading, because procrastination is the assassination of the motivation that will stop you from reaching your destination. So your success isn't optional. Your success is engineered. You have to work for it. So if this futures trading room is for you, if you're losing money into the market, okay, if you're losing money, you're red on the year, oh my gosh, you need help ASAP. If you don't have a system and you're just winging everything, if you don't have a process that eliminates emotions, emotions are big. A lot of traders fear, okay? Fear. You know why they fear? They lack education and they don't know how to manage risk. Confidence. Confidence comes also from education. An educated trader is always going to be confident because the educated trader is going to wait for the proper setup to line up. And that's where the confidence comes in. Because if you don't have the proper setup, you're not going to have the trade. And therefore, I'm going to not take the trade if the setup is not there. So I'm confident, right? Stressed out, that's because you're over trading. Remember, when you put more trades out in a day, doesn't mean that you're going to make more money. You're opening the door towards risk. If you don't have a trading plan, if you have no clue how to achieve consistency, if you don't have no clue how to double your account, if you don't have no clue how to triple your account, that's a problem because we have a technique for that. Your losses are bigger than your winners. Ugh, it's that risk again. If you need guidance and if you need somebody that is going to answer absolutely all your questions, this is for you. So how much money did you lose last year? I'm asking you a simple question. How much money? You don't need to answer. Just write it down right now on a piece of paper because you know how much money did you lose last year? And what is your account saying about you today? Are you repeating the same system, the same mistakes that you did last year where you lost money, or are you about to change something right now? So the Power Income Futures Trading Room Kickstart, we have a Kickstart program. We're going to take off $100 from the first month. By the way, the trading room fee is going to go up to close to $500 a month for a reason. Okay. $100 off for the first month. Use the coupon code START100. I'm going to give you the link in just a second. Then it's going to be $299 per month, and you're going to be grandfathered in to this $299 per month, which is peanuts. Okay, so I'm going to share with you the stats first. I think we have one more minute, David, before David kicks me out. Okay, so I really didn't have a lot of time for charts. These are all the trades that we took this year. You can see the date, the instrument, the direction, targets, and this is the number of contracts. You can see that the number of contracts varies. Here, the trade was taken with 2 contracts. Here, the trade was taken with 17 contracts. Here with 3. Here with 6. So the number of contracts are not standard, right? What is standard? The risk. We never lose more than 1 R. You can see 1. You can see 1. These are the R's, the risk to reward unit, right? You want to be a successful trader, you do this. You don't want to be a successful trader, you want to blow up accounts, you don't do it. It's simple as that. So year to date, we're up $105,000. This is on a $5,000 risk, which, by the way, majority of prop traders out there have around $500,000 to trade with. So you could trade it with that. I trade with a little bit more than that. So my results are a little bit different, but what is important is that 24 hours. Now imagine if you, for example, risk only $500 on a trade, so not $5,000, you say 24.82 times 500, and you're going to find out how much money you would have made this year because every single account is different. So you'd have made $12,410, right? So that is great because on and again, that would be like if you use 1% on a $50,000 account, that would be 500. If you use 2%, that's going to be a little bit different. Okay. And again, here I am going to share with you, okay, the link. Here is the link that you can sign up. And it's not on our website, so you have to go to this page. It explains a lot about what we do here and what the trading room is all about. And if you go down here and join the trading room, this is where you're going to be able, you're going to see it's $299 a month. This is where you're going to be able to save that $100. And by the way, this is going to go up by the end of the week as well. This is going to go up like crazy. So if you want to start the monthly membership, remember you can use the coupon code START100. I'm going to type it in here. Okay, and you're going to get $100 off the first month, and then it's going to go back to 200. It's going to go back to $299. So you have some reviews here. Okay, so this is it. I think I'm done. I'm ready for some questions. If you guys have any questions, let me know. Happy to be here. Thank you, David. Don't forget the coupon code is START100. Thank you, guys. I really appreciate it. Thank you, thank you, thank you. For some reason, I can't hear you, David. I don't know why.
All right. All right.
Oh,
Oh,
okay.
I'm here now. All right. Thanks, Anka.
Thank you so much. Yes,
All
you can use any platform. I can still stay here a little bit and chat with you guys until David gets the next presenter on.
right. Yeah, so um our next presenter had a bit of a tech issue too today. John Thomas was supposed to be up next, but he won't be able to join us live. So he sent me this recording that he did. I think he did this for his audience just recently. Anka, I'm going to turn your share off now.
Okay, thank you. Thanks,
Thanks,
everybody.
Anka. So I think he just recorded this recently. Like I said, he wasn't able to be here live, but still wanted to participate. So here's John Thomas, Mad Hedge Fund Trader. Yeah, hold on.
Everyone, this is John Thomas, the Mad Hedge Fund Trader, and I'm going to teach you how to get rich trading like a pro. Yes, we'd all like to be rich, but not very many of us are pros. And of course, I'm broadcasting from the center of the universe, Silicon Valley in California. So take out your pen and paper to take notes or start typing into your smartphone. What I'm about to tell you will blow you away and change your life. For I am in the early retirement business, your early retirement. Learn what to do, when to do it, and why. How would you like to become a millionaire? Trade for a living full time. Become financially independent for life. pay for educations, cover medical bills, pay off mortgages, and not just for you, but for your entire family. You earn those kind of numbers, you get to do things other people only dream about, like take the owner's suite on the Queen Mary from New York to England, which is $50,000 a week. Not exactly cheap, but you do get 2 butlers for that price. When you get to England, you can take the Orient Express to Venice, Italy, and every dinner on that train trip is black tie. Once you get to Venice, you can charter your own private helicopter to take you anywhere you want. No messing around with those pesky gondolas, which these days cost $100 a ride. And you get to pursue the most exotic and expensive hobbies you want. In my case, it's flying antique aircraft. This is my own 1932 de Havilland Tiger Moth. And you get to buy the latest hot car. This was the first Tesla sold in California, the Model X. And believe me, I got a lot of looks as I drove down the roads, as well as applause whenever I stopped at a traffic light. So why listen to me? Well, I have 55 years of experience in the global financial markets, 10 years as the Economist magazine correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley, little time out as a Marine Corps combat pilot in Desert Storm, 10 more years running the international dedicated hedge fund, 5 years fracking for natural gas in Texas, and now 20 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still working and breathing. I also happen to be registered with the U.S. Securities and Exchange Commission. I'm registered as a commodity trading advisor with the U.S. Commodities Futures Trading Commission, registered as an investment advisor with the state of California, passed my Series 7 securities license test, and then the Series 63 securities license test, 2 tests you have to pass if you want to be a stockbroker in the United States. We don't get any commissions or kickbacks from these presentations. For us to pay out is renewals from happy customers who have made a lot of money. The trading opportunity of a lifetime is at hand. The Iran war has destroyed the old investment world we knew, but a new one has arisen, creating tremendous opportunities for the well-informed. It's all about making money in volatile markets. Let me, John Thomas, the Mad Hedge Fund Trader, teach you how to make money in every market condition, be it up, down, or sideways. Draw on my 55 years of trading investment experience, as well as my own Middle Eastern and energy industry expertise. Cash in on my 90% success rate for my trade alerts. Sleep well at night knowing your retirement funds are safe. The new economic reality. Closure of the Straits of Hormuz has cut off 20% of the world's oil, 30% of the fertilizer, 10% of its aluminum, and 35% of the helium essential for chip making. The Iran war may never end, but continue at a slow burn, taking oil to $200 a barrel. The Straits will never reopen unrestricted again, with Iran wanting to charge $2 million per ship. That creates $75 billion a year in new revenues for the Islamic Republic, while doubling the value of the oil it does export. The war gave Iran a switch to turn on and off the global economy, which it alone controls. The U.S. has created the most unfriendly investment environment in a century. Risk control is the order of the day. There's also a new energy reality. Many Persian Gulf oil fields were completely destroyed by the war, by mandatory shut-ins, and are never coming back. Gasoline prices will never return to pre-war levels. Middle Eastern oil sources have been proven unreliable and will not attract new investment. Many damaged oil facilities will take 5 years and cost $5 billion to rebuild each. Even if the war ends tomorrow, it'll take 4 months for new oil supplies to reach the U.S. The U.S. is energy independent only on paper. The reality is that the U.S. needs to import 3 million barrels a day from the Persian Gulf to keep gas prices at $4 a gallon. In the meantime, U.S. hoarding and stockpiling increased demand by 3 million barrels a day. What Trump got wrong on Iran? Well, he thought Iran would surrender in 4 weeks. The U.S. went into the war with ammunition and oil stockpiles at decade lows. Anybody can be bought at the right price. That doesn't work in theocratic autocracies. Firing 80% of your intelligence staff gets you terrible intelligence. Iran's military capability was wildly underestimated, attacking a dozen countries at once up to 2,500 miles away. Nobody thought Iran could do this. There is no Iran opposition willing to step in and take control. Any potential opposition was executed a long time ago. Iran is willing to sacrifice a large number of its own people to stay in control. The case against stocks is overwhelming at this point. U.S. stocks are not cheap at a record high 23 times earnings multiples. They dropped to a more reasonable 19 times during the Iran war, but the 2009 bottom was 9 times earnings, half the current level. The current energy crisis is much worse than the 2009 subprime loan crisis, so lower lows beckon. No current earnings forecasts are based on a world that no longer exists, one with energy at half the current price. We've just had a great 17-year run in stocks, which is now ending. However, there is a new game in town. Iran war will accelerate the great rotation out of the old trends into the new ones. It will move us out of tech into non-tech, out of growth into value, out of domestic into international, out of no yield into high yield, out of the US dollar into foreign currencies, out of paper assets into hard ones like gold, out of digital into real world physical assets. This could go on for the rest of the decade. So there is a method to my madness, believe it or not. And this is my global long short all asset class review. A global stock market crash is imminent. You haven't seen anything yet. The 10% sell off we got last month was just a warm up. Gold took a huge hit on the outbreak of the Iran war, but will be the first asset class to recover. Any bond or fixed income investment is toast because interest rates will soar. The long-term bull arguments of super liquidity, tax cuts, artificial intelligence, and falling interest rates are ancient history. Jobs data remains dire and is getting worse, and massive layoffs are imminent. Gas lines globally have already started. $10 a gallon for gasoline. Here we come. The US dollar is catching a new bid as global positioning unwinds, but that is just a temporary rally. The dollar is about to suffer its own major crash. Commodities will sell off, then recover as AI accelerates. Bitcoin failed to provide any downside protection in the last sell off. Better places to park your money. So, what do these four names have in common? Stanford, Crocker, Huntington, and Mark Hopkins. Well, everybody in California knows these names. They were all taught in grade school. These were the big four who sold the shovels to the gold miners during the 1849 California gold rush, becoming the billionaires of their day. Hint, you want to be selling shovels to gold miners. The gold rush of 2026 is on. $1 trillion is pouring into artificial intelligence by 2030. And believe me, here in Silicon Valley, I see this every day. The enormous amount of money is funneling into just a handful of companies. It will be a winner-take-all situation with a few companies succeeding. Big tech is building 7 AIs when only 1 or 2 are needed. That will lead to massive overbuilding in AI and an eventual stock market crash. The big play in AI isn't buying the winners, but selling short the losers, of which there will be many. Get in on the early stage of the right companies, and you will increase your wealth by 100-fold. So we're not new at this. We've been doing this for 20 years and really 50 years if you want to go back to my very beginning. But I'll give you a history of our 10 baggers over the last 20 years. We caught Zoom before the pandemic. That went up 10 times. We caught Lam Research. That went up 10.6 times. We got Square before it went up 25 times. We got the drug company Moderna, the inventor of the COVID vaccine, before it went up 40 times pre-pandemic. And we got NVIDIA back when it was a little-known gaming company. It went up 100 times from our original $2 cost to 200. And of course, the granddaddy of them all is Tesla. Our average cost is $2.35. It went up 230 times from there on the back of global EV dominance, autonomous driver, solar panels, electric utilities, satellite Wi-Fi, robo-taxis, and the Optimus humanoid robot. Those kind of numbers get you an average annualized return for 20 years of 50.9%. And why did our performance suddenly take off right here? Because for the last 13 years, we've been using artificial intelligence for our market timing. And boy, has it done a great job. Not only did we accelerate our moves up, we limited our moves down. And that's compared to the S&P 500 in orange, where we saw plenty of big downs, 20% here, 20% here, 20% here, and recently 10%. Of course, this has allowed us 25 consecutive positive months. We stop out of losers very quickly. It's easier to dig yourself out of a small hole than a big one. And you can see for the last 12 months, we were up every single month. That brings us a total return since inception of 818%, and that includes 84% for 2023, 79% for 2024, and 75% for 2025. We are a money-making machine. But don't take my word for it. Listen to a happy customer give his version of events.
Hi, my name's Wilson, and I've been with the Mad Hedge Fund Trader, John Thomas, since 2019. I caught the phenomenal returns in 2019 and 2020, somewhere in the order of the 80-90% returns on both of those years. I caught all of those trades, NVIDIA, the TLT, the Teslas, and so many more. And then in 2021, I started trading in some additional accounts, and I have caught almost all of those trades as well, and have been getting almost the entire returns that John has received, and it's been just fantastic.
All right. We happen to have a secret weapon that brings home these tremendous profits, enabling people to trade, and this is called the Mad Hedge Profit Predictor. This is our secret weapon. It's a market timing index. It's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. Took a team of mathematicians 1,000 hours of calculations just to come up with this one indicator. And you can see recently we were at 66, which means we are in strong sell territory. Whenever the index gets down here to single digits, that's in strong buy territory. This is our secret weapon over the last 12 months, and you can see it perfectly caught the absolute bottoms here back in April, here in November, and here in January. And of course, if you came in at these levels, here, here, and here, you made an absolute fortune because right after that, markets rocketed. We're also good at calling market tops, which we did, again, 3 times in the past year, here, here, and here. Buy low, sell high. It's my new market strategy, which I'm thinking of patenting. Of course, you can have this at hand 24 hours a day if you want, assisting you in your own market trading. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that updates itself 1,000 times a day. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined, systematic trading discipline that will enhance your trading profits. This is 3 years of the market timing index, and you can see we get lots of buys at market bottoms, lots of sells at market tops, buy, sell, buy, sell. It really is a money printing machine. I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithm driven. And you can see by the names of some of these mega yachts. This one is Perfect Trade, which a client invited me to sail on last December. And we had a great time in Florida cruising the coast. And this one called Algorithm. Imagine that. The algorithms certainly work for them. Make the algorithms work for you too. Why do we cover all asset classes? Well, information about one asset class sheds light on all the others. For example, knowing what the bond market is going to do and therefore interest rates is an incredibly useful advantage when picking stocks. Some asset classes will be doing great while others are dead in the water. It will point you to where the winners are and how to avoid the losers. Give yourself every advantage. Know what is happening all the time, everywhere. So, what do we do now that the euphoria has started to wear off in the market? It's time to become a bear market expert. And believe me, this is a lot easier than you think. For example, there is an ETF out there called the SDS, or the ProShares Ultra Short S&P 500 ETF, and this rises whenever markets fall. So, for example, we had a 10% sell-off that started on February 28th with the Iran war, and this index soared from 65 to 80. So that is about a 20% gain on a 10% fall in the market. And you get big increases like that because it's a 2x ETF. For every $1 the market goes down, this ETF rises $2. But it gets better. There is also a 3x ETF, and this one goes up even faster in falling markets. And you can see here we went from 50 to 62 and a half on a 10% decline in the S&P 500 that we got in February, March. But it gets better still. There are many more fish to fry here on the short side, betting that markets will fall. You can write call options against your existing stock position. Let's say, for example, you own Tesla shares, which happens to be one of the most widely owned shares in the world. If you sell short call options against your long stock position, not only will you take in extra income, you will also lower the average cost of your shares. For example, last October, we sold the Tesla 470 calls at $38, and that meant we collected $1,000 on each option as long as the stock stayed below $370. And we did this when Tesla options had a 60% implied volatility. So again, it's a fantastic money-making opportunity to make money, but also protect existing long positions that you may have. You can also buy volatility. And while the war didn't start until February 28th, the volatility index started sensing that something bad was going to happen all the way back in December of last year. That's when we saw the volatility index rise from 12 all the way up to 35. So this is a 3x return on a rise in the volatility index over a 2-month period. And you can see the big moves didn't even start until the war began, all the way here at the end of February. And you can see to the end of February, we had a rise in the volatility index from 12 to 22. That's almost a double. And then another 50% return on that. So again, another great way to make money. And of course, once the peace stock started, the volatility index collapsed from 35 all the way back down to 17 again. There are many instruments you can play this with. We'll teach you how to use all of them. There also is another ETF which sells short IPOs, or initial public offerings. Turns out that initial public offerings are the worst performing stock category in bear markets. And you can see back here when the war started, this ETF, which is called the IPO, fell all the way from 46 down to 39. So again, another 15% decline on a 10% drop in the market. So it outperformed 1.5 to 1 on the downside. So in bear markets, you want to short the IPO and buy it back at market bottoms. And of course, we'll tell you exactly when to do that. You also get a collapse in momentum. And like everything else, there's an ETF for that, the MTUM. And when the war started out, MTUM fell from 260 down to 230. That is a 15% decline. And when the peace talks started, we rocketed from 230 all the way back up to 280, which is a 25% decline. So again, another great trading vehicle with which you can play bear markets. And of course, there's always the SPHB. That is the Invesco S&P 500 High Beta ETF. Beta dies in bear markets. In other words, the rate of change of stocks, and it rockets in bull markets. So you can see here, beta peaked right at the beginning of the war here in February, and it collapsed from 125 all the way down to 110. It then rocketed back up to 134. So sell short beta in bear markets, buy beta in bull markets. And of course, there's always one more ETF, the Advisor Shares Ranger Equity Bear ETF. And this is a ETF that constantly has a whole panoply of bear market plays. Short futures, short options, short stocks, you name it. And this bear ETF rocketed from 15 all the way up to 18. That's a 20% gain in just 3 months. And then it collapsed again once the peace talks began and the market topped out. So again, another great trading vehicle here, and we can send you trade alerts on all of these things when the timing is perfect. All else fails and the market gets too tough for you to follow, you can always go into 90-day treasury bills. This is a government guaranteed debt instrument. Currently, it's yielding 3.76% on an annual basis. You can sell it any day. It trades like water. You can lock in a guarantee income. And rather than risk big losses in a bear market, you can get a guaranteed 3.76% per year income. It's not a huge amount of money, but it's better than leaving it in a checking account, which pays nothing. Stock. So we've just seen one of the greatest short squeezes of all time, one of the sharpest moves up in stock market indexes of all time. And there are many things happening in the market which you need to pay attention to. And we update you on all of these things on a daily basis. Global airline system is grinding to a halt due to fuel prices that are up 400% or going missing altogether. Big banks are shaking off their private credit fears and buying up debt on pennies on the dollar. Netflix tanked 11% on great earnings but weak guidance. Maine, the state of Maine, became the first U.S. state to ban server farms, and there will be many more behind them. That's because of all of the electricity, water they use up, and the noise they create. SEC has removed day trading limits, prompting a 25% jump in the shares of Robinhood. Amazon takes on Starlink through buying Globestar for $11.6 billion, and that is a satellite company. Soon, Amazon will be competing with Starlink. United Airlines took a run at American Airlines. If combined, they would have created one airline that accounted for 40% of all the airline traffic in the United States, which means it's not going to happen. Wells Fargo missed on their earnings, taking the share down 6%. Lockheed Martin scored a massive $4.7 billion missile contract for new Patriot missiles, which cost $2 million each, and which we're using dozens every day in the Middle East. So this is the buy right now group, stocks you need to get off of this website and buy immediately. You want to buy the Brazil ETF, the EWZ, because they've just had a pro-business election. Interest rates are falling, and we know that stock markets love falling interest rates. It has an appreciating currency, the real, and is replacing the U.S. as a major food supply for China. The EWZ currently is at $39. We're targeting $60 sometime this year. And we're also targeting the emerging markets ETF. We see it going from 54 up to 90. And again, it is a commodity and weak dollar play, and we expect the dollar to collapse later this year once we go solidly into recession. On those days, you get panic sell-offs. There's another group you want to look at, and these are the Halo stocks. Halo stands for high asset, low obsolescence. They make things, if you drop them on your foot, it hurts. These include companies like Texas Pacific Land Group, Corning Glass, Southern Company, Baker Hughes, the oil company, Southern Copper, FedEx, the chocolate company, Hershey, Colgate for toothpaste, Apple for cell phones, and any oil company. These are companies that cannot be replaced by artificial intelligence. The biggest sell-off in the market right now is happening in software because they can be easily replaced by artificial intelligence. You want to avoid that sector like the plague. These companies are immune to AI shocks. Halo has massively outperformed the LAHO, or the low asset, high obsolescence stocks. And this is a sector you want to go into on the big down days. Some of these stocks include the banks. JP Morgan is one of our favorites. We see it going to $400 a share. Citigroup, we see going to $200 a share. Goldman Sachs, one of the top investment banks on Wall Street, we see hitting $1,200 a share. And we've already made quite a lot of money on this. And of course, my old Morgan Stanley, we see going to $300 a share. BlackRock, fund manager, got hit hard by the prime credit crisis. We see bouncing back since the whole thing was overblown. Eventually, it will hit $1,500 a share. And of course, Interactive Brokers is getting rich off the enormous explosion in options trading volume. We see them hitting $150 a share. Second half of the barbell is technology plays. Tech stocks always come back. AI innovation is still the leader and is growing exponentially. AI is enabling tech companies to shed jobs and overhead at record rates, allowing profits to explode. It makes a great counterweight to deregulation and interest rate plays. We could spend the next 2 years rotating back and forth these two groups. However, not all technology plays will be winners. And while some of the most successful companies have already had enormous gains to the upside, the losers also have gotten very expensive and make great short plays. So let's look at some of these potential losers, which you should be selling every rally on. And this is the sell on the rallies group. They include the NASDAQ index. We see it dropping 20% to 20,000. Tesla, we think will hit $10,000 someday, but it's going to go down to $300 first because they're not making any money right now. Everything they're talking about is in the far future, like self-driving EVs and the Optimus robots. And Microsoft, a software stock looking to hit new lows. And by the way, these are some of the pictures of planes that I fly in air shows. That's one of my favorite hobbies. This particular plane is a B-17 bomber. We think Meta is another big short. It's been grinding its way down for almost a year now. Palo Alto Networks, absolutely slaughtered. We think it will drop below 140. And those are the stocks we think are about ready to take big hits. So here is the TLT, and it has been going nowhere for a year. We think it's about to see a sharp downturn. That is happening because interest rates are going up. Our initial upside target in interest rates is 5%, and of course, high interest rates cause recessions. Foreign currencies are about to come out of the dumps. The Iran war triggered a massive flight to safety bid for the US dollar. But once the recession begins, US dollar interest rates will collapse, taking the US dollar with it. This will prompt sharp moves upward in the Australian dollar, the euro, the British pound, and emerging market currencies. So there's a great trade setting up here in the currencies. They will all go to new highs, sell any US dollar rallies, and we'll show you the charts as to why. Australian dollar, now one of the strongest currencies in the world because it's riding on the coattails of a recovering economy in China. Euro also seeing sharp up moves here. Same with the British pound and same with emerging markets. The war in Iran is causing a melt up in energy prices worldwide. Natural gas prices are up 30% after Qatar's main export facility took a direct hit from an Iranian missile. Straits of Hormuz will remain closed indefinitely. The world can't function with 20% of its oil supply missing. That means 90 super tankers a day worth $500 million each with cargo plus 30 container ships a day are barred from commerce each and every day. I think these numbers are very optimistic. 10 million barrels a day of oil was completely destroyed and is never coming back. Here's oil. Our target is $200 a barrel. We currently are at 94. We think there's another double in the price. If you want to avoid oil and go for alternative energy plays, the best thing you can buy out there is to go nuclear. And Cameco, as a Canadian company, is the world's largest supplier of uranium fuel for nuclear power plants. U.S. is planning on building 80 new power plants to power artificial intelligence data centers, and China has 120 nuclear power plants coming down the road. Precious metals, we just saw a meltdown for the ages after hitting extreme highs. The biggest sell-off in history in precious metals hit traders hard. The sell-off came as Mr. Kevin Warsh was nominated as Fed governor, and there were fears that he would raise interest rates. His history has been one of keeping a tight money supply and raising rates. Precious metals hate yield competition from higher interest rates. Enormous amounts of over leverage in the space has been wiped out. The bull market is not dead, it's just resting. Gold may still look expensive, but everything else looks worse. Expect gold to consolidate around current levels, possibly for months, then take a run at new highs. Buy all precious metals and miners on dips. And of course, this is me doing some early Christmas shopping in Istanbul in the Istanbul gold market. Here's gold. You can see the tremendous run we had last year. Taking a sideways correction now, but we expect it to eventually hit $10,000 an ounce. Here is the gold miners ETF, same kind of action, consolidation followed by new highs. And the same with the world's largest gold miners, Barrick Gold and Newmont Mining, both hitting new highs. We also expect a recovery in silver. It had a move for the ages from 15 up to 110. It's since given 2/3 of that up. We expect a consolidation and recovery for silver as well. Same with the silver miners, same with the biggest silver royalty trust, Wheaton Precious Metals. The harsh truth is you really need my help. The majority of individual traders lose money. They lack the correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution to that problem is to get educated yourself. And of course, we are in the education business here at Mad Hedge Fund Trader. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why do dead people do so well? They never sell. They never get freaked out at market bottoms and dump everything. They're the ultimate long-term owners. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can get a 10x return on the great ones, but get wiped out by the losers. Let a 55-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. 81.58% average annualized return for the past year. Richard made millions of dollars religiously following my trade alerts. He now spends his retirement restoring vintage aircraft and flying them over the California coast. Greg turned $100,000 into $3 million solely on my trade alerts. He bought a new home in Orange County, California, with Tesla solar panels, a Tesla Powerwall, and a Tesla Model 3 car. Still had enough money to send 3 kids to college. Bob turned $500,000 into $27.3 million in just 2 years.
This is Bob. I live near Denver, Colorado, and I'm hiking on top of the Continental Divide. 9 months ago, I joined John's Global Dispatch Service and was so impressed with the profits I made that 2 weeks ago, while hiking in the Dolomites, I joined his concierge service. And in 2 weeks, it is 100% paid for it, and I couldn't be happier. Life is good. John really helps. The other day, I had a text message exchange with him regarding some concerns I had with TLT. Put spreads, he encouraged me to stay in. I did, and today they went out at 95% of maximum potential profits. And that's the way it works for me. I hope you all do well trading yourselves. Thank you.
So what do we do about all this? Well, stocks, you want to sell rallies. Bonds, you want to sell rallies. Commodities, you want to sell rallies. Energy, you want to buy every dip. Foreign currencies, you want to buy dips. And precious metals, you want to buy dips. If you were not up 81.58% in the past 12 months, as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. 50.97% is our average annualized return for the last 20 years. That is almost double the 28.71% we saw for the S&P 500. And this is the very long view. Here's where the big money will be made. The 2000s were the hard decades for making money in the wake of the dot-com bust. Making money from 2022 to 2030 will be like falling off a log as AI's new golden age ensues. Only a select few will make the big money for the next decade. Now is the right time for you to join that club. How to make money in down markets? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top trade mentoring service in the industry, up 81.58% a year. Follow my research and market-beating trade alerts, and you will rake the profits in. Let a Marine combat pilot steer you to big profits. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. This is a typical month for us. We did 11 trades, 10 of them made money. You can see we made 16% buying the S&P 500, 8% selling short treasuries, 14% on the Russell 2000, 12% on Amazon, 7% on Apple. We lost 21% on buying Biogen. We stop out of losers very quickly because we know there's a 90% chance that the next trade will make money. It's just a matter of time for stocks break down to new lows. Watch this space melt down into 2030s. Get ready to start reeling in those whoppers with Global Trading Dispatch as your guide. And yes, that is a 24-inch rainbow trout, which I caught on an Indian reservation in northern Nevada. Here's how it works. Our algorithm predicted an upside breakout in NVIDIA a couple of years ago. So we sent out a trade alert that looks just like this. We send them out at market sweet spots by text message and email. You get it in 5 seconds of our transmission. This says buy NVIDIA at $48 or best. It's an opening trade. Here's the trade date, portfolio weighting 10%. And to get a $10,000 exposure, you needed to buy 210 shares. What happened? Well, NVIDIA went up 45% in just 22 days. Did we sit around and just pat ourselves on the back? No. We sent out a trade alert saying take profits. Sell NVIDIA at $69.50 or best. It's a closing trade. And on this particular trade, we made $4,515 on a $10,000 investment in just 22 days. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income. Go from complete beginner to seasoned pro in weeks. Learn how to quit your day job and trade for a living full time. Trade from anywhere, anytime. And this is me sending out a trade alert to you from the coast of North Africa. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds. With my Mad Hedge Global Trading Dispatch service, you get instant trade alerts sent out at market sweet spots, about 200 a year or almost one every trading day of the year, and all the reasons to execute them. Live bi-weekly strategy webinars like this one with an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world, more educational videos and webinars than you can consume in a lifetime, access to a 20-year database on investment ideas searchable by names and ticker symbols. I'll even give you the name of a surfing camp in North Africa. Warning, it's a lot harder than it looks. I think I broke my nose shortly after this picture was taken. This is the one-stop shop. Learn all you need for every level. It's for individuals who want to understand what is happening with their retirement funds. It's for people who want to learn how to trade for a living full time, get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford an in-house research department. Get in before the next melt up or the next meltdown begins. With our service, you get my global market comments in your inbox every morning before the market opens. You also get the Mad Hedge Hot Tips, the 5 most important things that happened today and what you should do about them. This is what I'm not going to charge you for this service. I'm not going to charge you $100,000 a year. That's what I do charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $12,000 a year. That's what I charge my concierge clients who get my personal cell phone number so I can be their investment 911. And I'm not going to charge you $3,500. That's the full price of what I offer this product for on my website. This is the real deal. Creating this product cost me millions of dollars. With the best customer service in the industry, running it costs millions more. This is the offer you can't refuse. Just $997 for 6 months. That is a 71% discount to our website price. It is a limited time offer. We only take 25 new subscribers at a time, so we don't overwhelm the market with too many trade alerts. So it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right. That'll take you to a dedicated sales page only available in today's webinar. Let me make the money for you to pay for your own subscription. You make the trades. Discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. Just click on the chat box on the right. Buy now and you will instantly receive a trade alert with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. Don't leave good money on the table. 90% of these trade alerts make money immediately. And just to give you a tease, this is the chart of the trade alert I'm about to send you. You have to go through 1,000 charts to find one this good. Let me do the heavy lifting for you. What I'm not going to tell you is if this is a buy or a sell. You have to subscribe to my service to find out which one it is. Sign up now and you'll receive my free video course, Options Trading for Beginners. This is a 12-chapter course about everything you ever wanted to know about options trading, written for the basic beginner. So if you're going to work with me for the next 6 months, it's best to find out who is John Thomas. My family origins are very humble. Growing up as the oldest of 7 children in a remote farm in Southern California. I lived the all-American childhood playing Little League baseball and becoming an Eagle Scout. There wasn't much to do in rural California in the old days but hunting, so I picked up a job as a paper boy for the Los Angeles Herald-Examiner. I found the stock pages, bought IBM at 20, sold it at 30, and suddenly found a far better way to make money than delivering newspapers off the back of a bicycle. By the time I was 16, I earned enough money to fly to Europe. By the age of 17, I had visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions of Russians killed. I didn't see much of a future in that, so the government sent me to Southeast Asia for a few years of intelligence missions, where I learned how to fly and jump out of perfectly good airplanes. There I advised the militaries of America's Asian allies. As the war wound down, I became a foreign correspondent for The Economist magazine in London. When they learned I had a math degree, they switched me over to covering the Asian economy and the stock market. Ta-da, stock market. Of course, 10 years of government service, all I got was this box of medals, which I trot out once a year on Veterans Day. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent all the way to India. And if you're wondering why I'm so skinny in this picture, it's because I just lost 50 pounds. There was a massive famine in China where 50 million people died and which they kept secret. I figured out very quickly you didn't have to be that smart to make money in the stock market. Otherwise, Wall Street would have run out of smart people a long time ago. So I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund. And this is my original ID card from 1983, and you can see the years have been cruel. I rapidly became the top performing hedge fund of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. You can buy the latest hot car, fly your own private plane around Europe, go marlin fishing in Mexico, and collect vintage Rolls Royces. I now spend my days pursuing my first love, finding winning trade alerts for my followers. But now I do it from my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland. And I've quit turning millionaires into billionaires. There is far more satisfaction leveling the playing field for the average guy and teaching him how to trade, and that includes you. If I can take a $50,000 account and turn it into $500,000, that is more job satisfaction than I could get anywhere. I now travel the world ferreting out the best trading opportunities, and recently spent a couple of weeks in the Middle East. And believe me, I did more than just ride camels there. I also learned that much of the oil infrastructure there is completely destroyed and is not coming back anytime soon. That means much higher prices for oil. The number of possible trades as a result of that intelligence is in the hundreds. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. If you see an old plane flying loops over San Francisco or London, it's probably me. There you can see the 1948 Chipmunk, RAF Chipmunk, where I learned my aerobatics on. That is my de Havilland Tiger Moth. That is the 1928 Travel Air D4 Deer that appeared in the movie Hell's Angels in 1928, earning one of the first ever Academy Awards. And this is a 1939 Boeing Stearman, the basic training aircraft for all the American pilots in World War II. The ultimate luxury, of course, is to give to those who need it. I am, as a Marine Corps veteran, I volunteer for grief counseling for widows and orphans, and I'm a major donor to wounded warriors. When wildfires hit California, I visited the main evacuation centers, handed out $10,000 worth of Target gift cards. I also flew spotter aircraft looking for new fires for Cal fires. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars. And I promised not to tell which one. So it was in that spirit that I traveled to the famed World War II fighter station in Biggin Hill in England to meet Mad Hedge concierge member Peter Monk. Peter was a poorly paid pilot for Ryanair when he first signed up for my global trading dispatch. After doubling his money in the first year, Peter upgraded to my concierge service. Then the money really started to pour in. Peter plowed his Mad Hedge trading profits into restoring a 1940 Battle of Britain veteran, a Supermarine Spitfire Mark IX, in his backyard begging, borrowing, and trading for parts all over the world. He eventually built his fleet up to 16 flying aircraft, which today is worth over $65 million. When Peter invited me to fly one, I jumped at the chance. It was a mild and blustery day when we took off and headed for the English Channel. Even though the plane was 82 years old, we managed a brisk 250 miles an hour over the English countryside. The Spitfire could outmaneuver any plane the German Air Force threw up against it. This particular plane is credited with shooting down two Messerschmitt Bf-109s, and it's easy to see how. We found a clear piece of sky over the white cliffs of Dover in between two big fluffy cumulus clouds and commenced a full-on aerobatic flight test. Pilots always want to see what I can do with these old planes, and this time was no different. I executed multiple loops, barrel rolls, chandelles, lazy eights, Immelman turns, and wingovers, careful never to exceed the 1G limitation or the wings might fall off.
Okay, I'm going to stop that there. Almost time. In case you missed this when I fired that up, John really wanted to be here with us live, but he was having some tech issues and wasn't able to join us today. But he just recently recorded that for his audience and he sent me the that recording just this morning here. I don't think that John has. Someone asked about a free trial. I don't think John offers that. But you're welcome to get in touch with him. Just go to his site, madhedgefundtrader.com, and send him a message, and I'm sure he'll get back to you quickly. So, Silas Peters is up next. Silas, are you there?
Hey, David, I'm here. How you doing?
I'm good. How are you?
Doing good. Doing pretty good
All
here
right.
for a Tuesday.
Yeah. All right. So, yeah, you should be able to share your screen and get set up. And for everyone in the room, Silas will be our fifth presenter today, and we have three more live presentations to go after Silas today. Floyd Bradley, Zach Manis, and Jody Samuels will be with us through the rest of today. And then, of course, we have two more great days planned for tomorrow and Thursday. And if you didn't hear this earlier, I am live streaming this to YouTube. That means it's archiving instantly. And then the recordings of each individual presentation will be available later today as well. So, all right, Silas, are you ready to start?
I am ready to go whenever you are.
Awesome. Okay. I'm going to start my recording again in just a second, and then you can start your presentation. So
Okay, I've got what, 45 minutes?
But an hour or just a couple of minutes under an hour.
Okay, cool.
So, yep.
All right.
All right.
So,
all right. I am recording again now.
All right, perfect. So, first off, thank you to Anka, David, and the Timing Research team for having me on. I always enjoy coming in and presenting to this crowd. So, a great group of folks. I'm sure you're learning a lot this week. So, as David said, my name is Silas Peters. I'm from T2 Markets, and welcome to what we call the SPX Income Trading Masterclass. And this is where I'm going to show you how to build daily income from SPX options. And this is all done without guessing direction, spending hours at the screen without needing any prior trading experience. And by the end of this session, you're going to see how traders just like yourself, beginners, burnt out veterans, even full-time professionals, are now collecting 3 to 5 income checks a week using what we call a pulse bar strategy. This is a method that only takes about 10 to 15 minutes a day, and it's proven itself across thousands of trades and over a decade of data. Now, let's quickly talk about what you can expect out of this training and set some expectations. This isn't some get-rich-quick nonsense. You're going to discover a real proven strategy to build consistent income using SPX options. This is the same approach that we use every single day in our own accounts. You're going to see how to generate daily, weekly, and monthly income, not from wild bets, but from a methodical system using repeatable trade setups and mechanical rules. Now, this all works without needing an audience, without selling anything, running ads, without staring at charts all day. There's no special skills needed, no selling, no dancing on TikTok, no massive risk, just one repeatable skill that pays. And yes, you absolutely can do this. Now, are you in the right place? Well, if you are looking to build an online income and need a process you can trust, then you are absolutely in the right place. And I'm going to talk about some reasons why I think these are some of the best income sources ever. So we know that trading is a solo sport. That means you don't need to answer to a boss, find clients, chase customers. Once you learn how to do this properly, nobody can take your income away from you. Number two is you can make money whether the market goes up, down, or sideways. This is not about predicting the future. It's about collecting income from it. Number three, we don't need websites, funnels, social media dancing. All we have to do is learn to master one skill, and I'm going to show you how simple that can be. Now, this is very important. It is recession proof, mobile ready, 100% recession proof. It works in recessions, booming bull markets. Simply does not matter. And yes, you can even do this from your mobile phone. It's also 100% president proof. Left or right, blue, red, green, brown, does not matter. The income system works regardless of who's in office. Number four is it only takes 10 to 15 minutes a day. It's all it takes to place your trade and move on with your day. There's no second guessing. There's no stress, just flat out results. And then finally, number five is the system is extremely easy to learn. So there's no more zombie trading, no more chart hopping, no more stacking 27 indicators, just a clean mechanical approach that works. And if you simply do what we do, you're going to start getting the same results that we get. It really is that simple. Now, what exactly do we trade? Well, I've traded everything: stocks, futures, Forex, even traded books on Amazon. My wife thought I was crazy, and it required a lot of effort, and the margins were very thin. But only one market gives us the speed, liquidity, and reliability that we want. It doesn't matter if 1,000 of us are doing the same thing, and it's through what we call SPX options. Now, this is one of our personal favorites, and it's really the core of the entire income system that I'm about to walk you through today. In fact, we like being in good company, like that of Uncle Warren. We know he sold billions of dollars in cash secured puts during the '08 crash. And it isn't a new idea. It's just rarely executed with the kind of precision that I'm about to show you. And the strategy that you're about to learn, it really didn't even exist 2 or 3 years ago. That's how powerful and how timely all this is. Now, quick backstory on me, who I am, just a little bit of a background. I'm the founder of T2 Markets, the co-founder partner of Blue Marble Advisors. I'm an entrepreneur, risk taker, full-time trader. I'm a speaker, author, educator. Started my career at the Chicago Board of Trade. But this right here is what really makes it all worth it. Husband, I'm a father to 2 girls, and I'm a mentor to thousands of students. And my obsession is helping serious traders get real results. Now, before we dive into the theory, I wanted to quickly cover some stats on SPX, and I want to talk about volume. So as the date of this graphic, SPX has seen a huge jump in daily trading activity. And so what that means is more opportunity, better fills, faster trades, and the volume just absolutely continues to explode. And what that means is liquidity or opportunity for you and I. Now, people will ask, why SPX instead of SPY? And well, here's the deal. SPY pays a dividend, settles in shares. SPX doesn't pay a dividend, settles in cash. And it's also called European style, so there's no assignment risk. And so these two things right here is what gives us a very unique edge that we're going to fully exploit. It makes it far safer for income traders like ourselves. Now, if there's a better, faster, or easier way to generate real income online, I frankly haven't found it. And I'm sure we've all looked at some point or another. Now, before we dive into the strategy, here's what you should know. You're not going to make $10,000 a second by next week. Yes, there is something for sale in the end. And no, you don't need to buy it to benefit from this training. So we are traders, And what I'm about to show you is one of my favorite ways to make money in the markets right now. And I do not see that changing anytime soon. Now, there's really three secrets that change everything. One is why traditional trading is broken and then how we aim to solve it. Number two, why most traders struggle and how the market is rigged against them unless they know what I'm about to show you. And then number three is how to build an account that grows while also staying safe. Really, the smartest way to kind of balance risk and reward for maximum growth. So, what I'm going to do is start here and what's the real difference between trading and investing, and then which one actually matches your goals? Well, we know that investing is slow, passive, and often uncertain. You kind of hold and hope. Well, with trading, you take control, but you also take on more risk if you don't have a system. SPX income trading combines the best of both the control and speed of trading with the safety and consistency of a well managed investment process. So it's rules based, low screen time, low stress, and it's perfect for those who want steady wealth without waiting years and years to see results. Now, here's the truth. The market is designed to take your money unless you know how to play the game. And today I'll show you exactly why most people lose and then how to flip the script and finally start trading like a professional. Now, stats don't lie. Over 80% and maybe even more of retail traders lose money, and most blow up their accounts in 3 months or less. And most investors or traders are not failing because they're ignorant or dumb. It's just they're following bad strategies, don't have any plans, no risk management, and it's really documented reality. And I'm sure a lot of this sounds familiar. Constantly adding and removing lines, tools, indicators, just trying to see if this works. Maybe fumbling entries, exits, targets, taking trades that look good in hindsight but keep ending in losses. Maybe you've bought yet another course that's impossible to replicate, and you're thinking, well, maybe this time I'll get it right, but the system never quite delivers. Maybe you're zombie trading, scrolling through chart after chart, hoping the next one is the one, and it's exhausting, and it just doesn't work, right? Maybe your results are mediocre. Maybe you've wiped out a few accounts, YOLO'd a few trades. You're not alone, but again, it doesn't have to stay this way. Maybe you're frustrated because it's not working for you, except for the, occasional lucky win. Nothing feels repeatable, no consistency. And the real reason most people lose money is because they're winging it, right? Making it up as they go along. And it's not a system, it's a gamble. And history proves it. I think of the dot-com bubble, the 2008 crisis, even the 2020 crash. Most traders panicked and lost, but many profited. Why? How? Because they followed the clues and they followed the rules. And that's all going to stop today. There's no more guessing, no more hoping, no more hype. Here's what we're going to do instead. We're going to pick one simple strategy and we're going to master it. And we're going to trade it the same way every day, like clockwork, using a rules-based system that's been proven over time, back-tested, repeatable, objective, and that's how we can create consistent income without all of the emotional whiplash. SPX income trading is your stress-free path to potential long-term wealth. There's no more timing tops and bottoms. You simply collect the income while everybody else out there is arguing about direction. And the best part is that this works in bull markets, bear markets, sideways chop, does not matter. SPX income trading helps you build daily gains with minimal effort. It removes all of your emotional decision making. You're not panic selling or chasing green candles. You're following a plan that's already proven to work. And it compounds over time. Small, consistent wins stack up fast, and that's how you can build a real trading account without all of the burnout. Okay, now I don't want you to just take my word for it. I'm going to show you the data so you can see it with your very own eyes. Now, the system here that we're going to be talking about is based on rules, and rules can be back tested. And what you're looking at here is 10 years of data, over 2,000 trades, all from a single setup. Now, this isn't cherry pick. This is every single occurrence of the pattern over a decade, traded mechanically, no discretion. And that's what we call an SPX income system. So, like a factory, the same setup, same outcome, same process, it either works or it doesn't. We don't guess. And yes, we trade this on the S&P 500. Ticker symbol is SPX, using 0 DTE options and a $5 wide credit spread. And we call the core setup the tag and turn, a swing trade structure designed to profit when price taps a zone, then reverses. So simple, repeatable, and powerful. And you don't need to be perfect. All we do is follow the rules, and the results speak for themselves. And you're going to see setups like this appear every single week. And we take the ones that meet the rules and then we leave the rest. So these are the type of setups that you are going to be able to take advantage of. 90% return in SPX, 52.5%, 91.8%, power of mechanical execution, another 90% return, $55 profit. These aren't anomalies, it's the standard. Here, this trade hit 90% return with $80 profit. The pattern shows up. You follow the plan, you collect the income. Here's another 91.5% return, $40 in the bank. The trades are short, clean, consistent. This one, 93.3%, $95 profit, same setup, same result. Even in a slower trade, we still come out ahead, 84.5%, $40 profit. Solid day's work in 15 minutes or less. This trade delivering 98% return and a $150 gain, one of the cleanest executions that we've seen. And we don't just expire to win. Sometimes patience is the profit strategy. So in this example, a $64 return came from multiple entries, profit captured in phases, all by design. Here's another clean win, 95% return. This is what a high probability system looks like when it's doing its job. And our students are not just participating, they're crushing it. So you can see here multiple stories. Brian smashing 100%, Kevin 80%, ROC, Duncan 80%. And it's not luck, it's the system in action. Okay, these are real traders, real results, and they're not spending all day in front of the charts. They're following the system, taking the trade and getting on with their lives. Okay, and this is what happens when you stop overcomplicating and start executing with clarity and confidence. And what do they say? Happy wife equals happy life. Well, this is my wife, funded trader, using this exact same strategy. So let's get to part two. This is where we're going to go a little bit deeper and talk about why traditional trading is flawed and then the fix. So I want to talk about what's broken with traditional trading and then how we can fix it the proper way. Now, most traders are stuck in a flawed model, trying to predict price direction, time the perfect entry, and then micromanage exits. And, it's exhausting. Here's the truth. Traditional trading is 100% dependent on picking the right direction. You only get paid if you nail the move, which we know is rare and hard to replicate. It doesn't factor in volatility, market conditions, price behavior, and that's why most traders are leaving huge gains on the table because they're flying blind. Here's the fix. We trade with the market, not against it. We're using modern tools, new option expirations, and repeatable setups, and we do it without getting emotions involved. And we don't need to be right on direction. We don't need the market to make a huge move, and if it does, we just get paid faster. No overcomplicating. SPX income trading lets us get paid without perfect timing, and that's the edge. It's a game changer once you start to understand that. Now think about this. If you knew the market was going to move and you could profit without guessing direction, wouldn't you take that trade every time? Yeah, I mean, it sounds obvious when you think about it, but you'd be really surprised about how many people don't and actually miss. What if you could profit without timing a move or picking the right direction, but if you did, you just got paid a little quicker? Well, that's exactly what this system is designed to do. Whether SPX goes up, down, or sideways, you get paid so as long as your setup and risk profile are correct. And so this is the SPX income system, a simple, optimized process that works with market movement instead of trying to fight it. So how do we actually profit from this? Let's walk through the exact mechanics and I'll show you why this works again and again. And I want to compare this to how most traders think profit works. In traditional trading, you only get paid if you nail the direction and the move is big enough. But if the market makes a huge move, great, you get a big win. But if it barely moves, well, you get nothing. Or worse, you lose. Here's the problem. That means you have to be right about direction and timing. And the market has to cooperate with a large enough move. And that is a lot of ifs. But with income trading, it's completely different. You get paid even if the market moves slowly or not at all. It's like getting paid to wait. Small moves, we still win. Sideways chop, we still win. Big move in our favor, we win faster. The only time we lose is when the market moves against us too far and we're still in the trade at expiration. And that's 100% okay. We're going to have wins. We're going to have losses. It's part of trading. And get this, a perfect entry is not needed. Even then, the loss is predefined. We know exactly what the worst case is before we even place a trade. So what that means is no surprises, no disasters, no margin calls. And so now let's walk through how we profit. Okay, this is where SPX income trading flips the script on everything you thought you do. A trade doesn't need to go big to be profitable. In fact, it doesn't even need to move much at all. We're not relying on speed or direction. We're relying on probability and time decay. We're not using stop losses in the traditional sense. So a trade that goes against us early can turn around and finish in profit by the end of the day. We get a big move in our favor. Beautiful. A trade hits 100% of max profit quickly and we are out. If it's just a small move, no problem. Still a 100% win. The market just needs to stay above or below our break-even level. Even a tiny move, just 1 single cent in our favor can deliver a full win. And that's the edge of being at the money with a spread working for you. And even if the trade moves slightly against us, we can still close for a partial win. Anywhere between 0 and 99% of max profit is still on the table. And if the trade doesn't work out, we already know what the loss will be before we place the trade. And so that's a risk-defined strategy. So that means that we cannot lose more than the cost of the spread. So for example, with a $5 wide spread and a $2.50 credit, the most we can lose is $2.50. And that worst case only happens if we are completely wrong and we let the trade go all the way to expiration fully in the money. But most of the time, the market gives us plenty of time to adjust, manage, or simply let probabilities play out in our favor. So we're not trading naked options. We're not holding for weeks. We're taking quick, controlled trades, no overthinking. The rules are the rules. And when you follow them, the system delivers. That's why the traders who follow the system, they don't panic. It's the power of this system is the confidence. You place the trade, manage the position, and you move on with your day. So what I want to do is zoom out for a second. Okay, here's the 30,000-foot view of how the SPX income system works. First, we identify what's called a pulse bar. Next, we wait for a clean break of that bar, and then we set up what's called a profit package. And then finally, we manage the trade or we let it expire for max profit. And that's really the entire model. And we do this in less than 15 minutes per day. So pat yourself on the back. Congratulations. you now have a profitable online business. So what do you need to run this strategy? Not much. Any charting platform works, but I personally use TradingView, and this is the platform that we have pre-built indicators and workspace templates for. But you can technically use any brokerage or firm that has charting. For options execution, I myself and a lot of our students use Tasty Trade, but you can use Thinkorswim, Interactive Brokers, Fidelity. All those also get the job done fine. So first thing we're going to do is locate what we call a pulse bar in the first 2 hours of the day. Now, you don't need 14 different indicators or some NASA terminal. The strategy is built on clean charts and one visual cue, what we call the pulse bar. So less clutter and more clarity. So what the heck is a pulse bar? Well, let's break this down. A pulse bar is a 30-minute candle that closes in the top or bottom 5% of its range. And that signals strength, bullish or bearish, in a way that's very easy to spot and act on. And here's what we look for. A bullish pulse bar closes in the top 5% of the range and higher than it opened. A bearish pulse bar closes in the bottom 5% and lower than it opened. So literally one glance, one trigger, and that's our setup. So we know that the high to low range of a candle is 100%. So all we're looking for is a close in the top 5%, which is a bullish pulse bar close, or a close in the bottom 5%, which is a bearish pulse bar close. So it's not very difficult, right? Now, if you're doing this manually, that's fine. Don't worry. We can grab a Fibonacci tool. It's on every platform. We set it to show 0, 5, 95, and 100% levels. And then we measure the high to low range of that 30-minute bar. And if the close lands in the top or bottom 5%, then that's your pulse bar. Now, can we automate a pulse bar? Well, the answer is yes, we can. Because pulse bars are a mechanical rule, we can also have them coded into platforms like TradingView. And because this is a rules-based system, automation therefore becomes easy, right? Now, our team has already coded tools that detect pulse bars on TradingView, but we don't just stop there. We have software that also filters trades by ATR, time of day, directional bias, tag and turn swings. So you're only seeing the cleanest, highest probability setups and really none of the other noise, okay? And again, it's all automated. So you're going to see everything that you need to see onto the chart. In fact, this is a sneak peek glance at what it looks like. You can see everything here all labeled out for you. No guesswork, just execution. It's browser-based simplicity, desktop, laptop, phone, you're covered. And you're probably thinking, well, this is pretty cool. But what about performance? Well, since it's a mechanical-based program, we can run some back testing, get some data. And although we have a very smooth upward sloping equity curve, you see that we still have some, lumps and bumps along the way there in the middle. But when we've added some simple automation to our software, and I'll show you how to get access to this tool later, but just know the automation is not required. It just makes everything 10 times easier, faster, more consistent. But when we added that, as automation filters, you can see we now have a much smoother looking equity curve, okay? And this is what I want you to pay attention to. This is only one of 7+ income strategies in our back pocket. And by now, you're probably saying, well, it's so darn good, why don't you just trade it yourself? Well, the quick answer, easy answer is I do trade it. We trade this system every single day. That is when I'm at my desk, which is most days of the week. We trade it live with our own money, our own capital, prop capital in real time. What you're learning here isn't some theory. It's not some recycled fluff. These are the exact strategies that we use in our own accounts, okay? A screenshot from Tasty Trade, a live real money account, not a demo. Tasty Trade doesn't offer fake data or paper trading. So what you see here actually happened. Several open positions, all placed using the same pulse bar strategy that I've been walking you through. And the edge applies across SPX, futures, even stocks if you wish to adapt it to those markets. Now, originally, this was developed for a similar strategy for futures and stocks, but when zero DTE SPX options came along, really changed everything, right? Same rules, bigger edge, more frequent payouts. And look, I love trading, but I also love teaching and helping others master this system, and others is really what drives us, right? I know what it's like to struggle with bad information, useless strategies, and so now we help others avoid that pain to help speed up their results. But don't just take my word for it. The system works, and not just for me. It's working for hundreds of traders around the world every single week. I've got Chuck here starting with $800 in his Tasty Trade account, turning that into $2,700 in just a matter of weeks. And again, guys, this is not luck. It's the system executed consistently. Here we had Brian just following the process, not a full-time trader, just following the rules. And the key thing here is that when you follow these rules, your trading becomes structured. And sticking to the plan is going to be way more beneficial and profitable than trading your opinion. And that's really the shift that changes everything. So let's get back on track for a moment, because by now you've seen the edge, you've seen the proof, you've seen the pulse bar setup in action. Remember, step one is quite simple. We're going to wait for a pulse bar in the first 2 hours of the trading day. And you already know what that is. That is a 30-minute candle close in the top or bottom 5% of its range. Now, step two is where the money is made. We place what's called a profit package. And now that you know the setup, let me show you exactly what a profit package is and how to actually place one. So what is a profit package? So think of this as like a trade with two parts, okay? Like a trade with two parts, like a game. So player one sells an in-the-money option, player two buys an out-of-the-money option, same time, same direction, and specifically we're selling one in the money, buying one out of the money, a simple credit spread structure. And here's what it looks like on an options chain. We're selecting two strikes. Again, one slightly in the money, one slightly out of the money, and that's where we get our credit from. And you'll notice the strikes are just $5 apart, and that's our defined risk. So I'm going to break this down here. Break this down. ITM means the option is already profitable. It's already in the money at the moment of entry. OTM means it's not yet profitable. It's out of the money. And by combining both, we build a position that gives us a net credit and capped risk. Okay. Now, don't overthink this. Just use the strategy selector on your platform, choose vertical spread, and then pick your strikes. It's done in seconds. So here's an example of a bullish profit package. You sell the higher strike put, buy the lower strike put, and you collect a premium for placing that spread. Now here's a bearish version. You sell the lower strike call, buy the higher strike call, same idea. Just flip for a downside setup. The logic is the same. The execution is just mirrored. So which way do we trade? It's simple. If you see a green pulse bar, you are bullish. You place a bull put credit spread usually on the right side of your options chain. If you see a red pulse bar, you are bearish. You place a bear call credit spread on the left side of your chain. And that's really step two of the SPX income system. You place the profit package, and now you've really kind of seen how simple this is, right? Whether you do it manually, or automate it with a platform strategy builder. And then step three is the best part. Once you place the profit package, you walk away. You don't stare at charts. You don't micromanage. You let the trade do what it was designed to do. The edge is already baked in. Time decay is working in your favor, and you define your risk up front. So step three, You set the trade, walk away, no babysitting, no micromanaging. Now, here's what most traders miss. We only lose if the trade finishes in the money at expiration. So that means we've got the whole day for the market to turn around, pull back, or just go flat and still come out with a profit. And this is how trading should feel: stress-free, mechanical, confidence in every position. You follow the steps, manage the trade if needed, and let the system do its thing. So there's no panic, no overthinking, just results. So let's recap here. Step 3, you walk away, let the trade do its thing. We're not watching charts, we're not second guessing. The system is doing all of the heavy lifting for you. And then step 4 is simple: rinse and repeat. This isn't about chasing perfection. It's about taking these same high quality trade setups day after day, just like a production line. Let's move to part 3: how to build an account that grows while staying safe. Really, what I view as the smartest way that I know to balance risk and reward for maximum growth without taking unnecessary risk, without needing a huge account, and without guessing your way through trades. Now, as I keep saying, SPX income trading is one of the most powerful short-term investment strategies out there. It's fast, flexible, semi-automated, and it lets you build potential wealth without years of watching or waiting or looking at charts all day long. And again, it's not just working for me. Our students are crushing it using the same strategy, same tools, same rules. The only difference is how consistently they show up and how quickly they take action. So what I want to do is show you how this actually works with numbers, because this isn't just about theory, it's about repeatable outcomes, and this is where it can get fun. What I'm about to show you is not a promise, it's a math lesson. Think of this as a demonstration of what's possible when you follow the rules consistently and trade just 10 to 15 minutes a day. So let's say that you start with $5,000. We'll risk 5% per trade because we're only trading SPX. We're using defined risk strategies. And for every 3 winners, we assume 1 losing trade and 1 no trade day. And that's a realistic rhythm, even if you're only trading the morning time frame. So week win, you have a win, win, loss, win, no trade. So 3 winners, 1 loser. And that gives you about a $500 gain on a $5,000 account, about 10% ROI. Week 2, similar setup. This time we gain $550. Week 3, another profitable result. Week 4, still consistent. And for the entire month, you're up $2,300 or 46% on the account. Now, we break this down. You started with $5,000, risked 5% per trade, won 3, lost 1, no trade per week, and you made $2,300 in profit. But it doesn't end there. Because once you have consistent profits, this is when it gets fun and we start to compound. You probably heard this famous quote about compound interest, and this is where things can ramp up a notch. So instead of starting month 2 with $5,000, you're starting with $7,300. So raising position size 5% of your growing balance, your risk per trade now increases, and so does your profit potential. Now, I'm not going to bore you walking through every single trade by trade scenario, but without doing anything different, your gains start to accelerate. Month 2, bringing in $3,394. By month 6, your balance is over $49,000. By month 12, over $480,000 and more than $150,000 in monthly income if you're compounding aggressively. So we recap here. You started with $5,000. Risking 5% per trade, consistent 75% win rate, and you build $150,000 a month income in 12 months. But let's stop and hold our horses and be clear. This is just a math lesson. Yes, you can build a $150,000 a month income starting from $5,000, but is it likely? Not without consistency, patience, and time. What matters is this: even a fraction of that would likely change your lifestyle. So you say, okay, great, the math works, but does it actually work? Well, you've seen screenshots from our live tasty trade accounts, no demo mode, no faking fills, real trades placed in real time. And again, this is not winging it, guys. This is rules based, back tested, forward tested, sideways tested, and live tested across thousands and thousands of trades over years of market cycles. And it's extremely flexible. Now, SPX is our go-to. You can adopt this to futures, ETFs, or even stocks if you wish, as long as it meets the basic setup criteria. But for simplicity's sake, SPX is really still the most elegant version of this system. Now, remember, this is just one of 7 strategies we have in our back pockets. And I've shown you all of these results here that happen on a weekly basis that myself and our students have had the opportunity to take advantage of. And there's no reason that you can't do the same thing, because these set up every single week and the results speak for themselves. More wins, more success stories from students, small risk, steady wins, real money using the same process that you've seen today. This isn't about cherry-picked unicorns. These are everyday traders following a mechanical system, and they're stacking results, trade by trade, week by week. And now I want to help you get your own success. Now, before we go any further, let's quickly recap. You've learned how to spot pulse bars, how to place profit packages, and how to manage trades and stack wins, and how to grow your account safely with just 15 minutes a day. Now, the question is, what are you going to do about it? Because it's decision time. You've got the strategy, you've got the rules, you've seen how to make it work. So now, what do you do next? This isn't a theory session. This isn't a watch and wait situation. It's about execution. And if all you do is keep watching webinars and YouTube and TikTok, nothing changes. But if you take action, you've got a real shot at building something powerful. Now, think about this for a second. Where will you be in 12 months if you keep doing what you've been doing? Will you have the same results you want? Will you have that consistent income machine working for you, or will you still be stuck guessing, over trading, and hoping? As I see it, you've got 3 choices. 1, do nothing, close this down, walk away, stay where you are. 2, try to piece this together, rewatch, take notes, maybe eventually you get it working. Or number 3, let me help you. Install the system, get it working in days instead of months, and start trading with clarity and confidence. Let me help you so you don't have to figure this all out on your own. Now, today I've shown you one piece of the puzzle. There are 7 other money-making patterns that we use out there to complement what you've seen. And if you want support while mastering this, then we'd love to help you. This is a complete rules-based trading system that lets you potentially generate daily and weekly income using pulse bars, profit packages, and our mechanical entry and exit rules. And we would love to help you. The system works, but it works even better with guidance and feedback. Now, we pride ourselves on our student success rate. And if you're the right fit, then we'd love to help you get there. But the program is not for everyone. I'd honestly rather you not join if it's not the right fit for you. And here's what I mean by that. This is for you if you want a structured, rules-based strategy. You don't want to watch charts all day. You'd like to trade part-time without being glued to your screen. And if you're ready to follow a process and stop guessing. This is not for you if you are expecting overnight millions, you're addicted to meme stocks and moonshots, and you can't follow rules and prefer trading based on feelings. If you cannot commit to a simple process, then this is not for you. So who here is still with me? Who here is still with me? Let me see. Awesome. Because if you are still here, I think you know this is probably something that you've been looking for. So let's talk about how you can get started today. It's all through what we call the SPX income system. This is a complete self-paced course that walks you through everything, basics to automation, to risk management, to mastering every single trade type, including the one we just covered. designed to take you from zero to confident execution. And the first thing that you're going to see that you'll have access to is our 5-day boot camp on demand. So this is walking through theory, strategy, setup, live trade analysis, execution, setting up your chains, and so much more. And then you're also, for those that want to dig deeper and spend more time in the charts, the breakdown, the theory, the Q&A, no stone left unturned. You'll find everything you need in our library, archive, and training suite. And then we've also made this about as simple as possible to get you going and onto the charts with 3 pre-built indicator and workspace templates for TradingView. So no more fumbling around with complicated installs, tutorials, and crazy configurations. We've already built the workspace templates for you. All you have to do is literally copy and paste. And in under 5 seconds, you'll now be able to spot and trade our 3 core setups with ease, giving you all of the visual details that you need to know. So there's absolutely no second guessing. And that is only 3 of 7+ income strategies that you have the ability to learn. So imagine the possibilities here. Now, our motto is leave no trader behind. And that's why we run a live members only Telegram room 24/7, 24 hours a day, 7 days a week, where our students ask questions, they get answered. We discuss setups, entries, wins, losses, occasional bad jokes here and there. We are a community and we help each other. And as already mentioned, we're including additional SPX income strategies, complete with entry exit risk strategies for those that wish to be more active, those that wish to be more passive, guides, case studies, daily market analysis updates, and so much more. And for those that get started today, you're going to have a full access pass to all of our future live boot camps that we hold online. Now, we're not done yet. For everybody who joins in this workshop today, we're now including bonus tag and turn alerts. Tag and turn alerts for SPX and XSP. You're going to be grandfathered in for 1 year of alerts. You're going to get everything you need, the strikes, the expiration, the premiums, everything we need from entry to exit. That is going to be included in this package today. So here's your offer and how you can get started with us today. Our 5-day SPX income bootcamp on demand, complete strategy archive and training suite, 3 pre-built indicator workspace templates, members only Telegram room, 7+ additional strategies, all of our quick start guides, case studies, and more. Total value well over $6,000, but we're not going to charge anything close to that today. We are on a mission to create as many successful SPX options traders as possible because we believe in our program. We believe in helping our students, and we want you to start trading with confidence and start getting real results as early as tomorrow. So it's not going to cost you $6,000 to join us. It's not going to cost you $4,000. It's not even cost you $2,000 to join us. For those that are serious, ready to quit tire kicking and take it next level, you can get started today by going to spx.t2markets.com. This is a one-time payment of $14.97. There's no renewals, no subscriptions, no additional fees, lifetime access, and you're now going to get 1 year of our TNT alerts. So you can head over to spx.t2markets.com, get started. The only wrong choice really here is doing nothing. And if this resonated with you today, then trust that. Because a year from now, you'll be looking back at this moment as either the day everything changed or the one you let slip past. Get started today. Now, I don't think that it's a coincidence that you're here today. You've made it this far because this has spoken to you, and now it's your move. So you can get started by going to spx.t2markets.com. There's no reason that you cannot become a success story like hundreds of our other students, and we can build this together. The tools are here. The support is here. The results speak for themselves. You just need to take the first step. So you click the button, choose your path, and let's start stacking wins together. So here's your offer, guys, spx.t2markets.com. I've got a few minutes here. And so what I like to do is go over some frequently asked questions. These are ones that come up a lot. So what amount of capital is needed? So you saw a student start with, what was that, $700 or $800, turning it into $2,700. You can do it technically with under $1,000. We generally recommend, $3,000 to $5,000. If you're trading SPX, you can get started with, $500 to $1,000 if you're trading XSP, which is the micro version of SPX. What about pattern day trade rules? I've got several answers here. One is supposedly the PDT rule is going away, I think, at the first part of June, so we don't have to worry about that. In the meantime, you can open up a cash account rather than a margin account. You can keep your trades limited to 3 in a 5-day rolling period. Or lastly, you can utilize one of our prop partners who allow day trading options with their firm. So you can access capital up to $250,000 of capital, and that is the alternative there. Is this day or swing trading? It's both. So what we just talked about over the last 45 minutes is a day trading strategy using 0 DTEs, but we also have strategies that go out to 7 DTEs. We have people using this in other markets, which actually leads to this last question here. Can this be applied to other markets? Yes. So we've got students, including myself. I like to trade this on ES options on ES. You can trade it on MES. You can trade this on NASDAQ, MNQ, crude, gold, bonds. We've got students that trade these on some of the Mag 7 stocks. I can work on any market in any time frame. Do we offer a guarantee? So do I offer a guarantee that you're going to make hundreds of thousands of dollars starting next week? No. Okay. I do not guarantee that. But what we do guarantee is that we stick by our motto that no trader is left behind. So if you run into any issues, problems, you run into a bump in the road, you need assistance, we are here. We are a community. We truly believe in helping our students. We want to see you succeed, and we're all doing this together. And so we do guarantee that we will continue to help you out should you need assistance. So here's your offer, guys. spx.t2markets.com. That's how you can get started. You can you can finance through PayPal if you wish. Do a direct purchase or finance through PayPal. You can also, if you need to ask me any other questions or need assistance, you can go to support@t2markets.com, and we can get all of your other questions answered. So I'm going to look here in the chat quickly. Do we provide the exact trades by text alerts? We do not send SMS text alerts. We did that in the past, and we ran into issues because some certain carriers were blocking messages or wouldn't allow, or somebody would not get the alert in time and they'd be frustrated, which is totally out of our control through different carriers. So what we do is, one, if you have the indicator, you can set alerts on that indicator yourself to get alerts sent to your phone or your email or pop up on your computer, however you design that. We are sending alerts on the swing version, the TNT swing version. We send those out in Telegram. And so if you're familiar with Telegram, you can put that on your phone and be alerted, when setups happen and things like that. You don't need to be glued to your screen. Okay. So you'll generally have plenty of time to get into the trade. We're not sitting here hyper scalping off of a tick chart. Now there are 3 kind of core bread and butter strategies that we trade in the morning time. In the first 20 to 30 minutes, in the first hour, we look for these pulse bars, the strategy that we just went over in the first couple hours. Now we do have strategies that you can essentially trade them all day on different time frames if you wish, and you can also Um, we have other strategies that we look for in the last hour of the day, overnight strategies, so on and so forth. So it's very flexible depending on, your situation, what you want to do. We've got people, that work full time. We've got people doing trading part time. It's very, very flexible. If you could spend, again, 10 minutes a day or just wait on our alerts 10 minutes a week. If you're really lazy, which not a bad thing, it might just be that is your style. So, yeah, so the indicator is for trading view. Trading view, you don't have to have the indicator. You do not have to have an indicator. You're going to learn the rules, the exact rules of the strategy, so you can technically go any firm and just place that trade once the strategy sets up, the rules are met. But TradingView is the platform that we've built the indicator workspaces for. You can use the free version. You can use the free version. I believe it allows you up to maybe 4 or 5 indicators. You can use the free version. The basic version is like $12 a month. Yeah, if we get it built for others like Thinkorswim or TradeStation, those will be included. Okay. We're only sending alerts on the swing version, not all of the other strategies. No. Okay, well, I think my time is up. I got you guys back on track. So thank you again, David and Anka, for having me on, the entire timing research team. Again, these are always enjoy coming in and doing these. I appreciate the invite and letting me present these wonderful strategies to your community. And again, if you have any questions, guys, there's how to get a hold of me, support at t2markets.com. Welcome to everybody coming in, and good luck with the rest of today's show and the rest of the week. I know there's some really great presenters and some great education that you guys are soaking in. So find something that works for you, and just go after it. So thanks again, guys. Take care. Talk soon, and have a great summer.
All right. Thanks, I can talk today. Thanks, Silas. Thank you for being here. Great presentation. So
Thanks so much, Dave.
thanks, Silas. All right. So in case anyone missed this earlier, I am live streaming today's event to YouTube. So that means the entire day is archived instantly for you to review at any time. And then as soon as I can, after today is over, I will be posting the individual archives on TimingResearch.com for the whole day. And I'll be doing the same thing for tomorrow and Thursday as well. So let's see, we have 3 more live presentations tonight. Floyd Bradley is up next. Floyd, are you there?
Yes, can you hear me?
Yeah, sounds good. All right, I see your screen is loading. All right. See the slides. Do you want to make that full screen? Okay. Okay, looks good. Are you ready to start now?
Yes, I can start now.
Okay, great.
Thank you very much.
I'm going to start my recording again, and then you can start your presentation. So I am recording again now.
Great. Thank you very much, David. My presentation today is about automated future strategies for NinjaTrader. And in particular, we're featuring the Scalar Bot new version 5.1. It's being released tomorrow. And it's symptomatic of some of our other products. So we can do a deep dive on ScalarBot, but you can also reflect on how it would apply to other of our automated strategies. Disclaimer, I'm not going to read every word, but as you know, futures trading and options trading have large potential rewards, but also large potential risks, etc. And if you do decide to invest real money, all trading decisions should be your own. You should carefully consider whether trading or active investing is suitable for you in light of your circumstances, etc. Quick bio on me. I have effectively had 4 careers from starting as a consultant, and then most of my time was spent in software marketing based in London, where I ran the UK or Europe or international for various NASDAQ companies. And then when I retired, I became to learn about active investing, started with equities, then moved on to options, and finally futures. And I'll explain why I think futures is the best place to spend your time for those of you who don't do it. Anyway, I've evolved into put everything in my career together so that my final career here is in fintech. Basically, I concentrate on futures day trading systems. I design them. I have programmers I've curated around the world who do the development, and then I do the testing, marketing, sales, and support. And we have the programmers also doing support, but they're all based on NinjaTrader, which I'll explain in a minute. But the company's called TradePilot AI, TradePilotAI.com. This is the web page, the home page, and the products can be explored at the second option up there on the menu, and the pricing, etc. So why day trade futures? Because I know not all of you who are watching today are futures traders. This is my own personal opinion because this is how I basically went from stocks to options to futures. In this train of thought, I found compared to equities, they're much more leveraged. You get much more immediate feedback, more profit per day potentially. On a second issue, there's favorable tax treatment. The real thing that I used to like was that you can go short and long just as easy. Buy, sell, buy, sell, buy, sell is just a click of a mouse. Short trading in equities, as you know, you have to borrow the stock. You have to have, there has to be enough shares to do that. There's certain rules, etc. But and additionally, there's thousands of stocks, but there are only really 5 or 10 key instruments for futures trading. The real thing is when you're dealing with equities is worrying about all the things that affect a company's EPS and dividends, etc. And PE ratio, so you get growth rate, profit margins, cash flow, their market share, management strength. You're looking at all that across thousands of companies. That's a lot. Futures is very, very simple, I would argue. Compared to options, I did do options for a couple of years. It took a lot to learn, and my head still mind boggles when I think about all the Greeks and all the complicated versions like put credit spreads and butterflies and iron condors. And, it's a minefield out there. And good luck to you if you can master it. And compared to Forex, which I actually never did try because I was too worried about things I'd heard, some shifty players in the Forex world, offshore companies, not regulated central exchanges in some cases. You don't always get to see a visible order book. You don't get true volume information. To me, it's just a minefield that I would avoid personally. Now, that's why I like futures. Now, why do I like automated? Well, compared to manual trading, you've got rules, and the rules affect the entry and exits. It's not discretionary. It's not based on your whims or your gut feeling. It's based on rules that either you've set up or we've set up for you. And if you don't like our rules, then don't use our bots. Or if you don't understand our rules, ask us. We'll tell you. Very open about it. Most of the rules can be seen right on the screen in terms of the actual visible entry levels and exit levels. Compared to, again, manual trading, automation can be very fast, very precise, especially compared to if you're looking at more than one instrument, scrolling around the different charts or monitors on your desk. The automated bot's doing it for you. Algorithmic trading, algorithmic rules are built into the systems. So basically, you let the bot do the trouble, and you don't have to worry about getting too greedy and too fearful. And you certainly can monitor many trades at once, many instruments at once, because the computer almost has no limit to how much it can handle. I trade 50 charts every day simultaneously, or I don't, my bots do. I couldn't do that manually. And then it's hands-free, so you can go to the kitchen for a sandwich. You can maybe walk away for an hour, come back. You can maybe play golf and come back. I don't recommend it, but I do have people who trade overnight, and they wake up in the morning to see how their results did. So you get that extended trading time where you could literally have the bot working during the Asia Open or during the European Open or other times. Now, a lot of people use indicators, and I don't disagree about using indicators, but we use indicators too. They're built into the strategies, some of the more popular ones. Now, ATMs, for those of you who may not know what that means, that's an advanced trade management system or template from NinjaTrader. It's basically, you can set up multiple targets and trailing stop conditions, etc. And we do use ATMs in some of our bots, but compared to just pure ATMs, automation gets you a faster entry as opposed to a manual entry as well, algorithmic base. And you can scale in as well, which you can't scale in with an ATM. And ATMs make it difficult to backtest and optimize and things like that, walk forward testing even. But our bots are much more able to do that without using ATMs. And then the other benefit of automation is you don't have to be totally automated. You can use the bots to get you in automatically, and then you can manually get out, or you can manually get in and let the bots take you out. So there's real flexibility there. Now, why NinjaTrader? And why am I mentioning this? Because we only develop our systems on the NinjaTrader platform. It's one of the best and most popular trading platforms for automated strategies. Yes, Thinkorswim is a great platform. I used to use it for options, but it doesn't really allow automated strategies. And there are many companies out there that offer trading with indicators, but not all, like TradingView, but not all automate the way NinjaTrader allows you to automate. Plus, it has a programming language built in called NinjaScript, which is very close to C#. And a lot of programmers around the world know how to use NinjaScript, C#. And I've curated from dozens some very skilled NinjaTrader programmers that work on behalf of TradePilot AI. We are also an approved ecosystem vendor for NinjaTrader, which takes a long time to get approved. I think about 6 months it took us to get approved, and it took about 6 months of trading to prove that we were in it for the long term. And then they invited us to present, and it's on YouTube at that link there, presentation we made late last year. In terms of our company's offerings, we have services and products, and I'm going to go on to the products, but that's my main focus today. But just quickly on the services, we have the Sunday Education Program, Futures Trading Club, the Bot Optimization Lab, and private consulting one-on-one. Futures Trading Club is mainly where I spend my time in terms of services, and it's a free trade room. We've been using Zoom for the last 2 years. As of tomorrow, we're going to be also simultaneously using YouTube Live. I did 3 of these last week as a test, and it seems that I've got it down now, so it's going to work fine. So it'll probably give you a choice of 2 ways to watch, but it's the same thing. We run all 10 bots on 5 instruments, so that's where I get my 50 charts from. We run across 2 laptops, And so I swap between the two laptops in terms of zooming in, zooming out of different trades, the ones that are active, the ones that are making money, the ones that are showcasing the way the bots are designed. We start at 9:15 with a short PowerPoint presentation, then go live at 9:30. And it's pretty much hands-free. I do a little tweaking here and there with, if I see a target that looks too far away or I see a stop that looks too far away, I might tighten them. But for the most part, it's hands-free. And that meeting ID passcode has been not changed in 6 months, so it's good for the rest of this year. And our YouTube channel is very clearly marked Trade Pilot AI, and that's where the live will be starting tomorrow. So moving on to products, we have 9 showing here. We have a couple of indicators, but these are our 9 automated strategies. We just added a 10th a couple of weeks ago, which is a pain because now I can't give you my 3x3 matrix anymore. Now I have to figure out how I'm going to present the 10th on the screen. So the good news is we're working on 2 more bots between now and the end of 2026. So we should have 12 by end of year, and then I'll have a nice 3x4 matrix or a 4x3 matrix. But the last one we've introduced is called VWAP bot. It's based on bouncing off of the price bouncing off of VWAP, and I'll show you a screen of that in a minute. Now, just as an aside, again, for many of you who don't know futures trading or have been tempted to try it or have been hoodwinked by people selling black box systems, the market really is based on or breaks down into 2 groups: black box strategies and white box strategies, and try to explain that. Black box, meaning the logic, indicators, algorithms, rules, processes, whatever. It's a secret sauce and it's hidden from you. It basically is proprietary to the vendor, and you really can't change it, and you can't necessarily they won't even tell you what it is. For the most part, you have no control over the settings. You have no ability to change the settings. You either use it or don't use it as they give it to you. And I find them quite mysterious. They're very aggressive marketing on Instagram and TikTok, and our bots are AI driven, etc. You look in the small print, and very often the terms and conditions are from a company that doesn't match the name of the company that on the first page. Offshore or unregulated exchanges, mainly dealing in Forex. And normally you have to allow the bot to run on their server. It's tied to your brokerage account, but it's running on their server. So you really, have no control over it. White box is what we specialize in, or we and our other futures competitors, where the logic is transparent. The rules are obvious or can be explained in the the user manual or the getting started guide that we supply for free. Every setting can be adjusted by every single setting. Now, you may say, well, why do I want to spend time working on settings? Well, the problem is no one setting is good for everybody. You've all got different risk reward profiles. You've got different margin accounts, prop firms versus cash accounts. You've got different styles. You have different favorite instruments, favorite times of the day. But the nice thing about all our strategies is you can choose any instrument, any chart time frame, any time filter, any account daily goal and account max loss, any number of contracts maximum, and the way you enter those contracts all at once or scaling in or piling on or whatever. Most of these are all adjustable by you. It also means that there's a lot to test and a lot of permutations, and that's the downside. But we find it very educational for our users to try different settings and see how back testing and forward testing changes according to your different settings. And again, most of the white box apps are for futures, not for Forex. And most are traded on your own CPU, your laptop, your desktop. Or if you use a virtual server, you can use it there. Now, going back to the 10 strategies that we offer, this is actually in chronological order of our introducing TrendBot 2023 and VWAP bot a couple of weeks ago. So I didn't put it in order of style or characteristics, but you can see there are a couple of trending strategies: trend bot, bouncer bot, squeeze bot, ATM bot, pretty much fall in the category of a trending software, trending app. So they do better in trends. And then you have the opposite, more mean reversion oriented strategies. Scalar bot a little bit, reversal bot definitely, reversion bot definitely, VWAP bot definitely. Scalar bot, which we'll talk about more since I'm concentrating on that today, does best in a sideways marketplace, but can also take advantage of a trend when if there's a breakout from the sideways movement, if you have a particular button that we offer called reentry on or off. But if you have it on, it actually does well in a sideways market and does well when it starts to trend one way or the other. Auction bot is an order flow strategy, rather unique to us. I don't know anyone who has that, where it identifies unfinished auctions and targets them. Breakout bot is quite common in the marketplace. Ours looks very similar to maybe others if you've ever used them. Squeeze bot is pretty rare. I'll talk about that in a minute. ATM bot, for those of you who use ATMs, is pretty obvious. So just a single screenshot of each of the strategies quickly. Trend bot is a trending bot. For those of you who don't know NinjaTrader, when a trade has successfully made a profit, it shows up as typically a green dotted line here. That's per contract, or it's red dotted line. Normally, I mean, you can change the colors, but this is out of the box. A red dotted line would be an unprofitable contract. So here you can see 1, 2, 3, 4 green dotted lines. There were a couple earlier in the day. You can see maybe upper, but basically that's kind of what a good trend bot trade will look like. And then a scalar bot, which again, I'm going to focus on this in a while, but it scales in and scales out. So right now, if you look at this, is it's still like a snapshot of a live trade where you can see that we're in with 2 contracts and there's a target at the top. But if price retraces, it might pick up another contract, scale in, and lower the average cost. And then hopefully it bounces back and you make even more money. And I got this set up for a maximum of 5 contracts, which is all my charts I've standardized on just a 5 contract maximum. And you can see this one has already traded, 1, 2, 3, 4, at least 4. Oh, there's even more. I don't know if you can see it, but in that red bar, there's a green line up and down. That's like a profitable trade within a 3-minute candle. Bouncer bot's very similar to scalar bot, except instead of bouncing off of or taking pullback entries off of fixed ticks or fixed ATR, takes it off of the moving averages, which, as you know, can vary. But this will bounce off the 8, 21, or 34 moving average, and you can see based on the green dotted lines where it's bounced off some of these lines in the past, and it's made 1, 2, 3, 4, 5, 6 profitable trades so far. So it's like the scalar bot related to the scalar bot in that sense. Reversal bot works on a pivot concept. You can see in the middle of the chart a red arrow where the yellow candle basically signified that price was going down, and then the blue candle and then followed by the green arrow is where a reversal candle suggested price was going up. And then we have it tied to an ATM, so you can see the 3 green price targets and the trailing red stop losses, dynamic stop losses. The auction bot, the bright blue cyan line is a target. It's an unfinished auction. The actual targets are a little bit, in this case, a little bit before that. You can see a couple of profitable trades, 1, 2, 3. But you can also see 1 negative trade there. Not every contract makes money, but this red candle is going down, so it probably did. Again, these are from our live trade room, the Futures Trading Club. All of these are snapshots. When I think it's a good example of a typical trade, I'll take a snapshot. Breakout bot, You can set targets according to percentage of the opening range. In this case, I've got a 30-minute set. You can set for 15 minutes or 60 minutes or whatever you like. And then you can also, manually raise stops or have a trailing stop. You can also have an ATM if you'd prefer, or you can set fixed prices, targets and stops, trailing stops. Well, three choices there. Squeeze bot is based on John Carter's concept of the squeeze, which is the interplay of Keltner channels and Bollinger Bands. We developed our own squeeze indicator. It comes with the product, which is the lower pane here. And you see when the red dot becomes a green dot, that's when the squeeze is fired, and that triggers the entry. And you can see the trend obviously continue. Normally, after a squeeze, you get a pretty consistent momentum. In this case, to the downside. Sometimes it's to the upside, but the squeeze normally indicates that. So that's a fun bot. Reversion bot is based on price bouncing off of the second standard deviation or the third standard deviation, or whichever way you want it to bounce between the two, or it's flexibility. But here's just an example of a reversion bot on RTY. Successful trades 1, 2, 3, 4, 5, 6, 7 or so, up to $1,300. Maximum, again, 5 contracts. ATM bot, again, an ATM normally shows up as a red stop and a green target. And we just have this done on a simple moving average. When the fast moving average crosses the medium moving average, enter. It kicks off the ATM, and then the ATM has a trailing stop built into it. And you can have higher time frame and other filters. The VWAP bot is the last one that the most recent that we've introduced. It's been our most profitable in live trading recently, so we're happy with that. And it's based on bouncing off the VWAP, as opposed to the bouncer bot, which bounces off of moving averages. This one, price comes down to the VWAP or VWAP plus an offset, depending on how you set it. It will in this case, go long. Bounced, came down, took another long trade, got a couple more. Again, I don't know if the trailing stop was on or whether this has to be moved manually, but you can see it. Next step would probably be to move these 2 stops manually. So that gives you a good example of the full portfolio of our 10 strategies. Anytime you want to look at these in a live environment in terms of, or a video of seeing them perform over time, during the day, normally 9:30 to 11, we've captured over 270 videos, and we now have 13,500 subscribers. Check how many subscribers your other vendors have. So turning to ScalarBot now, we've introduced version 5.1, and that's being released tomorrow. We had 5 beta versions of the product over the last 3 months, testing it and adding a few more bells and whistles and making sure it was debugged. So it's partly because we're introducing the new version tomorrow, but the other reason why I wanted to focus on ScalarBot was that it was our second product. So out of the 10, it's the second oldest. It has the second largest install base. It was our single best selling strategy in the year 2024, which was the first full year it came out. And more recently, because I record every trade in the Futures Trading Club every day, all 50 results, I can tell you that ScalarBot on the ES and RTY were profitable for the first 4 months of the year. And it's also, I think, one of the more easy to understand, easy to learn, easy to trade strategies, because I just think it's very intuitive. And I'll show you some more examples and hopefully you'll agree. I mean, Breakout Bot's very intuitive, and so is ATM, but basically ScalarBot, I like to showcase it because it's normally easy to understand. The history of the product, it's 2.5 years old, and we keep updating all our products. And we don't always release intermediate beta versions because we don't want to flood or confuse everybody by coming up with weekly releases. So we spread them out every 3 or 6 months or roughly, and try to keep adding features and keep our bots also consistent. So we add one feature we like in one bot, we'll try to add it to all the other bots. The enhancements for those who have 5.0 are the following. For people who don't have scalar bot, almost doesn't really matter. I'll show you more the full length of capabilities later. But if you have 5.0, starting tomorrow or later this week when we get it out, it now has the option to stop trading after so many trades that you configure. So let's say after 5 trades, I don't want to trade more than 5 trades, or I don't want to trade more than 8 trades. So you can now exit on that basis. And we're adding this capability to the other bots too. Or you can say after 3 consecutive winners, I want to get out. It's like I don't want to push my luck. Or the opposite, after two consecutive losers, I don't want to continue trading scalar bot today. Or maybe 4 is too many, or whatever. But you have a chance to play with these and now put in those kinds of restrictions. There's a slight variance here. They look the same, but this is slightly different. The scalar bot now, you can say, I don't want to re-enter more than X contracts or more than X times. Slightly different. Sometimes one will trigger in, not the other, or vice versa. And then we've added another one, which is Monday through Friday. So, and our Monday includes the Sunday night, the Globex Open in New Zealand. But basically, you can say, I don't want to trade on Mondays and Fridays, and you can literally uncheck the box, and even if you walked away for a week, it'll trade Tuesday, Wednesday, Thursday, but not trade Monday, Friday. We've added 2 more higher time frame filters, so now there are 3. I think that the default we ship it with is like a 30-minute, a 1 day, and a 1 week, but you can make it anything you want. We've added a couple of chart trader buttons, modified a couple. We have much more clear on-screen messaging for the APP and TPP. Improved error handling, which is always an issue with the prop firms and market replay versus live, and different quirks in NinjaTrader. Added a couple other small enhancements that are not visible to the user, and we fixed a few bugs. So that's what the 5.0 users are going to see different starting next week, starting later this week. All our bots have these money management restrictions, which give a lot of flexibility. You can set an account daily goal, like, if you get to $1,000, stop. Because sometimes, you get to $1,000, the next thing you know, you've gone into the red. Or, depending what size your account is, stop at 2,000, stop at 1,500. I actually stopped the Futures Trading Club I have it set for 2,250 because I'm trading 5 minis. But maybe that should be 3,000, maybe it should be 2,000. I'm always tweaking it from month to month, trying to figure out the best way. But that's what account daily goal is, and the corollary is the max loss, which is probably more important, which is I don't want to lose more than X per bot or per instrument or per bot instrument or per account. I'll explain the difference between account daily goal and strategy daily goal in another slide, but those are 2 important elements as well. We have at a lower level, you can say, if a trade gets to X amount, get out. If a trade loses X amount, but your bot is still active and you still will enter new trades, but you're just kind of, getting out at a lower level, even though you're still will take new entries. And account profit protection and trade profit protection are very powerful additions that we've put into the products. I'm using account profit protection more and more in the Futures Trading Club, where let's say your account daily goal is 2,000, but you could say, if I get to 1,500, I don't ever want to go back more than 20%. So the worst I can do is if it's doing well, is to make 1,200 instead of watching it go to 1,500 and then go back to 0. So you might not get to your daily goal, but you may at least salvage a good run. And account profit protection will close you for the day. A trade profit protection will just close you for that trade. But if you still haven't reached your daily goal, you may re-enter. So that's the distinction between those two. So an example where strategy daily goal is different than account daily goal is you, for example, doesn't matter. Let's just look at the cash account example here. But you could have an NinjaTrader, you can have a chart that has multiple tabs. It's one account, but it has multiple tabs, and one tab could have TrendBot working on NQ, and the second tab could have ScalarBot working on RTY. Now, your account daily goal might be 5,000, but what happens if RTY with ScalarBot starts to lose money? Well, you put your max loss for that strategy, that tab, that chart, or sorry, that bot instrument combination, and you get out at 1,000 loss, but the other bot with the other instrument keeps trading and maybe makes up for it. So this is where you can have like multiple tabs within a chart, or within the account. Quit when they get to their target or quit when they get to their loss, but the rest of the bots keep working. And then account profit protection. In an example like this, maybe you have like at 3,000. Yes, my daily goal is 5,000, but once I get to 3,000, I don't want to lose more than, I don't want it to fall back below 2,700. So that's what that does. And then the prop firm account, normally the numbers are smaller because you're dealing in 50K accounts or 100K account or something. But the principle is the same. Maybe you don't use trade goal and trade loss because you're dealing with micros or dealing with smaller numbers, but you have, this is why there's no one setting for everybody, because different cash accounts and different size prop firm accounts will have different recommended settings. So I did show an example of a scalar bot screenshot when I showed you the other 10 bots, but let's just look at one more here. Remember I said that the green dotted lines represent profitable contracts. Well, let's look at this. This is a real trade from the futures trade room. My CPU is on California time because I lived there for 16 years and I learned all my futures trading there. So I still have my laptops on California, but this is the 9:30 Eastern, and then I have the bot goes on. What is this? This is RTY. I have the ES scalar bot going on at 9:31. NQ goes on 9:32. RTY goes on starts at 9:33. So you have these time filters you can have automatically starting at staggered numbers. I just do it that way because it's kind of fun to watch, and trying not to necessarily trade it exactly at 9:30 when the first minute or two might be quite wild. But in any case, if you look at these green dots again, here's a profitable contract. Here's a profitable contract. Here's 3. There's 4. There's 5. There's 6. This vertical one is 7. That's 8. That's 9. That vertical one's 10. That's 11. That's 12. That's 13. There are 14 consecutive trades, not a single loss here. Yeah, this may be a good example of a perfect trade, but this happens a lot. And if you trade, log into watch the Futures Trading Club, it's a silent trade room, but the bots are doing all the talking. Um, um, and we have in the lower left-hand corner the cumulative P&L, gross and net of commission for the day. And it's at 1615 right now. And I've got my account high water mark at 1750. So when it just gets up to 1750 net of commission, then the 10% drawdown kicks in. So the worst it can do, other than slippage, the worst it can do would be 1750 minus 175, which is forget 1625 or something. Anyway, this example of what a scalar bot can do, and even though I said it's based on it's designed for a sideways market, this market's been trending. You can see the 8 EMA has been rising. All the trades have stayed above the 8 EMA, which means it's a strong trend. The green background means the MAs are all in alignment. Oops, sorry. And yet it's still making money. And that's because this button down here, RE on, it's called re-entry on. And if you have that on, I keep it on. It means if you make your first target, you basically re-enter again. If you make your contract, you enter again. If you make your first contract, your first target, you enter again. So it will keep entering. And we've now started keeping track of that. If you look on the upper left-hand corner, it says trades 8-0. So we've had 8 consecutive winners here, not just on the contract, but that's based on how many first targets were hit before the re-entry re-entered. Now we have changed. This was like beta 3, and we've changed this now. So instead of 8, it's just slightly different in terms of the way it's laid out, but it still will count the number of consecutive wins, for example. Okay, so let's go through and do more of a deep dive here. When I sent out an email invitation to this webinar, I included these links. I didn't label which instruments they were, but when you get your presentation sent by Timing Research, this will be in the presentation. You can click on these, but let's see if I can do one here. They're all based on our YouTube channel. So if you want to actually watch these working, or to see how they were recorded in a live environment. So I have sped these up sometimes so that you don't have to spend 20 minutes watching a 20-minute trade. You can, but right now I'll just explain this one. The background is red because you have the choice of turning the background color on or off, and it's based on the moving averages. Okay, so this was at 9:31. No, what is this? Yeah, ES 9:31. It took a bearish trade because the background was red, because the 8 EMA was below the 21 EMA. Generally, that's a good rule of thumb. It doesn't always work. There's already been two profitable trades. You see the horizontal green dotted lines. Those are profitable trades within the first 3-minute bar. And the target is down here at the bottom there. Now there's a second target because it just scaled in with a second entry. And if it retraces, it'll scale in a third, fourth, and fifth. But if it continues to fluctuate and continues to go this way, now we've just banked another contract. If you look in the lower left-hand corner, you're up to $900 gross, $800 net, and it's continuing, etc. So these videos are there. All our bots have video examples, but that was just an example of off of the slide presentation. And now, of course, I got to get back to it. Okay, here. So just, that was a bearish trade. Here's an example of a bullish trade. This NQ. And then again, this is right off our YouTube website. So although it's green and it's taking a bullish trade, the candle's red, but that just means there's some pullback and re-entry against the longer term trend. And that normally works in your favor because you're buying at a lower, it's costing you less. You're lowering your average cost per contract. And then again, you can see the buy lines are in the retracement area and the sell are in the trend continuation area. So, it's a pretty simple concept. And ultimately you have a stop down here and the stop, if it's 2 contracts, the stop will become 2. If it's 3, it'll be 3. It's a dynamic stop. Or you may get stopped out by your max loss. Or I'll talk about different stop strategies. Right. So I'm not going to go through the others, but that gives you an example if you want to look at them yourself. And now I have got to get out of. I always have trouble getting out of YouTube. Okay, let's get back. Okay, so we're back to where we should be. So there's some more examples if you want. For those of you who don't know NinjaTrader, this may look complicated, but this is a great cheat sheet here. It's really easy to install a strategy. You go to
Hello, everyone, and welcome to another edition of the TradeStation Trading App Store Showcase.
Oh, sorry, that's YouTube. I'm sorry. I got to get rid of that. Let me see if I can get rid of YouTube here. I apologize.
Carter. So the
Sorry.
longtime friend of TradeStation. He's a
Okay, I apologize. I'll get back to where I should be here in a second. Let me. Okay, let me blow this up here. All right, apologize for that. Good thing I caught it. Basically, it's easy. All automated strategies install the same way for NinjaTrader. Tools import. Then creating a chart's really easy. New chart. Choosing your instrument. You have a drop down ES, NQ, RTY, etc. Normally, there's a default expiration date like June 26th, but sometimes you can change that if you want as well. And then you choose your chart time frame, 3 minutes, 5 minutes, 10 minutes, 15, 1 minute, whatever you like. You can also do, Unirenko and range charts and tick charts, etc. Then to configure a strategy, you go to the strategies option, and then you choose your strategy. If you have one bot from us, only Scalar bot will show up. If you've got all 10 of our bots, you'll have a pick list of 10 bots, and then you add the one that you want. You then need to choose your account. Is it your Apex account? Is your Tradeify account? Is your Buellnox account? Is it your Live account? Is it your Sim account? You choose which one you want the bot to trade. And then it gets trickier. Now you got to set your properties, and I'm going to spend a few pages talking about properties. But once you've set that up, you save your properties as a template, so you can come back to them later. You can have multiple templates, so you can have different permutations and test them out, live or sim. And then basically you connect to your live data, either your own like brokerage account or your Rhythmic with Apex or whatever, CQ, whatever. And then to activate any strategy in NinjaTrader, you go to the strategies tab and you check the enable box, and that basically you get your bot's active at that point. It's right. So in terms of properties, which I said is a more complex subject, there's so many properties you can choose in a NinjaTrader strategy that we're not the only one who has this issue, which is how many options do we give you? On the plus side, I'd argue we give you as many options. We give you probably more options than any other vendor. I mean, for example, we have up to 6 time filters. I know some vendors have 1 time filter, some have 2. A few have 4. I'm not sure anyone's got 6. Whether you need 6 is another story, but we don't want you to say, well, I'd like to do 5, and you never made the option. Anyway, so that's there. You can choose Eastern time zone or your local CPU time zone, and there are benefits. I like to use Eastern because sometimes I'm in California, sometimes I'm in Florida, sometimes I'm in London, and I don't have to worry about changing my times according to where I am. I basically, or changing according to what computer I'm on, I just use the Eastern. Direction is pretty self-explanatory. Normally I have it on both because I don't know whether the market's going up or down in the time filter I'm using, but you can also choose long only or short only if you have a strong view that it's going to be a bullish market this week, or it's going to be a bearish day tomorrow based on yesterday's results or something. NinjaTrader has this concept of start behavior. It's a little bit esoteric, but basically we offer 2 options. Immediately submit pretty much looks at the entry trigger criteria and immediately will enter based on whether the criteria are filled or valid, and wait until flat. Normally waits till kind of a reversal or anyway, you'll understand it more if you've never used NinjaTrader as soon as you start using it. Then you set your maximum number of contracts that you want to trade. Some of the bots have choices for how you enter, some do not, but basically it's bot specific. And then the trigger can also be, you can enter manually, you can get out manually, but you can also let the bot trigger both the entry and the exit, which is what most of our users do. And then you've also got profit targets, stop loss, trailing stop, break even have to be set, or you decide not to set them. You choose whether to use filters to you minimize the chance that you're trading counter trading or trading against another phenomenon that's going on. And then we have other bot specific options and settings and various display options. You can turn these on or off, etc. And plus all the money management restrictions I told you about earlier. As an example for ScalarBot, we have this thing called the equidistant category. I'll show it to you quickly on the screen later, but it allows you to set most of your targets and stops just using the first number here, 1. It's how many contracts will be in your first target. 20, how many ticks will be your first target. Then this third one is how many contracts will be in subsequent scale-in levels. Then the next number is how many total levels do you want to enter it? And then the next 20 is how many ticks should each and each new level be, then 20, what should be the target, and 40, what should be the initial stop loss. Anyway, it looks more complicated perhaps than it is there, but believe me, almost all the settings are all based on that issue there. And we give recommendations when we deliver the product. We have like a 15 to 20 page user manual. We have a 2 to 3 page getting started guide, and we have a 2-page installation guide. We have, and then I'm available on email to give people additional help. And then dynamic stops, you can choose to use these or not. Trade goal, trade loss, you can, all these are optional. And now we have the new one about exit after end trades. So there are many ways to get out. You can get out by a daily max loss, get out by profit, get out by X number of trades, get out because of stop loss or trailing stop loss. This right now is the example of what I'm using for all the bots when I use 5 minis. I'm putting a daily goal of 2250, account max loss of 750. That's a 3-to-1 ratio. Some people might feel more comfortable with a 2-to-1. So you could have 1500 versus 750, or you could have 2250 versus 1125, and you can play with these and see how they work. And account profit protection, that's the one I've found to be really useful this year. The trade profit protection, I'm still working on that. That's not really relevant for ScalarBot. So I'm not going to go through all these, but this is what a properties page looks like in NinjaTrader. This is where you change your settings. This is the first page of 11 pages. We ship the product with everything already filled in, but it doesn't mean everything filled in is what is going to be what we recommend you trade. But it made 90% of these different numbers and colors and settings don't have to be changed. We've already got them for you. When I talked about the equidistant, I'll show you right now, like this page here looks complex. Don't touch it. This page looks complex. Don't touch it unless you're going to really get to the engineering level and you're going to be working with minutia. But we have at the top right here, the top half, this is that equidistant. There's that 120, 15, 20, 20, 40. As long as you have those 1, 2, 3, 4, 5, 6, 7 lines, you don't have to do these next 2 pages. It's just a way of making it easier for you. And then you've got your, account profit protection, your trade goal, your account daily goal settings. Then you have your time filters, 6 time filters, including 2 of them that go down to the second, not just to the minute. Then you've got whether you show VWAP or not, whether you have a squeeze filter on or not, whether you have a VWAP filter on or not, higher time frame filter here. Remember I said we've added 3 now. So you have a 60-minute time filter, a 1-day time filter, or 1 week, whatever you want to basically narrow down the settings, the environment that you want to be trading in, etc. So that gives you an idea of how you set your settings. Let's see, I'm running 15 minutes, 14, 13 minutes maybe. In terms of back testing for settings, you can do this. We do it a lot through our bot optimization lab, and we try to communicate as much of our new findings to our users. But people who know NinjaTrader know there's 2 ways to do back testing. One is the strategy analyzer, and one is playback with market replay data. We do not recommend strategy analyzer because it only deals with 1 minute price bars. And as anyone who's ever traded scalping strategies or manual scalps, et cetera, 1 minute, a lot can happen in 1 minute, especially with, let's say, NASDAQ, MNQ, and NQ. The strategy analyzer does allow optimization, but we have found the optimizer doesn't give you good results because of the 1 minute price bar issue. So we concentrate using playback with market replay data, which is based on tick by tick price data within each minute candle, for example. It doesn't allow automatic optimization. You have to triangulate with your optimization, so it's a bit rather tedious and painful. But that's what we use, and I'll show you some of those results. Clearly, the ultimate test is forward testing, and that's why we're trading all 50 bots every day. All 50 charts, 10 bots times 5. So we have literally a mathematical data set of everything that we've traded. And then obviously the ultimate is your own cash account or prop firm account. This is the process for using playback with market replay. I won't go through it all, but it's very tedious. But this might be helpful for those of you who want to learn how to use market replay data in a backtesting environment. But there is a lot of triangulation and triage and iterations, manual iterations. It makes it rather difficult. And we have lost a lot of blood, sweat, and tears working on this to make our users more successful. These are the main backtesting metrics we look at: the net profit, absolute profit factor, the drawdown as a percentage of the net profit, the average trade value, gross and net, number of trades, what percentage were profitable, and what's the win-loss ratio, what's the expectancy. Again, if you've never used NinjaTrader, these will be somewhat new to you, but I've got 4 examples where we backtested ScalarBot using different settings, and I can email people the settings if they want, but basically I'm just calling this A, B, C, D settings. But this would be, for example, a quick chart to see. This was the month of April, so the month literally just ended. How did ScalarBot work with the ES? It had 1, 2, I'm looking at the green bars here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 14 profitable days and 7 unprofitable. The cumulative of this number, you just change net profit to cumulative net profit, and you get the equity curve. It's not the best equity curve I've ever seen, but it is profitable. It has gone up, hasn't gone down too far. You have to say, okay, that setting's not bad to start with. Maybe let's tweak it. And that's how you work through this. You get your actual stats here, profit factor 1.4, which is pretty good. This drawdown 6 compared to 13, that's not, the graph doesn't look as bad. The numbers don't look great, but 53% profitable, and 244 trades. That feels about right in 1 month. Yeah, you go through these things and get a feeling for what you like and don't like. Here's example B. This was also ES with a different set of settings, where I did not have account max loss. Again, more green than red, but also you might say, well, let's put in a max loss amount because this is these losses here are too great. And by the way, if you're using micros, just divide everything by 10 or use a different number of minis or different number of micros. And that was the equity curve based on that daily chart. And here are the numbers behind it. Profit factor 135. Example C. Here I did put in, I think, max loss, account loss or whatever of 750. This is RTY, not ES. And you can see any day it hit 750, it cut off. Why are the numbers not exactly 750? Well, because of slippage. But I had no daily goal on this account. So you can see some of the days were very profitable, which helped, sorry, this was a C, right? Let me go back up. Yeah, so see, so that I gave this kind of an equity curve, and here are the stats. And then this example D, again, this was one, I didn't put these in order, but this is one where I didn't have a max loss. And this was back to ES again. But in the green, and ES and RTY did the best in January through April and including April. So I got to move on here. Just because I've concentrated on ScalarBot doesn't mean that's the only product that I'm recommending. I would argue that you should possibly consider 2 or 3 of our strategies, and I'm going to give you an incentive here with a big discount coming up to actually think about buying or leasing more than one of our bots. Because once you've learned one, you can easy to use the others. They all have the same time filters. They all have money management. They all have the same kinds of choices for targets and stops, the same on-screen messaging, the same choices for these things. So it's really easy once you're a user of a TradePilot AI product to be able to use another one quickly and not even bother to look at the manual. The way that we price the products and the way that we onboard, we offer lifetime license for $24.95, but we offer multiple ways of leasing the product. And the longer you choose to lease, the better price you get per month. As you work through that, all those prices are on their website as well. The onboarding process is semi-manual, semi-automatic. You purchase on the website using credit card or debit card, sign up as a member, receive the software by email with the documentation. And once you submit your machine ID in the members area of our website, then you can use the product. And we have multiple bot volume discounts available as well. But in terms of giving you more incentive, let me offer these bonus packages here. So anyone who sees this presentation, I guess, who wasn't live watching, you can get a 50% discount on ScalarBot or any of our bots by using that promo code at checkout, which brings the price down to $12.48. And I'm offering 1 hour free consultancy, which is normally $100. And for anybody who sees this, says to me, I want to get my 1 hour free, you've got it. We just have to set it up on Zoom. And then for the webinar attendees who are watching live right now, if you use this other promo code TR2026, we give you a 60% discount, so it gets you under 1,000. You're at $998, again, with 1 hour free consultancy. And basically, you just need to email me or use those promo codes. Sorry. This next one requires an email to me. This is the most aggressive we've ever been in terms of offering something. This top one here. You can buy ScalarBot and 4 more of our strategies. Any 4 that you want, you get free. So basically, it's a 5-for-1 offer, and we're allowing you to swap them. You could have 5 of our strategies and then get bored with one of them, or find one doesn't suit your style or whatever, and you say, I'd like to try another one, and we basically will turn off the lights on one and give you the lights on the other. And I'm giving 1 free hour of consultancy. But there's no landing page for this. You have to email me and just say amazing TR webinar purchase offer. And we have a couple of smaller ones here. These are for leases rather than lifetime licenses, where you can get a 3-for-1, either 3 bots for 1 month price, or you can get 1 bot for 3 months for paying 1 month. And any new user who's never bought a product from us before gets a 50% discount by using that promo code. So again, this is all going to be in the presentation that is going to be available through Timing Research. So repeat of where our website is, where our pricing is, where our YouTube channel is, my email, the Zoom link. Again, this is all in the presentation. So I have like a minute or 2 to answer any questions. I have not looked at the chat. I'm not good at multitasking, so maybe David should have to read some questions if there are any. I'll try to find. Do you see chat? Because I have a little trouble figuring out how to get to chat.
Yeah.
Somebody raised a hand, so I guess that
All
I can view.
right. Someone asks, so we can use our prop data feed like Rhythmic.
Yes, definitely. As long as your prop firm allows you to use automated strategies. I've done a lot of research on this and even have a white paper on it, but some do, some don't. Some say you can use automated strategy if you've gotten approval ahead of time. There are some who say they don't allow it, but they don't enforce it. Um, but technically, there's no problem with using a trade copier or a prop firm. Our bots will work on any data feed.
Can we use micros?
Yeah, absolutely. You can use micros, minis. You can do ZN, ZB. You can do soybeans, wheat, lumber. Well, whatever your NinjaTrader account supports in terms of your brokerage account.
Are the optimization settings shared with us as users, or do we have to subscribe to a different service
No,
for optimization?
we don't charge for that. We thought about that, but we don't charge for settings. But they aren't necessarily optimized in the way that we can say, here is the single silver bullet optimization for everybody. It's going to be more, this is what our bot optimization found from the last 3 months, from the last month. These were the settings that we found worked best in hindsight for, using 5 minis. If you want to use 5 micros or 20 micros, then you have to adjust accordingly.
Okay, great. And I think I got to cut you off there. So,
Yeah, thank you, David.
all right. Floyd Bradley of TradePilotAI.com. Thank you for being here. All right. And all right, so be sure to yeah, hit that link and check out Floyd's offerings there. And all right, next up is Zach Manis. Zach, are you there?
I'm here, David. How are you?
I'm good. How are you?
Doing great. I am ready to get started, I guess, whenever you are.
Yeah, you should be able to share your screen and get set up now.
Okay. Let's go to. There we go. I figured I did not put together a whole PowerPoint presentation. I figured it'd just be easier to use the Motive Wave window and talk about the charts, and then can pull up some other things if there's pertinent questions as we go.
Yeah, that's great.
So a little bit about me. I started the Stockwave service at ElliotWaveTrader.net about 13 years ago. I was one of the original members with Avi Gilbert, and started applying Elliott Wave to individual stocks, and started annoying people in his regular markets room. So they decided to create a special area for me to post my individual stock charts, and that grew into Stockwaves, which is the second largest service other than the market service at ElliotWaveTrader.net. Brought on Garrett Patton when he joined the Elliott Wave team, and together we've been running Stockwaves together. And we also launched in 2015 a standalone, well, a companion service, the Metals Mining and Agriculture service, run very similar to Stockwaves, but it focuses on precious metals and GDX, GDXJ, SIL, SILJ, and all of the individual mining stocks. We also do a lot with uranium and uranium miners. Some of the uranium bleeds into Stockwaves, and we cover some in both areas. Certainly the reactor companies. And then we also added the commodities to that, mostly the agricultural commodity softs, because they didn't really have another good home in other parts of Elliott Wave Trader. So always looking, one of the things that we do at Stockwaves is we, in addition to filling out member requests and posting wave setups, which I'll talk about a little bit more, But we do a couple videos during the week, usually about 10 minutes or so, cover 6 names, 8 names, whatever, of charts that just catch our eye. We do those on Mondays, Tuesdays, and Wednesdays. But every week on Thursday, we do a webinar. And we started initially, the webinars were just kind of amorphous, where we take member requests. But a few years ago, we decided to at least have the first 20 minutes or so of those webinars a little bit more structured, looking at picking one sector to delve into in a little bit more detail, and then drilling down into the individual components to see how those in the top holdings aligned with or differed from what the broad sector looked like. And then every couple weeks, we do a sector review, and really we're looking for good rotation opportunities, particularly as markets continue to extend and get ever more frothy, but not being able to break any kind of real support. We're always looking for what's the next sector that is going to either start showing some signs of weakness or be the one to pick up the torch and have added strength or more relative strength going forward. So on that note, I started doing a lot more work with ratio charts, and I share those a lot in the beginner circle section, which is an area that everybody at Elliott Wave Trader can see, not just people subscribed to any particular service. And just kind of saying, like, what can we learn and glean from a couple of these, from some of these different ratio charts. So I have up here to start off with the GLD to SLV ratio chart. This is a gold to silver ratio. I'm using the ETFs GLD and SLV because I personally track the continuous futures contracts that are back adjusted. And that's what I look at on a day-to-day basis at smaller time frames for a lot of fine detail that I share in the metals mining and agriculture service. And I also use that for my own personal futures trading. The problem with continuous futures contracts, and particularly the back adjusted ones, is that each time that contract rolls over, it shifts everything prior. And so if you're trying to have a continuous ratio chart or even a long-term continuous analysis, that's much better on a cash-oriented index or chart or ETF chart, so that you don't have to deal with those contract rolls. So for the purposes, particularly that are less exacting of a larger degree ratio chart, I just use GLD and SLV. So you can replace the 6.342 with a 63 to 1 ratio or something like that for silver to gold. So important things before we really dive in. Ratio charts are not an indication of a particular direction for either instrument. They are a way of viewing relative strength. Particularly, I think it's really interesting on something like gold and silver that those normally people think of gold and silver as trading, silver is just the little baby brother to gold, and that they trade almost in near perfect alignment. And it is true that a lot of the pops and drops are the same, and that if it's an up day for gold, it's probably an up day for silver. But the magnitude and amplitude of those moves varies, and that creates some nuanced differences in the chart. And obviously, there's some differences in the magnitude of those different moves, or our ratio chart would be a static line instead of a pretty big oscillator. So zooming out here, there was a really good 5-wave move up into the March 2020 extreme. I'm not going to call it a high necessarily. It was actually a high in, I'm pretty sure it was a high in gold. Maybe not. But it was an extreme in terms of extreme valuation of gold relative to silver. Silver was at a significant low point relative to the value of gold. Now, normally I view these ratio charts more like an oscillator, and I'm not looking for longer term trending moves to continue in terms of like a larger degree 1-2 setup for Elliott Wave. But we did know that if we could count 5 waves up, at the very least, we would be looking for a pretty large corrective consolidation. And so from that extreme, we saw a pretty significant 5-wave move down, then got an initial corrective bounce, which could easily have been all of the B wave, but couldn't gain any traction to the downside from there. And so that got over this high and then went up to hit a higher fib as a more complicated pattern for the B wave, but still was pretty extreme again at a 10.7 ratio, and was looking for a significant move to the downside, at least down towards the 50 to 1 ratio point. And it even had some exchanges on X with Lynn Alden, who works with us in Stockwaves, and it mentioned that in her recent book, well, not so recent, it came out like 2 or 3 years ago, Broken Money, one of the things that she talked about was that eons ago, the historic ratio of gold to silver was something like 20 to 1 or 25 to 1 of silver relative ounces per ounce of gold. But in the more modern age, that quickly ramped up because of the need for the divisibility of gold significantly plummeted relative to the needs for just the deliverable aspect of the long-term safe haven. And so that had quickly gotten to some pretty significant extremes. And I didn't think that we had a setup for this to go all the way back down into the 20 to 25 region, but looking for a move closer to a 50 to 1 seemed pretty probable based on measured move expectations and fib projections for a C wave, and that also happened to fit with Fibonacci support as far as a retrace from this larger move back here into that 2020 extreme. So we did fill out 5 waves down into a 1, 2, 3, 6 fib extension, and then spiked a little bit below that even to get to that 764, and then very rapidly reversed off of that significant low. So from there, we have another possible 5-wave move up. This can be in the start of something even more bullish longer term for gold relative to the value of silver. But more consolidation at a smaller degree in the short term would certainly be ideal. So this would give silver, as particularly if we got more of this possible 5th wave down for the wider flat for this wave 2, that could give a very short-term move where silver has outperforms gold before it starts to gold starts to outperform silver again on the way up back towards those higher ratios. And so now if we look at those individual charts, we can see something pretty interesting here for gold. There's certainly bullish potential for it to get the next 5th wave up higher off of the March lows. If it can't hold the 400 region, then there's a greater risk that it does try and tag one more low. Technically, this could count as a wave 4 of the C wave and break down to one more low and then reverse from there. But a lot of other things, particularly if you include the pre-market lows from March 23rd, look better with that being a more significant bottom, at least as far as many of the metals are concerned. But it doesn't have the most reliable retrace for all of the wave 2. It only hit a 50% fib ratio so far. So getting more of just a corrective bounce and then coming down in terms of a wider flat would be the more reliable and standard path that we would expect on gold. If it can get through 447 resistance to 450, then there's a chance that it is already starting 5 waves up for a wave 1 of this 3. But my base case assumption is that it's only going to get more of a corrective bounce into about that 436, 437 to 440 resistance region, and then try and fill out a little bit more of a wider flat. Meanwhile, silver would actually could count the same way and could count as all of this wave 2. The SLV chart looks a little bit different from the silver futures, so I'm actually going to pull that up and share that with you guys here. That silver futures in the very short term rather than just getting a bounce. So it is possible that this is all of the wave two, but my preferred count would really have, instead of getting a corrective bounce as a B wave and then a wider flat for wave two, the way that we're looking at on gold would be to get at least a nominal higher high into the 84 to 86 region for silver to count as a better fifth wave. And then it can fill out more as a standard wave two from there, while gold starts to get its C wave down as well. So just a little bit of interesting how the same general pattern at a larger degree for a fifth wave starting off of that March low can manifest in some different nuance, and obviously looking for the strength of the move to new highs to be much, much stronger in gold than it is for silver. And in fact, silver certainly was much weaker off of those March lows so far than gold has been. We good so far? David, you'll let me know if there's any glaring questions that shouldn't wait for the end.
Yeah, I can do that. Or
Okay, wonderful. Wonderful.
Yeah, there's none yet.
I don't want to lose anybody, and I'm kind of not touching on much of the nitty-gritty of the Elliott wave. We offer a lot of education at ElliottWaveTrader.net, trying to kind of talk in broader strokes, and because I didn't want to spend the time to do all of the background on exactly what Elliott wave is. This is just how I'm applying Elliott wave to those ratio charts. So next, I wanted to look at a ratio chart of GDX. This is the main mining stocks ETF, to the gold itself. And here we have an ideal wave 4 low counted, where the B wave actually made a nominal higher high in February and then got a move down, which is not the best 5 waves down, but you can count it as 1, 2, 3, 4, and 5 for that C wave. But it did only get 3 waves up. So there is a risk, and we'll see this when we look at a couple of the individual mining stock charts, that this high in February, the actual higher high, was an extension of this wave 3. And that this is the initial move down is the A wave, and this 3 wave bounce to a lower high is just a B wave here, and that this move is the start to a C wave down for a lower low, as that parentheses wave 4, rather than it being the start of the 5th wave already. And we can also see that the gold chart that we just looked at, it did count better as this being all of the wave 4. But it also has the similar 1-2 start, but not clearly holding all of that wave 2 yet. So it allows for a bounce and then maybe the wider flat. Whereas here, if we are looking at the potential start to that orange C wave, we're also looking for a corrective bounce here, just maybe not as high as that possible B wave if this is just working on a wider flat. So even the charts that look like they lean more in favor of getting a lower low, and a lot of the individual mining charts did not satisfy all of a reliable 4th wave the way that gold did. But they do look, if they are filling out that pattern, this should be wave 1 of that C wave down in most of them, and they should be due for a bounce here. So then when we look at GDX itself, we can see where that manifests and looks very similar to the gold structure, where if this is the start of the 5th wave off of that low, here on gold, it's probably 1 degree smaller. So just a nominal higher high is this wave 3, and then another 4, 5 to get up to the top of that primary wave 3. The alt here in yellow, when I try and be very careful and selective of when I show an alternate count and not post them for silly reasons. It's not just to show, well, here's a more bearish version alternative. And most of the time, there's a lot of nuanced overlap between those potentials. And the structure is also very similar. And I'm going to probably have to resort to that, to illustrating some alternate potential more so when I'm looking at an index that's a collection of individual names, when there's a lot of disparity and there's some names that lean more strongly to one of those outcomes than the other. If this is not all of the wave two, illustrated by the green for the wave two, we're looking for a similar bounce that we were talking about on gold, and then coming down as a wider flat back to this 84 to 82 or 80 support region off of that March low. If this was the B wave bounce, either in a wider, deeper version of the same yellow wave four, that's just where this next move is all of this primary wave three, instead of getting another fourth and a fifth wave after that, then that could get a little bit deeper here as an A, B, and a C wave down. But if we are starting those C waves down from the April high, most of those things are completing what looks like wave one and due for a corrective bounce as wave two, which would come into the 95 region as resistance. So ideally, we'd get a little bit higher than that if we're getting just a B wave, and certainly would get higher than the 102 region if we are starting the third wave up already off of that green wave two. But there's a lot of overlap between all of the potentials for at least a corrective bounce in the very short term. And depending on how that presents itself, we can evaluate it a little bit closer and make new decisions. We did post a number of wave setups on March 23rd because we had been looking for this consolidation. This was hitting the ideal support in the pre-market for a lot of the things that we were looking for, at least for the initial A wave move down of a bigger wave four. So we posted a number of wave setups looking for at least a bounce. Some of those were shorter term wave setups, and wave setups are high probability snapshots of an Elliott wave structure that clearly identifies support levels, invalidation levels, an initial resistance level, and a target level. And as those hit resistance levels, then we update those parameters, usually increasing, if it's a long position, increasing the support and increasing the invalidation levels, and then assigning a new resistance level that fits along with the Elliott wave structure as far as that next waypoint. And some of those wave setups that we added, just to give you some examples, were AEM, CDE, AG, AU, AGI, and SILJ, just to name a couple, all from that March 23rd low. And some of those were shorter terms, which we use a W to denote weeks, only targeting this region as a corrective bounce. Others were ones that could potentially count as all of the wave four that were targeting new highs, but posted showing that this would be significant resistance and that some traders would want to trim positions and look for further confirmation by holding higher lows and turning up from there for those to continue on to new highs. Also, starting on April 13th and into the rest of mid-April, we started posting some short wave setups for some of those names that looked more like they were starting C waves to the downside. One of those that just got an update last night was Franco-Nevada. This dipped a little bit deeper than ideal for it to still be just wave one of that C wave, but that really is the ideal path for that to get a B wave bounce, and then an ABC down for the third, and then a fourth wave bounce, and then a fifth wave that at that point might take it closer to the 180s instead of only the 195 region. But it could be further along. If so, I updated it this morning and lowered the support down to about 234. So because it seems more prudent at this point to follow this as though it is further along in the C wave than just a wave one. We have other wave setups that look more in line with getting a wave two bounce. And so if that is going to hold and fill out more directly towards the 200 region as the A, B, and the C wave down, then at this point it should really hold under that 234, get a little bit more of a third, and then a fourth and a fifth wave down for that C wave. Another one was GFI that was posted more recently as a shortwave setup back here in April 14th, I think. And so it hit its first resistance level as what should be wave 1. So if this is more bullish and this was all of the wave 4, then this is the support region that should also hold as the wave 2, but it should get more than just a corrective bounce into the 47 to 48 region and would go on to start to invalidate any immediate bearish potential as the start of that wave 3, and then we can be on the lookout for continuation of that move to new highs. I'm actually long a scalp on GFI, looking for at least some of this bounce right now. And then we'll look to restrike my short position if that clearly is a corrective ABC bounce. From there, I thought we'd take a quick detour and look at the ratio chart for Bitcoin to gold. And again, rather than using the gold futures and actual Bitcoin, for simplicity's sake and for the sake of the chart not getting wonky on me every couple of months, I use GBTC in the GLD ratio. So this is a very interesting chart. The red Fibonacci extension here represents a possible even larger cycle degree move higher. I don't have it labeled with a cycle degree low because I sometimes find that I need to temper expectations of members on our site and just zoom in and focus on something. And if I put a big capital Roman numeral wave 2 or even a big B wave there, then they might get super excited about the longer term potential and not focus on the near term potential for a drop lower in this C wave, the fifth of the C wave, deeper into fib support for this possible primary wave 2 in the gold to Bitcoin ratio. So this fourth might even potentially get higher. It could grow more than what's valid as a fourth wave and already be trying to start some sort of move up as wave 1 here. But most likely, we're still in just a corrective ABC bounce for a fourth wave, and we'll see some near-term weakness in Bitcoin relative to gold for that to head down close to the 0.1 region and maybe even down closer to 0.8 or 0.7 to hit those fibs. So when we look at the structure for Bitcoin, or GBTC in this case, I have an initial larger degree move down here that could be part of a bigger primary consolidation, and a corrective three-wave move up, which so far hit a 382 retrace. So technically that could be all of this B wave. That's kind of the minimum fib that we look for in terms of Fibonacci retrace ratios. But most of the time that's just going to be the A wave, and you're going to get a B wave consolidation and then a C wave down as a wider flat into the 50% of the 618 fibs, maybe even getting higher than that depending on the size of the 1-2 start to any C wave, if we can hold support down here in the 54 region for GBTC. So it hasn't shown any clear indication of a top yet. There's a little bit of room left up here towards 6420, which is the next fib, the 123.6% Fibonacci ratio for this degree circle C wave relative to the size of this A wave. But we can count 5 waves up completing inside that move. So certainly a good opportunity to raise some stops, be a little bit cautious, maybe even trim some of your Bitcoin position, looking for a corrective consolidation to retrace some of this move off of the February lows into support. For that to be reliable support, it needs to be holding as a corrective A, B, C consolidation. All right, so now I want to move on and shift gears and take a look at a few equity charts. And I want to actually start with something that is pretty important right now, and that is the XLE to RSP ratio chart. So talking about energy. This chart is pretty interesting. It doesn't count the same way that the XLE chart itself counts. XLE looks much more like this was a fourth wave and this is a fifth wave in a larger primary degree. And that is possible here. It just, this consolidation was much, much larger in both in time and in price relative to a lot of those moves in energy itself. And so it's a little bit less reliable for this to be 1, 2, 3 in this huge wide, even though it's pretty shallow consolidation relative to, you know, how deep some other things got. It's just so much larger proportionately than what this wave, possible wave 2 is for it to count as a wave 4. So instead, just counting this as probably a larger primary degree here, and then the ABC consolidation, which is kind of shallow for that ABC. So it is possible that this is maybe just an A wave and this is a B wave bounce. But this does look a little bit more bullish than just a B wave bounce. So because it did also fit with Fibonacci expectations for the wave 1 in this red measured move, I'm treating it as such. So off of that low then, we did get to a 618 retrace, which is the golden Fibonacci ratio, not the cleanest ABC down, and I actually have it counted as a WXY, but trying to move up nicely off of that low. Zooming in on a chart like this, you're not going to get the cleanest subwave structure. It starts to really, really thin out. So I'm going to leave it here at the 4 hour is the lowest we go. But this could be the start to a more bullish move, at least in terms of relative strength for XLE, the energy chart, relative to RSP, which is the equal weight S&P 500. Again, that doesn't necessarily mean that both of the charts or either of the charts need to be trending up. They could actually both be heading down from here. It just means that relative to each other, XLE is going to be stronger. Doesn't mean that it's stronger to the downside, just maybe just less of the downside move if they were to both be turning down. I don't necessarily know if that is exactly the case, but let's pull up the RSP chart and take a look at that first. So like many things in the market, we have a very, very extended move, especially when you go all the way back to 2009 lows. We can easily count 5 waves up complete. There's a little discrepancy on whether or not you count this as the primary degree wave 4, and then this is the 4 and 5 of the primary wave 5. Here I have the consolidation into 2022 counted as the primary 4th, and then an ending diagonal off of there for the primary wave 5. I show this on some of the other charts that we'll look at. There is one alt that I've been considering, and that within this primary wave 5 off of the 2022 low, it's possible that instead of this being 1, 2, 3, 4, and 5 completing, that this entire structure is actually a bigger ABC for that wave 3. But again, when you're considering an alternate count, it's also important to say, okay, where would this potential alternate pattern overlap with what I think is the most probable expectation, and where would it start to diverge? And in terms of the overlapping potential, that would be with the potential for a bigger consolidation as at least an intermediate degree 4th wave, which realistically should come down towards the 160s for that to be more reliable. So far, got an initial move down, and that looked like a possible alt 4th wave that allowed for further extension. I gotta zoom in to be able to see that a little bit better. And if we are in that green 5th wave, which could get another extension towards the 220 to 225 plus region, then support needs to hold in this 195 zone as an initial start to that bigger move. So we have what is not very reliably an impulsive move to the upside. It counts more as a corrective move, but got higher than reliable to be a corrective B wave, even though it is holding for now at a slightly lower high than the high that was struck back in February. It is not a reliable bearish start to anything more immediately bearish, certainly not until the 199.60 region can break as the highest level of support. And then even from there, as we said, we're looking for a possible move into support off of this high into this 195 region, and then maybe heading up towards the 220s for another extension. And so now comes the role. Well, we're going to look at XLE in a minute also. But with regard to equities in general, if there is that potential for even further extension, one, we're saying, okay, we recognize that based on our understanding of Elliott wave, we have full counts into significant resistance regions, but at the same time, we have potential for corrective consolidations to be holding to allow for further extension of those completed patterns. And so what is going to be the driver behind those extensions, and looking for those opportunities, whether it's sectors as a whole or individual components within that sector. And at the same time, if there is going to be some weakness, where is that weakness going to first start rearing its head from? What are those key levels of support, and how can we capitalize on that best? So now moving over to XLE. XLE counts great off of the 2020 lows as 5 waves up, as we were saying. So I have that counted as an intermediate degree 5 waves up for a primary wave 1, and then looking for a larger degree corrective consolidation as a primary wave 2 to be very, very bullish long-term on energy. But in the short term, we have a very complete count here, and I apologize for the recent split. It makes it hard to zoom in on some of the structure since that split back in the early part of the year, or December it was. But off of this possible high, we have an initial move down, and so far a corrective retrace into the normal fib resistance region that we look for a possible B wave bounce. And so that can be setting up at least a measured move down towards the 50 to 48 region, which would be the next spot for us to look for another bounce, ideally holding as a lower high, and then maybe coming down into the mid to lower 40s as either this larger A wave inside the even larger A wave of that primary wave 2, or possibly in an even more bullish parentheses wave 5, where this was just the A wave of that, and we can hold as this green B wave and then head up into the 70s before this primary wave 1 tops. We did get a little bit lower than we should have if we were going to hold as an alt 4th wave, but there are a couple of individual charts that we're tracking in stock waves that do still argue a little bit more in favor of getting one more high in this C of the parentheses 5 of that primary wave 1 before they actually start this up. But even among those more bullish ones, a lot of them look like just the wave 1 here, and so they can get some short-term consolidation as a wave 2 and then head up in more of that 3, 4, and 5 for that alt 5th wave. One of those names that we have been looking at closely and actually posted that a short opportunity ahead of earnings, it looked like it could pop a little bit towards this 158 level, and then it did reverse, and so far is getting a little bit of a corrective bounce to a lower high, was Exxon. Exxon also looks like it counts as 5 waves up for that primary degree wave 1, and is starting the small degree initial A wave and B wave inside a larger A wave of that even larger A wave of that consolidation. So as long as this can hold under the 158.26 level that it struck right on earnings, it has a setup to head down towards 127. And we're going to be continuing to follow that pretty closely. Next, wanted to take a look at the XLK to XLU ratio chart. So again, if we're going to be getting, so XLK is the technology ETF, different than just the Qs themselves, and XLU is the utilities. So if we are going to be getting more bullish extension that we had talked about in general equities on the RSP chart, then the XLK chart, or at least XLK relative to XLU, could be one of those main drivers of where that further extension comes from. And that would be as a much more extended intermediate degree parentheses wave 5 off of the April 2025 low. So the red alt here, which I actually can start to fade out because of the way that this made a slight higher high already, but it is still a little bit of a concern. Usually you want your wave 1 inside a more extended move for a fifth wave to pause before actually making a higher high. Once you make a higher high as 5 waves up over the top of that wave 3, then technically that can count as all of that parentheses wave 5. So that's what that's the reason for that red alt as a risk, but particularly this tiny little push higher here makes that even less of a concern and more like a possible 5-wave move up for wave 1 in this green wave 3. So in the short term, it should try and get more of a small degree wave 2 back towards the 3.2 to maybe 3.09 ratio. And that could be outperformance of XLU going to the upside and XLK being more stagnant, or it could mean some sort of pullback in XLK, or even a pullback in both, but just a more violent pullback in XLK to get affect that change in the ratio for it to head down. But overall, it does look like we have a nice setup for further extension as long as the threes can hold in that ratio chart. And one of the names that sticks out here is the Apple chart, and I haven't changed this here, so I'll just do this on here with you guys. But it looks to me like this was actually a larger ABC up for just the A wave in this fifth. So short term, we can fade back down, ideally towards that 618 Fibonacci retrace. Or if this was just the wider flat for wave 4 as the ABC in orange, then this can be 5 waves up for the A wave either way and fade back. But then from there, this can head up into the 320s and maybe even get a more blow off top towards 350. It is very, very toppy at a number of very large degrees. But as long as we're going to hold support in the 250s and ideally closer to 259, then there is potential for even more of a blow off top extension. And that could even get closer to the 123.6% fib extension, which is closer up here to the 373 region. So that is the larger intermediate degree C wave, but just the fib extensions for this C wave can easily take us up into the 325 zone. Another chart that I thought would be worthwhile to look at from the top holdings within XLK that might, again, some of the components could get hit much harder than all of the other components. So maybe we get that more mild corrective consolidation to the support in the 259 region, just discussed on Apple, before that heads up towards the 320s. But Micron could be a more significant top forming here as it gets what looks more like a blow off top extension that has potential to stretch even further towards the next fib in red at the 2618 fib extension, all just shy of 700. But it has a very, very full looking count here as the 5 waves up inside this intermediate degree C wave of that larger primary wave 5 that started all the way back here in March 2020. So this is filling out as a diagonal completing, and also something like a chart like Micron, where it does look a little bit more parabolic. The reversal out of a chart like this can be more violent. It doesn't mean it's a short setup right now, but just something to be on the lookout for, and that could have a more significant effect on XLK than a more mild consolidation that we might be expecting on something like Apple. The next ratio chart that I wanted to look at with you guys today is the XLY versus XLP. This is consumer discretionary versus consumer staples. This is another chart that Lynn and I have talked about a lot. She really likes kind of the view here where this is a good gauge of bullishness in the market, that if the staples are looking stronger relative to consumer discretionary, then that isn't the most bullish environment. But at least for our purposes right now, we have a decent start to at least another push to one more high as the 5th wave in this ending diagonal for the parentheses C, which is itself in the 5th wave of a much larger diagonal. So that should take us to new highs up in the 163, maybe pushing all the way up towards 1.8. And just needs to hold a little bit more of a reliable corrective consolidation as this B wave. We do have only 3 waves up, but we have 3 waves down and then a 3-wave bounce. If this were going to break under the 135 region, then it could be heading down as a measured move towards about 1.7 to 1.15 as more of a measured move off of this high. But this did not count reliably complete yet in terms of this ABC structure. Our C wave should have 5 waves. Would be a very unsatisfying, maybe a truncated top here, which I definitely don't want to count it that way. So looking for at least a nominal higher high towards that 163 seems like a good plan. Now, in terms of XLY itself, this actually has even more bullish potential. And we'll look at it on the daily first because of that split. So a little bit different than what that alt purple count that we had talked about on the RSP or something, where this was the alt parentheses wave 3. Instead of counting as an extension of the parentheses wave 3, this looks like it is just the A wave of a much more extended 5th of the primary wave 5. But like we were talking about on the XLK to XLU ratio chart, we do have a move up nominally higher than this parentheses wave 3 that is possible to count as all of that 5th. So we do need to see support hold in ideally the 111 region, coming down as a C wave towards 113 to 111 off of the recent high in the 120s that we struck. As a lower high for this B wave would be the most ideal inside that start to the C wave up. But there is a risk here that this was an A wave down and a B wave up in red. But so far, a pretty small consolidation. So if we start to drop strongly below 111, then it would add some strength to that red alt, and we'd be looking for that to break under the 104s. In terms of a more bearish start to consumer discretionary. Individual names within consumer discretionary that I think are pretty supportive of some upside. Tesla's probably my favorite. At the larger degree on Tesla, counting a ending diagonal off of the 2023 low back here from January 2023. So that's where all of the subwaves in the diagonal are ABCs, including waves 1, 3, and 5. So it's kind of a unique Elliott wave structure. We have an ABC up for that wave 1. We have an ABC down into the April 2024 low. We have a very large A wave relative to the normal expectations for the A wave of 3 based on Fibonacci pinball. But then inside this C wave, we also have a similar fractal of that larger A wave inside the wave 3 for 1, 2, 3, 4, 5 waves up for that C of 3 as the most ideal path. And off of the more recent April low, we have some really, really nice structure forming for Tesla to be more long-term bullish. Next, I wanted to take a look at the SOX to Qs ratio. For this, I want to zoom out at a much, much larger degree. So we have a very large cycle ABC move down into the October 2012 low. And then we are filling out as a diagonal off of that structure also at a very large cycle degree. So we have a primary degree ABC structure where we have 3 waves up in the A wave and then 5 waves up in the C wave for a cycle degree wave 1. We have a retrace that looks a little bit small timing wise relative to at least this primary degree B wave. So, but it did hit a 50% Fibonacci level. So perfectly acceptable as that cycle degree wave 2. Then we have an A. This is an expanded flat for the primary degree B wave. And then this parabolic move that resembles Micron a little bit that we were just looking at as 5 waves up in the primary degree C wave right into a cluster of fib resistance that we would expect for the C wave hitting a 1618 fib extension right now and a 178.6 fib extension in between that 178 and the 200% for that cycle degree wave 3. So again, this doesn't necessarily mean that the bottom is going to fall out for semis or for the Qs, but it does mean that the extra strength that we've seen, the relative strength of the semiconductors to the rest of the NASDAQ, seems like it is coming very close to an end and at a significant extreme. So that could get, a parabolic move like this, once it does start to break some initial support, could get an initial kind of sharp downdraft. But we're looking longer term for a corrective retrace back into the 0.50 region from the 0.7s for that to be the next run higher that would favor semiconductors over the Qs in general. Let's pull up the semiconductor chart. And here we are looking at this ABC completing off of the April 2025 low for a parentheses wave 5. Very small B wave here, but it does have a nice 5 waves up for the ending diagonal C wave off of that, proportionate to the size of the A wave. And into some pretty significant fibs. And at the smaller degree, we can even count a completing A, B, and 5 waves up in the C wave there. Zero sign of any significant top yet, but the 470 and then the 440 regions would be the first smaller degree signs of some support breaks potentially there. We also have AMD reporting popped a little bit and didn't do much. And here is the QQQ chart. This very similar to RSP, where the October 2022 counted as the primary degree wave 4 bottom, and then 5 waves up, potentially completing for a diagonal structure for that primary wave 5 of the cycle wave 3, right at a pretty significant fib. Again, if this is going to hold for another fourth and a fifth wave up even higher, there's overlap with the structure and support region that we'd be looking for the potential start of something more bearish as well, which would be an ABC down towards the 500 to 475 region, would be the most reliable for a new larger degree swing move. If something more like we're looking for potentially for further extension on RSP were to hold, then support off of at least off of the March low as the initial move of an even bigger extension would be in the 620 to 600 region of support from there. And let's take a look at the SPY gold chart, and then I'll open it up to some questions. So SPY gold chart hit a pretty significant bottom, which could be all of a larger cycle degree retrace, but easily just the primary degree A wave, since it was even shy of just a 50% retrace. Also, we did hit, yeah, we can delete that. Maybe it's possible this is an alt 4-5, but I think we're more in line with this being our wave 1. So we have an initial 3-wave move up, a corrective retrace that hit a 618. I think at this point we should just consider this a further, more remote alt because we did get that higher high. Ignore that spike. Sometimes the ratio charts do that. They get a little phantom bar. Can't quite clear that out right now, but we'll ignore it for the time being. But we do have a nice 5-wave move up with this push a little bit higher here. So it takes that less likely that this was a B wave with getting a 4th and a 5th wave higher. So ideally, this is wave 1 in a larger C wave of the primary degree B heading up towards the 214 region for the SPY to gold ratio. So in the very near term, we should see some weakness in the S&P 500 relative to gold for it to get some consolidation as this wave 2. But then it should outperform for more of that parentheses C wave up heading into the low 2s. And then looking at just the SPY itself, again, looking for at least a corrective consolidation similar to what we were just talking about on the Qs, and allowing for that to turn into a bigger consolidation as at least that wave 4 before it sets up for even further extension towards the 7,700, 800 region, or turning into a bigger A wave in the start of an even larger consolidation, if it does in fact start to break some support from probably that gap would be a good place to start in the 659 region. All right, with that, I can take some questions, David.
I don't see any questions yet, but we have a few minutes here. Does anyone have any questions for Zach?
And I know David posted the link for ElliotWaveTrader.net. Stockwaves and the Metals Mining and Agriculture Service both offer free trials, 15-day free trials. You can also find me at Zach Mannes, ZACMANNES on the Twitter.
Can you someone asks, can you zoom in to a lower time frame on SPY?
And I don't count the smaller degrees on charts like SPY. I'm going to look at that on the ES futures, but we can get similar structure to that A, B, C up that we were looking at on XLK off of this March low. So and even a possible small ending diagonal off of 702, 703 level from the other day completing. So that's going to be the first level that needs to break, just a hair under 703. And then from there, you're going to have support in the 660s as the next possible bullish support, or at least maybe getting a small degree B wave bounce from there.
Okay. Someone asked about the archive or the replay. It's we're live streaming to YouTube, so it's available basically instantly. And then the individual recordings will be available on TimingResearch.com as soon as I can get them.
Great.
Minute or so here. Can you all hear me still? Okay.
I can.
Okay. I just
We
got a
also try
message.
to have fun with stuff, and joke around and make puns and, try and alleviate some of the monotony of the trading and being super obsessed with markets can be. And one of the things that I think the approach of posting regular wave setups on both sides of the market and looking for kind of an ebb and flow between different sectors and just different areas of where the market, where money might be flowing within the broad market, not just equities, is it really takes away a lot of the necessity to hyper focus on a broad index, which is going to be choppier and have less clarity than an individual chart in many instances, because it is composed of lots of different individual charts. So that's one of the reasons why and then also, rather than having to worry about trying to hedge a position and be short-term bearish and long-term bullish on this, or scalping this, but having a core holding in the same thing, but that's in a different direction, you can just say, XYZ, not actually XYZ. I happen to be bullish on that chart, but XYZ chart looks bearish, so that's going to be a short wave setup, and other things look bullish, and so those are going to be longs, and through that I'm going to get nice diversification and be able to play things on both sides of the market.
All right, great. Thank you, Zach.
Thank you very much.
I gotta cut you off there, unfortunately, but thank you for joining us.
My pleasure.
All right, and yeah, so let me just post your link. All right, thank you, Zach. All right, so we have one more live presentation today, and to close up the day for us here is Jody Samuels. Jody, are you there?
Hi, Dave.
Hey, how are you?
Good. How are you?
Good.
Do you want me to share?
Yeah, you should be able to now. And just a reminder for everyone too, we will be back on at 10 a.m. Eastern time tomorrow and Thursday as well. So Martha Stokes will open the day for us tomorrow. And then we have Rob Roy, Price Headley, Mike Polinoff, Marino Villatoro, Daniel Zinish, Richard Friesen, Harry Boxer, and Jeff Tompkins tomorrow. So, right, Jody, I see your presentation now.
See my presentation? Okay.
Yeah. Are you ready to start?
Yeah.
All right, I'm going to start my recording and then you can start your presentation. So I am recording again now.
Thank you, everybody, for being here. Thank you, David. My topic today is spotting Elliott wave setups with the Wavy Tunnel Pro across global markets. And today I'm going to show you a simple 3-step playbook for identifying these setups. But before we begin, please read the disclaimer. Everything I share today is for educational purposes only, and as always, trading involves risk. Over the years, I've come to believe that markets move very much like a pendulum. I've been trading for a very long time. I started in the 80s, trading Forex for JP Morgan. And in my book, The Trader's Pendulum, I describe 3 forces that drive market behavior. The market pendulum, which represents price structure and cycles. We'll learn a lot about that today. The financial pendulum, which governs the capital that we're trading, risk and reward. And third is the emotional pendulum, which reflects fear and greed in the markets. And this is the psychology that drives traders to extremes. Elliott wave theory is one of the best frameworks we have for understanding how these emotional swings create repeating market patterns. And the markets do repeat with these patterns because the markets are fractal and these patterns repeat in all time frames and in all markets. So the question then becomes, how do we turn these patterns into actionable trades? And that's where the Wavy Tunnel Pro framework comes in. My work has been featured in major publications, including USA Today and International Business Times. That's great, but what matters most to me is being able to help traders apply these ideas in a practical way, and that's what we're going to focus on today. This is what we're going to do today. We're going to discuss the 5 core setups and how to spot these setups. We'll show live examples of each setup, and we'll cover the different asset classes. And the important thing is to learn how to trade with structure, not emotion. So I'm going to do my best to show you how to trade with structure. And then at the end, I will show you how to join the Wavy Tunnel Pro Accelerated Training. It's on demand. We had the 5-day accelerated training starting April 19th. All of the videos are fresh there, so you're more than welcome to join and get all of the recordings. But for now, I just want to focus on how these setups actually work in live markets. So what process do I follow to find the trades and execute with confidence and manage risk effectively? Over the years, I found that consistent trading really comes down to a very simple framework, which includes the analysis, the strategy, and optimal risk reward and trade management. So first we analyze market structure using the market map. And the strategy that I use is called the Wavy Tunnel Pro. So let me quickly connect the dots between Elliott wave, Fibonacci, and how we actually trade this structure. The market map is really the first step to understanding the context about what's going on. The market map helps us to identify the dominant trend and to anticipate possible future scenarios. Where are we? And to prepare for the next opportunities that will arise. And the market map comes from the complete market cycle. This is the classic Elliott wave market cycle. And notice the 5 waves up on the left and the 3 waves down on the right. And if we can find trades to mimic this market cycle and indicators to mimic this market cycle, which is what we've done in the Wavy Tunnel Pro, there's a very good chance to see these patterns in the market once we internalize these patterns. So I want to teach you what these patterns are today. And looking at this, and this is a very 5 waves up, 3 waves down, the correction is always in a lettered ABC. And then waves 2 and 4 are also corrections, so they are labeled ABC. And then at market swing points, highs and lows, you can see some technical analysis patterns, okay, that you might be familiar with. Head and shoulders patterns. Doesn't this look like a head and shoulder pattern? Shoulder, head, shoulder, shoulder, head, shoulder, shoulder, head, shoulder. So and then the reverse. You typically find that at the ends of swing moves. most investors feel greed at the top of this. This is point T. This is the top of wave 5. This is where optimism and exuberance are at the highest. And this is where traders tend to load up. And then after an ABC correction, we often see fear and panic when traders feel like bailing. But successful traders learn to reverse that instinct. As Warren Buffett famously said, be fearful when others are greedy, be greedy when others are fearful. This is the contrarian view. So we almost have to switch our brain to feel the fear up here and greed down here, because this is when we should be buying, and this is when we should be selling, taking profits, unloading a little bit. Okay, so our goal as traders is to train our brains to recognize when the market is reaching those emotional extremes, the exhaustion points, and be ready to take advantage of a significant move which follows so that we can then participate in the direction of the trend once again. And up to this point, we've been looking at the market map. And this is the market map on the left. And this mimics the complete market cycle as described by Elliott Wave. The challenge for traders is that waves are often difficult to see in real time. So the Wavy Tunnel Pro tools help us visualize that same structure directly on the chart. Instead of guessing where we are in the cycle, the Wavy Tunnel Pro helps us see it objectively on the chart. And this is a graphic of the Wavy Tunnel Pro mimicking the 8-wave market cycle. So you can see the wave trending with the 5 waves up. And then we have a significant ABC correction where it takes price down to the tunnel. And this is this ABC correction as shown in the Wavy Tunnel Pro chart. So the second step in our 3-step playbook is strategy. A clear strategy helps us identify the entry point, define the stop loss, set the profit target, and know when to trade and when to stay out of the market. We've already discussed how removing the emotion from the decision is key. So we want the decision to be very structured, so very automatic, so that when we see the pattern, when we see our trade, we can automatically take it and set our trade plan. The Wavy Tunnel Pro framework is built on a combination of several important market principles. First, the Elliott Wave, which helps us understand the rhythm of the market cycle. And then there's Fibonacci, which helps us to measure the timing and the symmetry within those waves. And then, of course, there are harmonic relationships which helps us to identify potential price targets. And then finally, momentum, which tells us whether the move has more strength or is beginning to exhaust. When these elements align, they create the setups that we look for within the Wavy Tunnel Pro. So let's talk about the framework of the Wavy Tunnel Pro and these setups. I showed you the visual, and these are the 5 core setups. So the start of the trend, we saw point 0 on the chart. We saw point T on the chart. The start of the trend would be really at point 0. The breakout 1 kicks off the trend. And then we have the trend expansion moves. So getting in on the trend, getting in on the wave 3, getting in on the wave 1, getting in on the wave 5. You can see that in our breakout 3 trade. This just helps you to trade the trend, to ride the wave 3 momentum if we're in a wave 3. And then there's the breakout 4 trade. That's after the ABC massive correction we have when the market wants to just get out of any long positions that they have. This is the time to initiate the breakout 4 trade for a potential buy again for the wave 5 move. At the top of the market, point T, we have the PW, the price to wave, and the fill the gap trade. And this is what it looks like on the chart. So you can't see the wave crossing the tunnel, but my definition of an uptrend is when the wave is above the tunnel and pointed up in the 12 to 2 o'clock position. So the wave is traveling higher. This is the tunnel, and the wave is separating from the tunnel. That's a very strong uptrend. And sometimes price, it's such a strong uptrend, and we'll look at examples shortly, that price is above the filter. This is the shortest moving average. This is the 12 EMA. And other times, price comes back into the wave. So when it's a very, very steep trend, price doesn't even come back into the wave. It just comes back to the filter. And then the trend is really, really stretched. So this is called the filter, the green EMA, and the wave are the 3 purple lines, moving averages on the charts. And then this is the tunnel. So the trend expansion trades take place over here. These are the breakout 3 trades, so riding the trend. And then the breakout 4 trade is down here after we've had a significant ABC correction, or whatever the complexity of the correction is. And this is where the breakout 4 kicks in, and you can see it in this diagram here, right down here. The trend reversal takes place at the market top. The price to wave is just price moving back into the wave. And then the fill the gap is once we have a confirmation that we have, in fact, a top, and we are going to have a more significant correction down into the tunnel. That's what I call the fill the gap trade. So let's just learn a little bit more about this, and we will look at live examples, but this is a case study on how to spot the end of the trend reversals. So this is the awesome oscillator, and this is one of my favorite indicators to use to see if the market is running out of steam. And we use it to look for divergence. So when you see divergence, and we see divergence here, we see divergence here, and that's when price makes a new high and the awesome oscillator makes a lower high, that tells us that price momentum is slowing down. The market is running out of steam. And we could potentially correct, which is what we do, like after we have divergence. And sometimes the market is really running, and we have like double divergence and triple divergence. This is very nice because it's just proper divergence. But we could make a new high and have another divergent histogram bars. Then the market sells off. So this is called the price to wave, and we look for divergence. We also look in terms of, taking the trade, we want to see some confirmation there, a 1, 2, 3 reversal for the next move, for the fill the gap trade. We don't want to just take the trade just because it comes down into the wave, because that could signal another move higher, an extended move. So on the left, we have a bullish price to wave. We have divergence. We have the purple diamond. Price moves into the wave. That's the price to wave. So if you are picking a bottom in the market, your first stop is going to be the wave. Like the market is definitely stretched. This is called the rubber band effect, where the market price action is away from the moving averages. So we are going to come back to equilibrium. Doesn't have to be now, but at some point we are going to come back to equilibrium. So this is what we call a bullish price to wave. And then the fill the gap is the continuation into the tunnel. And we get a great diamond here. So this is the continuation into the tunnel. So if you do go long, let's say down here, if I were to go long down here, my target is always going to be the tunnel, my first target. And then after that, we'll see what happens. We'll see if this is just a correction or if it is actually going to be the resumption of the uptrend. But right now this is bearish, and this to me is just a correction. On the right side, we have a bearish PW fill the gap. So same story. We have divergence, nice divergence, Price comes down into the wave, does a little retrace, and then it comes down below the tunnel. And at this point, we're thinking, okay, if we were short here, we would definitely want to take our profits down here because we don't know what's going to happen. This is our breakout 4 trade, so we're anyway anticipating a move back up again. Here's Apple on the daily chart. Again, we have divergence here, and we have triple divergence here. So we made a new high after we had divergence here. That's why what I was talking about, that you don't know if the market will extend. If we come down in a 3-wave move right into the wave and then we make a new high, we are going to extend. I mean, then this is just a correction into the wave. Now on this side, we come down into the wave and we could have gone up to make a new high, but instead we rallied above the wave and then we came down to below the tunnel. So this is the PW fill the gap trade. It goes right into a breakout 4 trade. I don't know why okay. Yeah. This is, okay. So this is a more current data in the little box here. So here we have the gray diamond. What happened after this? Do we go up and make new highs? No, we don't. We move up and we have another correction down. This is a complex correction right here. It's a complex correction. So we haven't made a new high above this high. Sometimes this is the bottom and we take off and there's no looking back. Other times we have a complex correction taking place, which is what this is. Okay, it's a complex correction and you can see that in the box. Okay, I'm just looking at the clock. So now we just learned together the price to wave, fill the gap. Let's talk about the breakout 4 trade. On the left, we have the gray diamond. So this is where we have the PW fill the gap. We had the corrective move above the tunnel. And now the question is, are we going to come down from here and make a new low or form some kind of a complex correction? That's the question. If the wave continues to cross above the tunnel, well, then we're talking about something completely different. This is no longer a correction, and instead this will find a bottom and we will start to trade up if the wave crosses above the tunnel. But for now, we can just say that we've reached our target, our objective, and at this point, this is a breakout 4. This is a legitimate sell trade for a move lower. On the right, we have Masco Corp. This is a legitimate buy trade, breakout 4 trade, stop below the low for a move higher. So let's see what happens. On the left, we had the original chart, and on the right, we see the price that this is the weekly chart. So in fact, price did come down lower. I mean, it did come down on this chart. It's a week old, it's a couple weeks old, a week old. So we did come down to this level. Okay, the 59 area on this breakout 4 sell signal. We did come down. Where we go from here, I don't know. Like, are we going to make new lows? I don't know. Okay. But I do know that if I were long, my first target would be up here. And this is a breakout 4 sell trade. Now, the bullish breakout 4 buy trade is over here on the left. Look what happened on the right. We traded up, we traded down. This is another complex correction. We traded up again, we traded down again. This is a sideways move right here. So sideways markets are corrective. We had the initial push down over here. It was very, likely that we would bounce off, trade up, maybe make a new high. If not, then we're in the corrective zone. Excuse me. Scratchy throat. Okay. Okay. Let's look at some ETFs, and then I'm going to show you some ETFs. I'll show you current markets. But this is the SPY Daily. It's not updated. It's a week old. Excuse me. Again, we have the PW fill the gap. It comes down. We call that a breakout 4 trade. And then we make new highs, okay, on the SPY. This, as long as the wave stays above the tunnel, and it did here, it can go into the tunnel, but it stayed in it. As long as it's not below the tunnel completely, this is still an uptrend, and this is merely a correction. Okay, that's it. When the wave starts to cross down below the tunnel, then we have we have another story to tell. But this story is strong trend, deep correction, off to the races again. That's his story. Here's the cues. Strong trend. We have divergence, but this is another case where was this going to end? We didn't know. Every time we came down into the wave, it was buyable again. Comes down into the wave, we make a new high. Comes down into the wave, we make a new high. Up here, we came down into the wave, we didn't make a new high. This is our 1, 2, 3 reversal. And then we had a complex correction, but we didn't make a new high. So we were anticipating a move down to the tunnel. Maybe it went a little bit more. We got a purple instead of a gray, but the wave is still in the tunnel. It didn't go below the tunnel, and now off to the races, as we know. So what happens from here? I don't know, but what I would like to see is whenever we have this histogram, all green bars, at some point we are going to come back to equilibrium with the awesome oscillator. And that means seeing some red histogram bars. And when we have red histogram bars, it means that we will either trade sideways or price will actually come down a bit for us to get the histogram down to the 0 line. I mean, that's what we need to see. Okay. So here, going back here, we had a very strong move and a strong histogram. We had red, but look what happened. We had a slowing down of the trend, but we still moved up. So typically when we have this kind of a strong move and the histogram bars come down to the 0 line, we could move up a little bit, but we could also trade sideways, and we could also correct and take our Fibonacci tool and correct more than just a sideways correction. So we don't know what the correction will be once we find a top and have some kind of correction. This is the weekly chart. So this just shows you that we haven't, like here, we had a peak in the awesome oscillator and we came down, and we're forming divergence on the weekly, but we haven't seen the top yet. I mean, as we know, we haven't seen the top. And because this has been such a strong market, we got this, okay, we got the move down, the PW filled the gap on the weekly. With this correction, we couldn't even make it to the tunnel. So when that happens, it just shows you that the market is very, very strong. Here's the Russell. In the Russell, we came down to the tunnel twice. So the Russell wasn't as strong as the Qs were and the SPYs were, because the Russell came down to the tunnel twice. And this is our signal to buy right here. We want to see the price coming down below the tunnel, and we want to see the wave above the tunnel. We don't want to see the wave crossing down below the tunnel. And then we took off from there. So this is the ideal setup that we want to see. We did not see that on the Qs, and we didn't see it on the SPYs. Sometimes, this is the XLY in the 60-minute, you don't get divergence. So here you have a peak in the awesome oscillator. You don't get divergence. Most of the time you do, but sometimes you don't. Like here we gapped up in price. We didn't get divergence, but we did come down to the tunnel. We didn't go below the tunnel. We came down to the tunnel, and that's okay. We had the correction. Very small bodies here. Very, very small. Okay. So that's the XLY. Futures, the NQ, the 5-minute. So these patterns occur on the futures markets as well. This is not current. Okay, this is an old picture. And again, price to wave, fill the gap, breakout 4. In a bullish market like we're in now, you want to look for these patterns. And I like to look for these patterns on the 15-minute chart on the futures markets. And very often when we get them on the 15-minute chart, if we do get them on the 15-minute chart, I mean, then the market turns around and goes up. So you can look for these patterns on the 15-minute chart where price comes down below the tunnel. This happens to be a 5-minute chart. But you see the same patterns. We have divergence here. This is lovely divergence. And then we have a price to wave, fill the gap right down to below the tunnel. Here's the ES. It's on the 1-minute chart. So you even get the 1-minute price action doing the exact same thing. Okay. We had the purple arrow over here. It turned gray once we made a new high. Okay, and now the purple is over here. So all of this is just to show you how you can use these moving averages to see when the price action is likely to hold. You can also use, obviously, your support and resistance zones, your supply and demand zones. You can look left, et cetera, but I find that these Fibonacci moving averages hold really, really well. And when price is coming down for the PW fill the gap, we typically go below. These moving averages, the tunnel. Okay. So this is gold, the 1-minute. Divergence, price comes down, and then price goes back up again. PW fill the gap, breakout 4. So PW fill the gap, breakout 4 trade, that's how it goes. And then if we are going to continue up and make a new high, so it goes. That's one possibility. The other possibility is that we have a deeper, a longer in time correction. This is the GC 15-minute. We have divergence, PW fill the gap. Kind of sloppy move down, but then we have the breakout 4 here. And we have the 4 hours. Markets are fractal. These patterns are going to repeat themselves. Corrections A, B, C. Really nice, really nice. Okay, now we're going to switch gears to ETFs. This is the Select Sector Spider ETF Sector Tracker year to date. So here are all of the tickers on the left. So if we take the top one, Energy XLE, this is the last price, and this is the end of the year price. The change is here. The percent change is up 32.83%. Energy is the strongest performer of all of these sectors year to date, up 32.83%. Then comes information technology, then comes materials, then comes industrials, then comes real estate, then utilities, then consumer staples. And we had some negative returns, communication services, consumer discretionary, financials, and healthcare. And then this is the SPY. Okay. So what I want to do now is take a look at some of the top performers in energy and look at the charts and show you what's going on in the charts and what the patterns are. And then we're going to have a look at XLK as well. We're going to break that down. So let's get started with energy. There are 22 holdings in XLE in this sector. So 22, okay, these are them. There might be a few more. I don't know if there are 22 on this page, but the highest return is 71%, okay? The energy sector on balance, if you look at the 22 holdings, they were all up year to date except for one. And I'll show you the one that wasn't. And you'll be able to see how obvious it was that it wasn't going to be up and you wouldn't want to buy it. And I'll explain why. So we're going to look at the top 5, and then we're going to look at the one that is negative for the year. Where I have the circle is the end of the year, okay, the beginning of the year. So here's APA Corp, up 71.79% for the year. All of these trades are breakout 3 trades. The wave is separating from the tunnel. You don't, and this is where we get a steep incline because price only comes back to the filter. We don't even come back to the filter. This was just runaway, okay, because of the geopolitical situation, etc. And then we had this purple top, and we have our price to wave. Now we are at a critical juncture. Either we had a significant retracement, but because the market is on fire over here anyway, we didn't come down to the tunnel. Doesn't mean that we won't. So we made a move down, and it looks to be a 5-wave move down. This could be a 3-wave move correction, and we still can come down to below the tunnel, or we make a new high. Okay, we don't know at this point. Confirmation would be is if we start to come down from this level and break down below this wave again, then we can say, well, gee, maybe we are coming down to the tunnel. But this is where we started off, right here. We started off the year. So all of these dips into the wave were buyable and even into the filter. Here, you're just making new highs. So that's the first example. Here's Marathon Petroleum Corp. It's up 55% year to date. And this is very interesting because this is our pattern that we were just discussing. Right over here, we had the breakout 4 trade. And then what I like to see after the breakout 4 trade is I like to see a 1, 2, 3 reversal, and this gives us it. So we have gray, red, red. I'm just talking about the dots. Gray diamond and then the red, red. That's a 1, 2, 3 reversal. When we broke above this top, you would want to buy it. And then the wave starts to separate from the tunnel. And this area is buyable. Beautiful area. We get a nice impulsive move up, and then we came down. So if you see this kind of a pattern where the wave is separating after we see this kind of a bottom, that's a nice pattern to take advantage of right here. Here it gets a little tricky. Again, it's very steep uptrend, very tricky. Like, you can buy once we take out these highs, but this is tricky. And then we see the same pattern. We came down below the wave and we started to move up again. So either we're going to take out these price highs, and it looks like we are, doesn't it? Or we're going to come down and do a deeper correction into the tunnel. Here's Valero Energy Corp. This is where we were at the end of the year. And again, we have nice breakout 3 trades, nice dips into the wave. Okay, here we have dips into the filter because we have a very steep uptrend. Same pattern. Are we going to come down to the tunnel or are we going to make new highs? We're at a critical juncture here. Now we have Baker Hughes Company up 51% for the year. Part of XLE, one of the 22 stocks in XLE, which is up 32.83% for the year. And here we didn't get the gray, and we didn't get the gray, but we came down to equilibrium, the tunnel, and then the wave started to separate from the tunnel, and any pullback is buyable. Like really, this was the first pullback that we had, and then we had a very steep incline right above the filter. So that's very bullish, and it's also difficult to get in. You can get in on the breaks or on the pullback to the filter. And then we had a corrective move down, and we made new highs. So here, there's really nothing much to say. I mean, it's still, I prefer to wait for dips to buy. I don't like to buy once we're making new this kind of a high. We do have divergence, so I would be cautious at this point, but it looks very, very bullish nonetheless. Texas Pacific Land Corp, up 50% for the year. Same story. Now, this is interesting because remember I told you that a bullish pattern is when the wave is above the tunnel. Well, here it's not. The wave is below the tunnel. So this would have been the last one that I would be interested in buying just based on the pattern. The wave is below the tunnel. Before I get interested in anything, I want to see the wave crossing the tunnel. Now the price crosses first, and then you have the 12 EMA crossing, and then you have the wave crossing. So this would be an early cross, and then we come down. Actually, this right here, this is not a bad place to enter because we've already crossed and we're coming back and retesting. Then we make new highs. Whoa, this is a wicked sideways consolidation. Could have gone either way, and as soon as we broke down, there's your PW, fill the gap trade. Yeah, and two things can happen. Either we make new highs or we have a longer consolidation. We've seen those patterns over and over again today. Do we have any questions, by the way? Let me see if there are any questions. I'm going to put up okay, if you do have any questions, please ask. Okay, that's fine. And I can answer your questions as we go. So now we're going to look at the one that lost. I said that there were 22 holdings in the XLE. So I sorted by the smallest return, and that would be this stock up here. So this is the only stock in the XLE that has a negative return for the year to date. So we're going to take a look at that chart. You can see the difference. There's a big difference. All the ones that we saw that had positive gains, the wave was above the tunnel, the wave was separating from the tunnel, and all pullbacks were buyable. Okay, so let's have a look at this stock that's down, EXE. Yeah. Okay, so this is the beginning of the year. This is what I call chop around the tunnel. Chop around the tunnel. So it's a sideways market. It's just a sideways market. It's difficult. You can see that it's not cleanly trending up. It's not cleanly trending down. it's sideways. So with this kind of a pattern, you need to trade the range if you're going to trade it at all. So this is the ideal pattern where you trade from purple to purple to purple to purple when it's so sideways like this. Okay, chop around, chop around, chop around. So that's why this is down for the year, because we're slightly lower than where we opened up the year. Now let's move on to XLK. XLK has 73 holdings and it's up 12.56% for the year. Now what's interesting is there's 73 stocks in this ETF, and around 30 have negative returns for the year. So roughly half, a little less than half. I'm going to show you some of the negative returns, and we're going to start with the positive returns. I'm not going to show you this top one, SanDisk, but its return, the price opened up the year at 237, and the last price was 1255. So 429% return on that one. But we're going to start with the next stock, STX, up 168% for the year. Okay, this is STX. This is where we are at the beginning of the year. And this is just such a clean uptrend. The wave is above the tunnel. These are the types of stocks that you want to look for. Because these stocks are in uptrends, and every time price stretches away from the wave and comes back in, it's buyable. Okay, so this is a very strong pattern. Also, we have a peak in the awesome oscillator here. This is really an exhaustion in the awesome oscillator. Okay, yeah. Yeah, and we don't have divergence here. Do you see? We do not have divergence in the awesome oscillator. We keep making new highs and there's no divergence, and we make a new high again. Okay, the next stock is Light. It's up 164% from the beginning of the year. Same thing. The wave is separating from the tunnel, and every time we come back into the wave, it's buyable. So this is what a really nice pattern looks like. Here we have some divergence finally. We have some divergence, but we made a new high. So we have divergence between this peak and this peak. We had a 3-wave move into the wave, and then we made a new high. Okay, the awesome oscillator didn't make a new peak, so there is triple divergence here forming. We made a new high. So we have to watch, what happens. And we can't pick tops. I mean, you don't pick tops. You wait until we see some kind of resolution and a move back down below the wave, if we are going to start to move lower. And I'm not saying that we are. Okay, Intel, oh boy, what a rock star this one, huh? So this is the year end. Very quiet. Intel was very quiet until about a month ago. And then boom, a couple weeks ago, 3 weeks ago, and then boom. Yeah. And you can see the wave separating from the tunnel. You can see the awesome oscillator traveling higher and higher, higher. The histogram, really, very, very, very strong. And then Western Digital Corp up 156% for the year. Just watching the clock. Okay. You can see the same thing happening. This is year end, healthy move, wave is separating from the tunnel. So when you see this kind of price action, these are the stocks that you want to get involved in. Same thing here. Okay, Sienna Corp up 130%. Okay, no divergence yet in the awesome oscillator. So when I sorted from the biggest loss, this is what I get. So we're going to look at a couple of these stocks to show you the difference in the way the chart looks. So like I said, out of 73 holdings, roughly 30 had negative returns. That's why you saw such high positive returns, but the negative returns balanced out the very high positive returns so that the XLK is up only 12.56% year to date. I don't want to say only, but compared to the 150% returns that we were seeing. So let's look at the top two stocks here. EPAM Systems Inc. down 46%. Look at the way this is. The wave is below the tunnel. So up here, the beginning of the year, this is when we petered out. We had awesome oscillator divergence. This was a warning sign that if we came down to the wave and failed to make a new high, we could come down to below the tunnel. Only it didn't stop there. It continued down. So as soon as the wave crosses down below the tunnel, that's when you say, okay, something's wrong here. Like this might have been buyable at the time. Right here, it might have been buyable. Maybe we got the gray diamond here. And then we started to move up. But as soon as the wave crosses down below the tunnel, all bets are off and we take out this low. That's it. It's over. Now, no longer interested in this stock. And then there's another one. The wave is below the tunnel the entire time. Not interested. This is the year end. Not so it was even below the tunnel before the start of the year. Not interested, just not. Okay? There are plenty of stocks which are much healthier. So there are a few questions. Do I have today's NQ chart? I shut my NQ chart down. But what's your question about the NQ chart? On the NQ, we did trade down. We did have that breakout 4 trade today. We had well, yeah, I don't have it open, but we did. If you look at your NQ chart, we did have the PW fill the gap, that sell off, and we did get the nice gray on the 15-minute chart. For the two tunnel lines, what are the values of the exponential moving averages? The 144 and 169. Those are the values. So these are the Wavy Tunnel Pro platforms. That's enough of the analysis for now. Now I'm going to tell you a little bit about the Wavy Tunnel Pro and where we have our indicators. We have a new dashboard scanner. That's all of these charts are from the dashboard scanner. Very, very pretty charts. The dashboard scanner is an end of day scanner on the daily and the weekly, and it scans over 4,900 symbols. Then we have the indicator suite and scanners on MetaTrader 4, NinjaTrader, MotiveWave, and TradeStation. And we have the indicators on Wealth Charts and TradingView, but no scanners. This is what it looks like on MetaTrader 4. We also have trend line breaks. These are automatic trend lines. And when you get the arrows and then the horizontal arrows, it gives you the price target. So here we had the red trend line that was broken. We have a red up arrow. This is the price target. This is your PW fill the gap trade. Okay, this is how it looks on MetaTrader 4. I kept all of the trend lines on just to show you, but you can remove them after the target is hit. It can automatically leave. This is NinjaTrader. Also have the trend line breaks. And we have the breakout 4 trade and price targets for the breakout 4. So this is very nice. So we learned 5 setups today. We learned about the breakout 1. That's when the wave crosses the tunnel. We learned about the breakout 3 trades. That's when we have strong trend expansion. We saw lots of those examples. And with wave 3 momentum, we learned about the breakout 4 trade after an ABC, which can be a wave 2 or a wave 4. We have a break. It's called a breakout because it's a breakout for hopefully new highs for a wave 5 or an extended correction. And then we have the PW, the price to wave, and the fill the gap. We saw enough of those examples. And this is what it looks like once again. So it's a progression of trades that occur over and over and over again. And once you get the hang of it and you start to really internalize it and see it on the chart never the chart tells a story. You can see the market cycles without really counting the waves. And if you have somebody who's counting waves for you, like if you have an Elliotician or whatever, and you're looking at wave counts, and you use the wave tunnel in conjunction with the wave counts, it's great, just great. In fact, that's how I started out trading on the desk at JP Morgan. We had an Elliotician on the desk. He came from the floor of the Chicago Board of Trade, so he taught us a lot of stuff, including, all about pivot points and support and resistance and where he felt price would stop. And he was great to have on the desk because we were trading in the trenches and it was difficult to do analysis ourselves. I mean, I was busy, trading. So these patterns are great. These blue and red dots, these are your breakout 3 trades. And the gray, your breakout 4 trade. Here and here again. That's the gray arrow, start of the trend, the new trend for the next move higher. And then the purple arrow is the end of the swing move. And then we start all over again, PW fill the gap. So to trade this framework consistently, you need a clear roadmap of the market cycles, which I taught you about today, and a structured strategy for the setups, rules for entry, stops, and targets. And then you just practice applying the setups on real charts. And trade on a demo account, of course. So I told you that our 5-day accelerated training was the week of April 19th, but it was a great week, and you're welcome to join. All of the setups are there. All of the recordings are there. Everything is there. And it was really a great week. So I think you would enjoy it. And then, of course, I would be able to meet with you to discuss, to have a few coaching sessions with you if you join. So this program is for new traders looking for a clear trading roadmap, for experienced traders looking to improve consistency, for traders across all markets, for Forex, futures, stocks, options, cryptocurrency traders. The accelerated training includes 5 days of accelerated training, but we have a ton of videos. I mean, and it's really complete training. You get the complete Wavy Tunnel Pro strategy and course manual. We cover a lot. We cover Elliott wave analysis, Fibonacci, harmonics, lots of real chart trade examples, unlimited access to training. It's a great, great program. I think the students really loved it. They all gave it a 10 on a scale of 1 to 10. Bonuses, 2 months access to the Wavy Tunnel Pro desk with Pro, elite tools and scanner for Forex, stocks, commodities, and crypto, market outlook video 4 times a week with the weekly live session. You get 2 months access to the Wavy Tunnel Pro dashboard scanner and a one-on-one coaching session with me. And we have Wavy Tunnel Pro trade analysis mastermind videos with 11 student trade reviews. So the real question isn't about price. The real question is, how long will it take to figure this out alone? And how much money might be lost through trial and error? And how much faster could progress happen with a clear framework? Learning from experience is valuable, but learning from a structured process is much faster. So it's wavytunnelpro.com. David posted it. Wavytunnelpro.com is where you can find this. And I really do hope you join me. So today we covered a lot: the market map, Elliott wave structure, Fibonacci timing, the Wavy Tunnel Pro setups. But the real key to consistency is not just understanding these concepts, it's having a clear process to apply them every day. And that's exactly what we teach in the Wavy Tunnel Pro accelerated training. And if what you saw today resonated with you, I invite you to take the next step. So you can scan the QR code on the screen or go to wavytunnelpro.com to learn more and reserve your seat. Okay. I would love to work with you and help you build the clarity, confidence, and consistency that every trader is looking for. So thank you for being here live. I hope to see you inside the program. And if you have any questions at all, please contact me, Jody at fxtradersedge.com. That's all I have today. If anybody else has any questions. All right, David, no questions.
All right. Thanks, Jody.
Thank you.
Thank you
Thanks,
for
everybody.
closing down the day for us.
Thank you.
Put your sites in there again. So everyone be sure to, check out Jody's links there.
Okay. And enjoy the next 2 days, everybody.
Yeah. Yeah, that's the end of day one, but we have another 2 days of great presentations lined up for you all. So let's see, the archive, the full unedited archive for today is here on YouTube. We're live streaming there. And that'll be available permanently, but then also as soon as I can get all the individual recordings processed, those will be posted to YouTube and to TimingResearch.com as well. And let me get that link for you. Yeah, if you want to bookmark that link, yeah, the archive for today will be there as soon as possible. Let's see. Hold on just a second. I have a couple other things for you. Yeah, if you enjoyed today, or if you have any questions or feedback or suggestions or whatever, you can reply to any Timing Research email that comes to me directly. Or there's a contact form on the Timing Research site that also comes straight to me. If you want to add future Timing Research events to your Google Calendar, there's a link. I just posted a link there for that. Also, you can get updates on Telegram and Substack, and of course, the full 12-year history of Timing Research is permanently archived onto YouTube, the Timing Research YouTube channel. A couple other little things for you. Jeff Tompkins is going to be here tomorrow, but then also on Thursday and Saturday, he has some important presentations he's going to be hosting. So he has this PDF that'll give you more information about that I think you'll find interesting. So click that link, check that out. Also, our friends at NetPicks have this Iron Condor options report that I think you'll also find interesting. And so, yeah, be sure to check those out. And let's see. What else do yeah, like I said, tomorrow and Thursday, we start at 10 a.m. again. So you can just come to TimingResearch.com and log directly into the room that way. But of course, I'll be sending out the email reminders into like normal. So, all right. So that's it for today. Does anyone have any questions or anything before we close out? All right. Oh, to yeah, just one more thing here real fast. Get my correct list. Of course, thank you again to Jody for helping to close up the day for us. And thank you to Anka Metcalf of TradeOutLoud.com, who's my partner on this series. And then also I want to thank again my our co-sponsors for this event, MadHedgeFundTrader.com, TradeThirsty.com, and TradingIndicators.com. So, all right, so that's it for today. Thanks, everyone.